understating the potential impact of inflation. Those shares are down about 4.5%, 5% right now. They're down more than 30% year to date. Carl?
Morgan, one name going green for the year so far this morning is Tesla. Company says it wants to split the stock so it can pay a stock dividend to shareholders. Also suspending production at its Shanghai Gigafactory as that city once again goes into lockdown over rising COVID cases. On top of all of that, Elon Musk says he once again has tested positive for COVID himself. No symptoms. Joining us this morning, Roth Capital Tesla analyst Craig Irwin has a neutral and a 250 target on the stock. Craig, it's good to see you again. On the split, what do we think the motivation is?
For 23, 24, 25, new models like the mini car. You have Germany ramping. You have so many initiatives like India that they should really give us some pretty good visibility on. Hopefully this year. It's been too long, but these are big levers the company can pull and will pull. And I think there'll be positives in the valuation. That's why I keep the neutral despite being bearish.
Right. Yeah, 250s, rather bearish. On production, Giga Berlin, we've had some commentary in recent days that's going to help at least Q1 momentum on delivery. But now we have Shanghai to worry about. Which is going to win out?
I think there's puts and takes. It's very, very hard to know exactly at this point. If people want to know, they should look to the registrations data from EV volumes. Victor Earl and his team out of Sweden do a phenomenal job there. Globally, we're going to have to wait for that data to really know. Reality is, I don't think we have a miss coming anytime soon. I think this is a company that will continue to beat on deliveries, continue to do a spectacular job. The question now in my mind is, 1.5 million really the number for this year? Do we beat that? Quite possibly we do. So Shanghai is a speed bump, but it's not something that we see as really a major impediment. If anything, there'll be pent-up demand in China for those vehicles.
So, Craig, with Tesla trading over $1,000 a share right now, why the $250 price target? Why do you hang on to that?
So you look at the largest automotive company globally, Toyota, right? They have about a $300 billion valuation. They sold 9 million cars last year. There is nothing that Tesla has that Toyota doesn't as far as technology. Toyota has a much closer relationship historically to Panasonic than Tesla. Tesla's got a $1 trillion valuation. They sold 900,000 cars. Okay, we should give them a very chunky premium for leadership in EVs, right? Really creating the EV market. But I think 300 billion is probably closer to where this thing should be. 250, 300 billion, not a trillion. Because by the end of 2025, there's going to be 500 EV models on the road. There's 60 new EV models coming this year. Many of them will be successful. Tesla's just done a spectacular job, and they should be rewarded for that. But a premium valuation would be, a third of where the stock is now, or a quarter.
Yeah, I get that, and certainly in terms of absolute numbers of vehicles that are being sold and manufactured, I mean, Tesla's still a smaller player. That being said, there has been this emerging narrative that Tesla is kind of the maturing, leading option when it comes to EVs specifically. You don't buy into that?
I completely buy into that. I think Tesla's a very exciting, interesting company. I just don't see them doing 20 million vehicles. I think there's going to be too much competitive pressure. And others that have moved fast and maybe not done the optimizing of their technology. Porsche's a great example. They should have had silicon carbide in their drivetrain. Will make those changes, and they will all be fully implemented by 2025. Tesla's valuation is really a function of the scarcity of successful companies in the sector. By the end of this year, I think we're going to start seeing a few more that are treated with fair to optimistic valuations. We've already seen a couple of those. And that's why I'm saying I think people are much better off in the small cap names right now.
Yeah, Craig, finally, just to get to sort of the global supply or lack of it of certain commodities that are crucial for the making of batteries and other things involved with EV, is that a concern to you in terms of the cost that these manufacturers are going to have to potentially pass along?
So the cost of batteries is a point of controversy where I've been on the controversial side for years, right? You'll recall that when I initiated a couple of years ago, I said that the actual battery price was close to double what Tesla was claiming then. So this last week, we saw Tesla raise the price of its mega pack by 25%. Battery costs are materially higher than what all of the consultants out there are saying. Tesla does not have a moat in battery technology. And the price increases we've seen in the last couple months are because of these rising battery prices impacting vehicles. Now, that is a headwind on total market adoption, right? But it's not a big one, and EVs are absolutely inevitable. So, the 500 EVs that are coming over the next few years, I think many of them have a really good chance of being wildly successful. And you look at the energy security issues in Europe, you look at gasoline prices, these push people to really want to own EVs. And then, heck, I ask everybody to test drive an EV before you buy your next car. I did, and wow, the performance, I test drove many, right? But the match for what I wanted. And I'll probably never go back, even though I'm bearish on Tesla. I'm not bearish on EVs. I think EVs offer an incredible opportunity.
Yeah, it reminds me of what the Daimler chief said to the FT over the weekend, and that is that the cost of building a battery-powered truck, at least, will, quote, forever be higher than a combustion engine equivalent, in part because of what's happened in the last month or so. But you don't think it's that much of a disincentive long term?
So trucks are a very special situation, right? Because payload is so very important, and the longer your range you need, the bigger batteries. So I'm not a big believer in long-haul EV trucks, maybe distribution center to distribution center. Shuttle school buses are the area of the market that I think is really ripe for aggressive adoption. President Biden's put in $5 billion in funding for the school bus market. So that's a market that's really going to work. There are areas that are more economically sensitive and areas that are less economically sensitive to battery materials and other commodities prices and to absolute vehicle prices. And I think it's going to be really self-evident that there's a lot of opportunity for success over the next several years. And I think this year is a key year where we get data points from many of those companies.
Craig, good stuff. I covered a lot of ground about Tesla and the industry at large. We'll see you next time. Craig,
thank you.
All right, let's turn to the broader markets. Now our senior markets commentator, Mike Santoli, joins us now, taking a look at the action so far. Mike.
Yeah, David, the stock market at least continues to absorb these fast moves in other parts of the capital markets, the repricing of Fed intentions in bonds. You're seeing the Japanese yen kind of crash against the dollar right now, and really just this general reset of expectations in terms of how rapid and front-loaded this tightening cycle is going to be. And here we are. We've gained back about 60% of the overall correction losses in the S&P 500. And since the Fed came out and officials started pushing the 50 basis point move next, what you've seen is stocks up 10%, volatility down, credit spreads narrower. So at least for now, it suggests that investors are willing to buy the premise that we're headed for some kind of a soft landing. Of course, that's not going to be determined till later. The bond market says fast tightening and then maybe even going to cut rates next year, the year after. That sometimes happens ahead of a recession when it's in sight, but sometimes it doesn't. 1994 is an example, and I would argue 2015 to 2019, we saw one of those round trips without being on the precipice of recession, of course, before we got COVID push us in, guys.
All right. Well, Mike, stay with us because we're also going to bring in RBC Capital's Amy Wu Silverman to this conversation around the markets. Amy, Mike just talked about volatility being down. It's kind of incredible that even though we've been seeing these stark moves in the bond market in recent days, the S&P is now up over 8% in the past 2 weeks. It's recouped all of its losses since the Russia invasion. The NASDAQ 100 has gained almost 11%. What do you make of the market action we are seeing?
Yeah, look, it's pretty staggering. If you actually take QQQs, even since mid-March, that's up 15%. And those bond-related proxies that you mentioned, an IEF or a TLT, is down 7%. And of course, VIX is basically back to pre-Ukraine crisis levels. And the question is, has anything changed geopolitically that would justify that decline in uncertainty? I think probably near-term tenors of volatility are too low now. in particular, even if you take out the Ukraine crisis, we're just heading into earnings, which historically is a seasonally good catalyst to own volatility and to see volatility rise.
Mike, just to go back to the 1994 example, I mean, how similar are we in terms of history? I mean, was inflation high in the early to mid 1990s? Does it actually serve as a closely related template for how the Fed could execute on a soft landing?
Well, Morgan, there's a reason that Fed officials love looking at 1994, because it was this nearly perfectly executed mid-cycle tightening that really didn't push things toward recession very dramatically. I would say there are some similarities. We already are seeing a sideways choppy stock market with valuations getting compressed as people expect the Fed to move. 1994, you also had a lot more labor market slack than the Fed was giving the economy credit for at the beginning. Unemployment was above 6%. The Fed was being very preemptive in trying to keep the economy from overheating, and unemployment fell pretty dramatically during the course of the tightening cycle. Corporate profits did well. So I think you have some of the makings, but we're at higher absolute valuations right now. And quite intentionally, this Fed is not trying to be preemptive. They came into this inflationary period saying, we're going to let it run a while. We're not going to try to kind of anticipate it and get in front of it. And that leaves us in a very different spot, I think, than the starting place of 94.
You know, it's another morning in which we're looking at various curve inversions. Today it's 530s, and that's inevitably met with the response that QE distorts the overall curve, and we won't really know what the true curve looks like until we start reversing that purchase dynamic. Is that true? Do you believe that?
Oh, if that's for me, Carl, I don't think that we can necessarily say, oh, because the Fed's running this huge balance sheet, that all of a sudden the longer end yields are not reflective of something. We saw them. We've seen them move from 1.7 to 2.5 in a couple of months' time. It's not as if they can't move relative to supply and demand. But I do think you can say that the yield curve inversions themselves are not necessarily telling you something specific about the economic cycle. They're saying there's a certain window where the Fed can hike. It's front-loaded. After that, we don't think they can actually keep or get rates much higher, and therefore that explains some of the kinks in the curve.
Amy, you just touched on earnings. I mean, it's pretty incredible to think we're about to close out not only the month, but the first quarter. So how would you be advising positioning coming into that season, which is perhaps more critical than it has been in a really long time, given the fact that other dynamics, more macro dynamics in the market are very different than they were, say, just a couple months or a year ago?
Yeah, I think it's extremely critical. And historically, when you look to past earnings seasons, there are a couple of things that become very clear. The first thing is that, in the first 8 quarters, the first 2 are always times to own volatility. So, we're positioned to own that volatility, in particular, as we see near-term volatility having declined. The other thing I would say is, we also looked back into the 1990s, looked past kind of the last 30 years to different volatility regimes. And when you enter different cycles in a very high volatility regime, which we're still at a VIX kind of above 20, that's typically pretty bad for stocks. Over a 30-year period, a volatility regime kind of in the medium to high range gives you an average market year of about down 10%.
Love getting those historical references, and you both brought them today. Thank you for kicking off the hour with us, Amy and Mike. As we head to a quick break, here is a look at our roadmap for the rest of the hour, including cryptocurrencies bouncing back, Bitcoin notching its highest level since early January.
Plus, President Biden is expected to propose a new billionaire minimum tax, but it may be more of a marketing effort than effective policy. We'll explain.
And we'll get a live report from China as the country's largest city, Shanghai, begins this 2-stage lockdown today as more squawk on the street is straight ahead. China is shutting down Shanghai in 2 phases to control COVID. Our Eunice Yoon has the latest this morning. Hi, Eunice.
Hey, Carl. Well, Shanghai's 2-stage lockdown is meant to test the entire 26 million population in Shanghai for COVID over the next 4 days. So from today until Friday, the east side of the city is going to stay shut, and then the west side is going to be restricted until the following Tuesday. So in the lockdown areas, residents are going to be required to stay in their homes unless they have medical reasons to leave or essential work. Public transport and ride hailing is suspended. Non-essential companies and factories are also going to remain closed. Some exceptions for those that have set up a closed-loop system. Tesla has reportedly halted production for 4 days. Shanghai Disneyland remains closed. And the phased lockdown really comes at a time when Shanghai had been insisting, up until the weekend actually, that they would not go into lockdown because of the importance of the city as a financial and global trade hub. The officials have said that they are going to prioritize cargo trade in order to try to minimize some of the economic costs, as President Xi Jinping has mandated. The port, the airport, rail lines will stay normal. Highways are going to stay open with COVID tests required. Those traveling out, the stock exchange won't be affected. Authorities say that infections just got too large scale for them to stick with their original plan, which was has been rolling mini lockdowns around the city. The city reported 50 new cases and 3,440 asymptomatic cases. Morgan?
Eunice Yoon, thank you for bringing us the latest. As we head to a break, Credit Suisse is underperforming today as the House Oversight Committee probes the bank's compliance with Russian sanctions. That's according to Dow Jones. Shares are down about 2.5% right now. There's a lot more squawk in the street straight ahead, so stay with us as it's a mixed picture for the major averages. Welcome back. It's now time for our ETF Spotlight. Our Seema Modi is looking at Brazil and Latin America outperforming other major global indices. Can the rally last? Hi, Seema.
Hey, Morgan, that's right. So if you look at the performance of last week, emerging markets saw $3.5 billion in inflows last week, led by Brazil and Latin America. If you look at the U.S.-listed EWZ ETF, it's now up over 30% this year, outpacing the gains of nearly every global market as fund managers continue to move money out of Russia. For context, the S&P is down about 5% this year. And even with this year's gains, strategists at Bank of America Merrill Lynch write that Brazil's valuation is still at an all-time low following last year's horrible performance, price to earnings ratio of around 7.5 times. They say Latin America is, quote, ripe for outperformance. Also adding that rate hikes in Brazil are peaking, whereas here in the U.S., we're just getting started. Inflation risks, though, are adding up. JP Morgan revising its forecast for Brazil to now around 7% for this year. The country is also the top producer of sugar, soybeans, coffee, and does rely heavily on Russia for fertilizer. Dwindling supply and, of course, higher prices could pressure its exports. But for now, David, the market is overlooking that concern.
Seema, thank you. Seema Modi. As we head to break, keep an eye on shares of HP. It is buying communications technology company Poly. It's a company that will help people work from home and or from the office in terms of connecting with colleagues who are not in the office. It is a bet on the growth of hybrid work in many ways. You can see the stock not responding positively right now. Poly's revenue growth last year was not particularly strong, about 4%, but HP says it believes it can garner as much as a 15% compounded annual growth rate from the company due to synergies, due to its ability to improve supply chain issues the company has been dealing with as well. Paying $40 a share, all cash. We're back after this.
I'm Frank Collin. Here's your CNBC News update at this hour. With another round of talks with Russia scheduled for tomorrow, Ukraine's leader says he is prepared to talk about concessions to end the war, quote, without delay. In a video call with Russian journalists, Vladimir Zelensky said, quote, security guarantees and neutrality, non-nuclear status of our state, we are ready to go for it. But he said Ukraine will not give up its territorial integrity. Russia continues its assault on eastern Ukraine amid fears in the West that Moscow is trying to divide the country. In this video, teachers, parents, and some of the older students, they worked to clear rubble after a school was hit by a missile. One former student told Reuters, "Let everyone see, let no one say it is fake news." And the G7 nations will not use rubles to pay for Russian natural gas. After a video call with the group's energy ministers, a German official said they all agree it is, quote, unilateral and a clear breach of existing contracts. Russia has demanded that what it calls unfriendly countries use its currency for energy payments. That's the very latest. David, back over to you.
Okay, thank you, Frank. Well, President Biden is expected to propose a new minimum tax plan that would largely target billionaires when he unveils his 2023 budget. Our Robert Frank has that for us. Robert.
Good morning, David. Well, it is being called the Billionaire Minimum Income Tax, but it actually applies to households worth $100 million or more. That's roughly the top 20,000 households or the top 0.01%. It would impose a minimum 20% tax rates on all income and unrealized capital gains. That's the big change here. So that's a stock or business that has appreciated but has not actually been sold or realized. Now, taxpayers would have 10 years to pay that first one-time payment for lifetime gains. They would then be taxed on the annual change in value going forward. This creates a longer-term payment stream. So if a stock goes down, they can apply that credit to their future payments. Now, let's take Mark Zuckerberg as an example of how this would work. For 2021, he would owe $25 billion as a one-time tax. Going forward, he would only pay for the annual change. This year, he's down $41 billion, so he would get a tax credit of about $8 billion, leaving him with a $17 billion balance with the IRS. Now, if he ever sold his stock, these tax payments would be credited toward his eventual capital gains tax. Now, the rule on illiquid assets and private companies still being hashed out, but they would also be subject to this tax. The White House says the plan would raise about $300 billion over 10 years. About half of the revenue, though, would come from America's 720 billionaires. David?
And then they can give us back our SALT tax deduction? No, just kidding, Robert. How is it workable with a private company? How are you supposed to actually value a private company in an effective manner?
Yeah, and the reason that's such an important question is because if you look at that group, $100 million or more in net worth, most of those families get their wealth from private companies. And we're still awaiting the details of that. But basically, my understanding is they would be required to pay that first lifetime payment on the total value of the appreciated asset. But then going forward, they would not be required to do it every year. They would pay some kind of interest payment to the government based on some complicated calculations. So they wouldn't get off scot-free. And then they would eventually pay the tax in full when it was sold or it was passed on to heirs. So that is the big question in this, is how you would treat illiquid assets on an annual basis, because like you say, it's almost impossible to value a private company on an annual basis or that change.
This is a tricky one. We're going to have to see how it evolves. Robert Frank, thank you. Sound like a little salt in the wound there. Today, President Biden will unveil his latest budget proposal for fiscal 2023, as we just mentioned, amid war in Ukraine. The request for military spending, which will map out the administration's priorities for the next 5 years, that is seen as the next big catalyst for defense and space stocks. Here's what we're expecting. And as has been reported elsewhere, White House expected to seek $813 billion for the overall national security budget, including $773 billion for the Pentagon. That would be 4% greater than the 2022 fiscal budget that was just signed into law earlier this month, significantly more than what the White House had projected for 2023 just a year ago. Now, the proposed budget, which analysts already believe Congress will boost, crafted as Russia was preparing to invade Ukraine, but also with the longer-term, quote-unquote, pacing threat of China in mind. What's anticipated? Though we won't actually know the details until this afternoon, more money for R&D, which is a forward indicator of future investment for defense contractors, more money for procurement or purchases of existing and new systems. In focus for analysts, nuclear modernization, so B-21 bomber, the ICBM replacement program, the Columbia-class submarines, missile defense and space-based deterrent systems, hypersonic missiles, Army's next-gen helicopter plans, unmanned systems and drones. Also, how many F-35 fighter jets the Air Force and Navy will buy, because that's reportedly expected to decline. Among the names to watch, Northrop Grumman, Lockheed Martin, Raytheon, Boeing, Textron, Huntington Ingalls, and General Dynamics, to name a few. All of those names largely under pressure ahead of these details today. But keep in mind, we've seen a pretty strong run since the start of the year, outperforming the S&P. Key question, though, how the Pentagon will account for inflation and whether that top-line increase can actually counter rapidly rising costs, which, Carl, is perhaps the reason why so many experts expect that lawmakers will ultimately boost this budget before the year is out.
Yeah, not to mention other governments like Canada making some comments just now about Northrop. Interesting stuff. We're in different days, Morgan, no question about it. As we go to break, take a look at cryptos rallying here. Bitcoin, a few moments ago, gets above 48K. That's not only the going green for the year, but above the 200-day at moving average for the first time this year. We're back in a moment. Welcome back. The House is set to vote on a federal marijuana legalization bill in the coming days. Tilray jumping more than 20% in each of the last two sessions. But this morning, the sector is largely lower. And despite the gains to end last week, many cannabis names are down more than 50% over the last 12 months. Joining us this morning, Ben Kovler is the CEO of Green Thumb Industries. Company operates 17 marijuana manufacturing facilities across the country and has a retail presence in 15 markets. Ben, good to have you. Thanks for the time today.
Hello. Thanks for having me.
The prospect of a bill, at least in the House, got a lot of people excited, but it was inevitably met with the response that where does it land in the Senate? Do you have expectations of this going anywhere?
Well, I think it's important we zoom out and see what's going on. There's a lot of misconception on what's happening with America versus Canada, the federal government versus the states. I think it's very clear change is coming to America. Americans want change. Opioids are killing people. Alcohol is killing people. How that's going to exactly happen at the federal level is pretty unclear. What is clear is the federal government's a trailing indicator. And on the ground in America, where U.S. operators have a moat around our business, there's a monstrous opportunity. So you mentioned Tilray in the opening. It's really irrelevant to what's happening in the U.S. right now with branded consumer products and the end of prohibition.
Right. Do you think it matters necessarily what federal law looks like? Do we have enough momentum, and are we at a tipping point on a state level where that can be enough?
What's happening at the state level has already tipped. So in 2021, you had Connecticut, New York, New Jersey, and Virginia all legalized, none of which day one has occurred. New Jersey, big state where you guys are very often, day one of prohibition ending is going to come in the next 60 or 90 days. We're very excited for that. What happens in DC, again, is a little bit irrelevant. What's important for us in the country is how we set up this new industry, who's a participant, and where the new wealth is going to be created, and who takes part of that.
All right, so it is important. What's going to happen if, in fact, you finally do get what you've been hoping for years now in terms of legalization federally?
Well, I mean, monstrous upside optionality for the equity, right? It's difficult to buy U.S. operators, right? MSOS is the ETF that's easily accessible. So for investors, we think the equity prices go up effectively. But what's important is access to capital and people participating in the industry that have been hurt by the war on drugs. So this is the black and brown community that is in jail. There are still 40,000 people in jail. So as things progress, what we've been hoping for is to get the people out of jail, to your question. But there's a lot that has to happen. It's not an easy path.
So, Ben, it's Morgan. If we were to see decriminalization finally on the federal level, does that actually help to counter or even potentially stamp out the black market, which has continued to be a pretty formidable competitor, at least in certain states, because of the regulations and because of the taxes and because of the limitations on the legal market that we've seen?
Yeah, I think those two things are somewhat disconnected, right? You see the legal market at $25 billion on its way to 80 or 100 billion. Federal decriminalization, there's 40,000 people, like I mentioned. We think about 4,000 of those people are federal prisoners that the president, in one motion could get them out of jail. That federal decriminalization, get him out of jail, whether it's that or another motion, that's what we're focused on. And then who gets to create new wealth in the new industry is important. That should happen at the state level. We're seeing some difficulty in Illinois, and hopefully New York, New Jersey, Connecticut will be a role model for what's going to happen going forward.
Hey, finally, Ben, separate from whatever may happen with law, how would you grade the industry in learning lessons, getting better efficiencies out of pricing and inventory and licensing, even with all the handcuffs around banking, for example? Are we getting to a point where they can, once it's legal in a state, run it better than they did before?
100%. But I think when you say the industry, I think there's massive misconception again on the industry. The Canadian cannabis markets and LPs are not the U.S. branded cannabis operations that are thriving, that are hiring people. Listen, states need taxes, they need jobs, and we need to employ people and create a new economic stimulus through this industry. And guess what? Americans are in favor of it. More than 2/3 of the U.S. thinks recreational cannabis is a good thing. So there's plenty of opportunity. We think it's the next great American growth story because American consumers are choosing cannabis for well-being. It's pretty awesome to watch. We invite you to the store here. There's an on-prem consumption experience here, et cetera. But it's a big upside.
Well, our eyes are going to be peeled on the Hill next coming days. See if this moves, Ben. Maybe we'll talk later. Appreciate it, Ben Kovler.
Yeah, thanks for having me.
Later today on Tech Check, we're going to talk more Tesla with Morgan Stanley's head of global auto research, Adam Jonas, who's been pretty active in writing his notes about the industry at large in the last few days. That's coming up at 11 a.m. Be right back.
Welcome back to Squawk on the Street. The pandemic led to a few realignments in the labor force, from reassessment to resignation and now organization. Our Kate Rogers has that story, and she joins me now here at CNBC HQ. It's so great to have you on set, Kate.
So nice to see you, Morgan. Great to be here. High-profile union drives and strikes are underway at a handful of companies, from Starbucks to REI and Amazon, where votes are being cast and counted at company warehouses in Bessemer, Alabama, and Staten Island, New York. Workers are deciding to use their power to push for better pay and working conditions. Several of the drives are being driven by young people. Starbucks Workers United says the charge is being led by baristas in their 20s, and some workers that I've spoken to tell me that this push is important even though they don't plan to stay in the job forever. The challenge is twofold for private sector retail and restaurants in particular. Workers tend not to stay in these jobs long enough to see some of these fights and contract negotiations through, and getting an actual contract can be a challenge, as companies do have to bargain in good faith, but agreeing to that contract is a different story. For companies, it's also a really delicate dance between keeping shareholders and workers happy.
I think that the calculus that a company has to make on this, in this context, where you could be more aggressive, increase the probability of winning the election, and damage your brand. How do you think about that if all you're thinking about is, let's say, keeping your shareholders happy? It's not an easy needle to thread there, right? Because, the more aggressive you are, more likely you're probably going to win.
Now, in 2021, the union membership rate overall was 10.3%. That's down from 10.8% in 2020, which was due in part to a big decrease in non-union workers tied to the pandemic. In the public sector, the rate is 5 times higher than the private sector at 33.9% versus 6.1%, even as these fights spread and feel like everyone's unionizing, right? When you look at the actual numbers, particularly for restaurants, retail, private sector, very, very low.
Yeah, which of course has been kind of the counter argument to the risks that are being seen, and some economists are talking about where a wage price spiral could be concerned. I'm curious though, when you're talking about a Starbucks or you're talking about an Amazon, I mean, how many people are actually voting to unionize? Because I imagine it looks very different across these different businesses, especially when you take into account churn, which you talked about.
Yeah, so like we said, some of these can have very high turnover. I talked to one organizer at the Bessemer warehouse for Amazon in Alabama. He said there's about 6,000 votes that are expected to be cast, which is huge, so that count will take all week. Some of these Starbucks NLRB hearings are done in like 30 or 40 minutes because the stores have under 20 workers. Starbucks' hometown of Seattle that just unionized, which was a big win for the union, had 9 workers. They voted unanimously to unionize, but it was just 9. So smaller footprint there, smaller amount of workers, potentially easier to get everyone on the same page in those stores. It's spreading across the country very quickly, but it's important to keep in mind how many people are actually voting. And that's something that I think investors are watching too.
Yeah, I mean, it's important context. If some of these employees are not expecting to be there by the time their unionization efforts actually manifest, why are they doing it?
It's so interesting, Morgan, in talking to young workers at all 3 of those companies, it seems like there's a collective groupthink about improving things and making things better for everyone, not just for yourself in your current position, but for years to come. If you get a good contract and that's something that the union can hang on to, even if that worker decides to move on, that's good for everyone, right? So these younger workers, baristas in their 20s, they're thinking about everyone else much more than just themselves, it seems, in talking to some of them.
It's very fascinating. You've been covering the story very closely for a while. It's great to have you here on set.
Thank you. Great to be here.
Kate Rogers. Well, now let's get over to Dom Chu for a sector sort. Hi, Dom.
Hey, so Morgan, stocks are mixed at this hour, but we are tracking particular weakness in certain parts of the market, and some sectors in particular more vulnerable to the volatility in the commodity complex and those markets, including energy and materials, metals, that sort of thing. Now, within that energy trade, it is names like Halliburton and then APA Corporation, also Baker Hughes, that are firmly right now in negative territory as oil prices slide today. That comes as those oil prices drop on demand concerns related to these stricter COVID lockdowns that are happening around Shanghai, China. Over in the material side of things, the metal and mining companies like Freeport-McMoRan, also Nucor, steel side of things, among some of the worst performers, as you can see here, alongside fertilizer players that have seen a lot of strength recently. Mosaic, CF Industries in particular. If you watch some of those names, keep an eye on some of the reversals that we may be seeing right now. Keep it right here. Squawk on the Street. We'll be right back after this break. Don't go anywhere.
we're going to continue to bring the old company back. But yes, I think we're going to be doing interesting, exciting things to grow AMC, to transform AMC, to find attractive investment opportunities so that we make sure that we do grow into that valuation that's out there on Wall Street every day.
That was AMC CEO Adam Aron joined us last hour. You can see shares of AMC are having a very strong run. Of course, reiterating the company would do more what he calls transformational deals following that investment in the gold and silver mine operator Hycroft. Fascinating that he does now believe this is a core competency of AMC, not necessarily just running movie theaters, but using its army of apes to provide capital to companies that he may identify that are capital starved, but with that new capital can quickly change their fortunes. That at least is what he says is the case, Morgan, with Hycroft. And, well, the memesters seem to buy it.
Yeah, I mean, it is. It's really fascinating. It's like it's the spread of the meme theme, if you will, being led by Adam Aron and AMC, and we're seeing it with shares up almost 18% right now. Meantime, satellite as a service company, Terran Orbital, completing its SPAC merger with Tailwind 2 Acquisition Corp, listing on the New York Stock Exchange this morning. The company, which counts NASA and Lockheed Martin as customers, among others, has seen its tech in high demand as geopolitical tensions increase in Europe. So joining us now from the New York Stock Exchange is co-founder, chairman, and CEO Mark Bell. Mark, congrats on going public today. And I do want to get into the specifics of the company, but first, just from a geopolitical standpoint, given everything we're seeing play out on the ground with Russia's invasion of Ukraine, the fact that it has put a lot more attention on intelligence work and data coming from space and satellite constellations, how are you positioned within that? How are you able to, with Terran Orbital, help glean that information, and what kind of growth opportunity does it present?
You know, unfortunately, this tragedy in Europe has brought a lot of attention to what we do for our customers. We build solutions to help image the Earth, both at day and at night. We've been providing Ukraine with information to help save civilian lives, imaging what's going on there in real time and providing them real-time data. And we're seeing a lot of interest from both the commercial and the military sectors in the products that we offer, things like electro-optical imaging, which is taking pictures of the Earth, or synthetic aperture radar, which is where we can image the Earth at night or when it's cloudy out.
Yeah. How do you keep those assets safe in space? And I ask that as I've had conversations with senior officials from the Space Force and the Air Force more broadly who talk about this need for a more resilient architecture and the role that commercial space can play in that.
You know, General Hayden talks about these big, juicy targets in orbit. What we do is most of our satellites are in low Earth orbit, so we're moving at about 6 kilometers a second around the Earth. So we're about 2.5 times faster than a hypersonic missile. So we're pretty hard to catch, and we build them in quantity. So we build what's called constellations of many satellites. So if one goes down, we have many more to take its place.
Understood. We were expecting this Biden 2023, fiscal 2023 budget in just a short while. And the expectation is that we are going to see increased proposals for defense spending as well as civil space spending. What are you looking for, and what kind of opportunity does that mean for Terran Orbital?
You know, the opportunity for us has been huge. I mean, we're building the SDA's transport layer, which is their communications layer of the future, to help other satellites communicate with Earth in a real-time fashion. We're seeing opportunities across the board through the DoD and the IC community of all different kinds of payloads, because we're what's called payload agnostic. We build everything from electro-optical to SAR to infrared, hyperspectral, whatever the customer requires, we help solve the problems from space. And with this new budget, we see lots of opportunities to provide more assets in space to help keep our nation safe.
Mark, it's David. Just a question on your balance sheet as you start life as a public company. You know, I see back in October there was $345 million cash in trust in Tailwind 2, but you only took in $29.4 million. So I would assume redemptions were very high. So you start life with $100 million in equity, or cash on hand, I should say, but debt of $175 million. Is that a result of the fact that the necessary money you needed had to come in the form of debt because the redemptions were so high in the SPAC?
Well, in addition to the $29 million we got from the SPAC, we also had a $51 million pipe.
Right.
So we took in about $80 million of equity into the company, and we wanted access to the public markets going forward. As we are building lots more factories, we announced one recently. We've gone from, call it, 50,000 square feet of space to 250,000 square feet of space and climbing. We announced a new project in Florida. We're going to be building the world's largest satellite assembly facility with the state of Florida putting up $300 million for that. It's a 660,000 square foot facility where we're able to produce over 1,000 satellites a year.
Right, but my question was, are you starting life with more debt than you had originally anticipated? And does that in any way hinder your ability to grow?
No, it doesn't hinder our ability at all. We knew it was going to be a rough SPAC market, but if we had tried to do an IPO in this market, it wouldn't have happened. And so we made a conscious decision to use a SPAC because it guaranteed us access to the markets to the end of the day. And we're highly confident about our business plan going forward. We announced even today we've hit over $200 million of backlog that we're building.
So quickly, Mark, does that mean that you're still on track to be profitable on an adjusted EBITDA basis by next year?
We are working towards that goal.
Okay. Well, we appreciate you joining us today. And I do have to point out LLAP is the ticker here. Live long and prosper, which is the Vulcan greeting for Star Trek, and certainly an unusual one. We appreciate you joining us. Terran Orbital CEO and co-founder Mark Bell. David, just getting a check on the markets here. I mean, it's a pretty quiet day, dare I say, or start to the week for the markets, with the S&P just barely positive. 45.49 is the level there. The Nasdaq is the outperformer as tech stocks move higher.
All right, and with that, we'll end our show and get over to Tech Check, which starts now.
Happy Monday. Welcome to Tech Check. I'm John Fort with Carl Quintanilla and Deirdre Bosa. Today, Tesla's tear higher with shares back above 1,000 a share and reports of a potential stock split. We've got Morgan Stanley's Adam Jonas to break down the space. Plus, the slap felt round the world, what Apple's Best Picture win could mean for streamers and the stock, and social media's growing role. And finally, cybersecurity companies and risks in focus with the conflict in Ukraine. We will talk outlook for the sector with the CEO of Cloudflare this hour. Dee?
First, breaking news from Washington. Crossing right now, President Biden unveiling his budget proposal for 2023, and Elon Moy's got those details for us. Elon.
Good morning, Deirdre. President Biden's budget includes $2.5 trillion in new taxes over the decade, targeted at corporations and the wealthy. His plan would raise the corporate tax rate to 28%, tighten international tax rules, repeal key tax breaks for the oil and gas industry, increase the top individual rate to 39.6%, close the carried interest loophole, and end the benefit for like-kind exchanges. There's also, of course, a new 20% minimum tax on those worth $100 million or more that covers both regular income and unrealized gains. Now, that revenue will help pay for investments in K-12 education and college affordability, public health, housing, and combating crime. It also allows the administration to reduce the deficit by more than $1 trillion over the next decade. But the White House is also setting money aside for another go at a Democrats-only tax and spending bill that would focus on cutting costs for households and expanding the productive capacity of the economy. Now, that could be funded with separate proposals like taxing stock buybacks or a millionaire surtax that passed the House last year. Now, if the White House budget were to pass, the administration estimates GDP would grow 7.6% this year and 5% next year before settling around 4% for the rest of the decade. The unemployment rate would dip to 3.6% next year and hover around 3.8% in the long run. The White House also projected inflation would end up at just 4.7% this year, then moderate to 2.3% in the following years. Now, if that sounds kind of rosy, the administration did caution that the forecast was made in the fall before the crisis in Ukraine. Officials acknowledge that is likely to keep energy and food prices higher for longer. But overall, guys, the White House said that fiscal responsibility is one of the key priorities in their budget. Back to you.
All right, a lot of moving pieces there, Elon. We're going to count on you to keep us honest. That's our Elon Moy in Washington. Meantime, we'll start today's feed with Tesla. Shares, as you know by now, up 35% in just 2 weeks. And the news today, the company is proposing a 5-for-1 split. COVID lockdowns in China are pausing production at the company's Shanghai factory for at least 4 days. Elon Musk tweets he now has COVID. And on top of that, reporting that Musk is at war with the SEC and NHTSA. A racial discrimination lawsuit is moving forward against the company on behalf of more than 4,000 current and former employees. Is that all enough to keep track of? Let's bring in Adam Jonas, Morgan Stanley's head of global auto research. Adam, welcome back. Always good to check in with you.
Yeah.
Hey, Carl, thanks for having us.
Your overall point in your writings last few weeks has been Tesla's a must-own, but you continue to warn about dealers especially who you think are beginning to tamper with the consumer's ability to keep up with prices. How can both things be true?
Well, it's interesting when Elon Musk and Tesla went state by state to try to get the ability to go direct to consumer. At the time, a lot of folks, including a lot of dealers, thought Tesla, they're just, a fly. They'll go away over time. You'll see. They didn't count on this being $1 trillion company and one of the most deterministic tech firms in the world. So now we have a little problem where there's two classes of car companies that can go direct, where, Tesla and some of the new startups can stack retail and have a more frictionless experience, whereas the legacy folks are kind of prevented from
yield curves that are getting close to inversion territory, 2-year yield spread versus the 10-year 3-month, which is a little bit more reliable as it pertains to timing with recessions in general. But given all of those factors and the fact that consumer confidence has sunk like a stone, particularly if you're looking at a metric like the University of Michigan, we just have to start dusting off the playbook and see, what is it typically, what are the dominoes that have to fall for us to get into a recessionary environment? I think the timing is always tough. Nobody can accurately predict when we're going to get one. But, enough of a slowing in activity, such as we've seen in some of the metrics that are key, especially those that are leading in nature, it just warrants a little bit of a look back at history and, what might suggest that we get closer to the end of the business cycle. But all that being said, this is a really tough cycle to assess. It always has been since the onset of the pandemic. So I don't think that we can perfectly apply what's been, what's played out in history and use that as a, prognostication moving forward.
Right, overall. And so with this jobs report on Friday, tell me what the expectations are. There's always the whisper numbers and then there's reality.
Yeah, I think, it's probably good. The expectation, at least, is for it to be pretty strong. And for us in particular, we've been really hyper-focused on metrics, more of the sub-metrics like labor force participation. And even when you get within that rate and you break it down, looking at the age cohorts and then among gender, just to make sure that it's broad-based and that enough people are coming back into the labor force. You don't have sort of the Great Resignation theme holding anymore. So that's going to be a pretty big focus for us. And then other metrics like the unemployment rate, which even though it is among the most lagging economic indicators and, broadly, it's certainly the most lagging labor market indicator. We want to, see if there's any movement there. And then in conjunction with earnings, too. A metric like average hourly earnings is getting a little bit easier to assess as we move off of the base effect era of the pandemic. We're no longer being skewed as much by, the areas like leisure, hospitality, and retail that were, excluded from the workforce. They have now started to come back in. So we can get a little bit of a better sense of what actual wage growth looks like in the face of higher inflation. But as I mentioned at the opening of the show, the labor component for the Fed has, at this point largely been satisfied. So it would probably take a pretty dismal report, either at the headline payroll level or even an uptick in the unemployment rate for them to sort of reassess what they, have mapped out moving forward, at least in the near term as it pertains to rate hikes.
Right, and as investors have been seeing some growth, at least in their portfolios, with 2 weeks of gains for the S&P, NASDAQ, and the Dow, you are with some concern about the recent rally, whether or not it really truly has legs, and growth investing versus, value investing or looking for dividends, plays that might be a little safer.
Yeah, it hasn't been the healthiest rally. A lot of it has been a mix of short covering and then areas that got hit really hard in the initial, drop phase. So the high volatility, high beta, high momentum areas, those have been leading the market higher. And, for us at least, we'd like to see broader participation, especially among high quality areas. Because if you look back historically, I know we can't apply it perfectly, but when we go into tightening cycles, when we get later into the business cycle, closer to the end than we are to the beginning or the middle, high quality just outperforms. That's just the case, especially when you get into a tighter financial condition scenario or environment. So that's been our call that we've liked to stick with, because over the past 6 months or even year to date, that's still been the area of consistent leadership. And you were talking about sort of yield plays or defensive areas in nature. An area that's actually done pretty well recently is utilities. So the utilities index itself within the S&P 500 has hit an all-time high. Going back to 1990, that's when we have the data. But if you look at the sector's expense on a forward PE basis, it's more expensive than the S&P 500. So it's defensive, and even though it lives in value indices like Russell 1000 value or Russell 2000 value, you're still paying a lot more than you would be for the broader market. So that's why we don't like to just put blinders on and look at one sector and say there's where you find defense in an environment when the market's just more highly volatile. You want to be sort of broadening that out and look for high quality across sectors.
Yeah. And you know what else I was thinking about just now is how we've had this correction in oil, right? Whereas we're seeing this pullback in oil for several reasons. And that might be at least a bit of a relief. But on the other side of the coin, we've seen yields moving higher, right? So you have the 10-year Treasury at 2.5%. So what are your thoughts on some of these push-pull events?
Well, I think between the three, if you just look at stocks, bonds, commodities, that's enough to sort of put your, have you to put on a neck brace because of not just the volatility in the commodity space itself. Maybe just excluding that. If you just look at stocks and bonds, they become much more tightly correlated from a price perspective. So this quarter, when you look at the drawdown for the S&P 500, if you want to use that as the proxy for the equity market, and then just the maybe aggregate U.S. bond market, they've both been decisively weak. And that's our concern if this does become more protracted, and if we are entering an environment where we're a little bit more prone to supply shocks than demand shocks, much like was the case in the 70s and the 80s, not saying that we return to a stagflation environment, but if we get back into a scenario when stock prices and bond yields are negatively correlated, that means that rising yields, that environment of rising yields will be more negative for equity prices. And so, in an environment also with, the commodity aspect, when you have oil prices staying elevated, but also moving up, whether it's to the upside or the downside in double-digit fashion over the past, on a rolling 5-day period basis, which is what we've been seeing, that's enough to sort of, keep investors sort of spinning around and looking for areas to hide in. And that's why, back to the factor approach, that's why it's worked so well. That's why you've found consistency there. So I think between those three asset classes and all the volatility that we've seen, if it doesn't die down, then you want to keep that factor-based approach.
Good to see you, Kevin. Thank you so much.
Thanks, Nicole.
Kevin Gordon, Senior Investment Research Manager at Charles Schwab. Thanks for being with us. Plenty more to come right here on Trading 360, live from the New York Stock Exchange. NYSE Senior Market Strategist Michael Renking will be with us and join us right here on the floor. We'll have a discussion on the market action, rising yields, recapping earnings season, and much more. And Roku is today's disruptor. Tom White will join us with all the details and a way to trade it as well. And later, a quick look here at those travel stocks, our 360 round. Our panel is ready to look at names such as Booking and Expedia. But up next, it's the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein goes through the technicals. Scott Nations from Nations Indexes takes us through the trades for Deere, Exxon Mobil, and Netflix. Next, here on Trading 360, live from the NYSE.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network. Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position?
You two are all set.
Choose the app that fits your investing style.
Welcome back to Trading 360. I'm Nicole Petalides, live in New York City, live from the New York Stock Exchange. Thanks for being with us. It's time for the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein will take us through the charts. Here to take us through the trades is Scott Nations, president at Nations Indexes. Scott, I'm glad you're here with us. You've been talking about Deere for some time. You know, it's been a winner, and you're talking about how to add to a winner, right? Tell us more, Scott.
That's right, Nicole. Last time I was on, I suggested buying Deere because while we are all rightly worried about inflation, Deere is just the poster child for those companies that love inflation. So farmers are in great shape. Crop prices are at all-time highs. They're going to put even more land into production. They're going to put marginal land in production. What's that mean for Deere? It means that farmers have lots of money. They have reason to spend it. They're going to be able to spend it. And as I said, that's wonderful for Deere. So last time I was on, I suggested buying it when it was in the 380 range. And Nicole, now I want to do something that a lot of traders don't do, and it's really tough to do well, and that's add to a winner. So I want to add to my position in Deere. I would buy a half a unit. Anytime I could buy it below, say, $430 a share. So it needs to come, as you can see, it needs to come in at least another $2. But at that level, I would be happy to add to a winner. I think I'd be adding to it really well. And I think Deere is going to continue to do incredibly well, given everything we see as regarding inflation.
Yeah. And Ben, what do you think as you take a look at this chart? I mean, Scott made the point that he did pick this one some time ago, and it's continuing its run higher. Your thoughts on the chart, Ben?
You know, guys, good morning. I remember specifically the day that we looked at this chart and some of the levels I was talking about. So again, Scott, I was happy to revisit this one. And if I remember correctly, at the time, I had mentioned how we were starting to see a little bit of a bid come back into play, which was encouraging for the bulls. And I mentioned how 320 was a key level. I thought 350 was going to be key as well. We wanted to hold that support. And here I want to show you we didn't hold 350 as earnings came out. Again, we're talking about middle of February. We started to see some weakness down to the 320 level, but then again recovered nicely. We spent a very limited amount of time down here. And in fact, this turned out to be a bit of a V bottom. So we always talk about how, again, you're seeing new levels. You need to then look at the kind of a if-then situation here. If you do break out, then what should happen? In this case, we should form value or overlapping rotational price activity at a lower level. We didn't. We rejected that. And look, it's been off to the races since. Now, again, I mentioned the 350 level I thought was key, but at the time we had this double bottom which had formed around 320, and so I mentioned if we got below 350, keep an eye on that, and look, it held, and again, as mentioned, in a big way. We've now got price activity above the 50-day moving average, this blue line, back above the 200. RSI a little overextended, so I like in terms of what Scott was talking about as far as a pullback to the 430 level, ultimately, because that is a bit of a lower extreme of a range that we're kind of in right now as we now accept this new area of value at upper level. I do want to point out, year to date, this stock's almost up 26%. I mentioned RSI a little bit overdone. We have seen some volume come into play here now. Take a look at this chart, the weekly, because what I'm wondering, Scott, and you might know a little bit better in terms of your familiarity with this stock, but as far as my familiarity with price activity, I'm sort of looking at this range right now that we're breaking out of to the upside, almost like what we saw back in, well, we're talking the end of the summer and into the end of 2019 and throughout the beginning of 2020 prior to that breakout up. Look, we've got a vertical move up, higher highs and higher lows. We saw the same thing back in beginning of August of 2020. And again, you can see how well in this instance, we didn't really slow down and we didn't find a stopping price till we're talking the fall of that year where we've kind of consolidated around 250. I guess what I'm wondering is if this is a similar situation that's starting to stack up here. I think investors should be looking for higher highs and higher lows, energy, follow through, directional conviction to the upside here. And then again, we want to at some point see a new area of value form at this higher level. We don't want to see a V-top type pattern rejection of this and kind of work our way back into that range that we just broke out of. We want to see acceptance of this new price activity at the upper level. Basically the opposite of what we saw as we traded back down to 320 the last time.
Yeah, and Scott, what do you think of that as we see that conviction, at least for this part, before we move to the next name on the list? Your final thoughts here on Deere.
Well, the last time I was on with it was within just the last few weeks. And I think that what we've seen in commodity prices, particularly what we saw in wheat futures, changes the dynamic for John Deere to a substantial degree. I noticed that, and Ben is right, we have higher highs and higher lows, but I actually think that the levels that we saw last summer for Deere are now nearly irrelevant because of what we've seen in commodity prices. That changes the paradigm for John Deere completely.
Okay, that being said, let's change what stock we're looking at. And we'll look now to your next name, and that is Exxon Mobil. Of course, we've had the jump in oil. It's since pulled back some, but you're looking at some of the other things that will be fundamentally probably some good news, such as travel, reopenings, things like that. Tell me more.
Well, and Nicole, you know, when we look at oil, we think that anything that has to do with energy is helped by higher oil prices. And for the integrated names, that's just not the case. So I'm looking at Exxon Mobil, one of the integrated energy companies. And why is that not necessarily the case? It's because when they have a retail arm, they see their retailing margins pressured when they have to, when oil prices increase. And so what often happens for the integrated names is they'll actually accept lower margin at the pump simply because they want to maintain market share. So the pullback that we've seen is actually great news for Exxon Mobil because now they're going to be able to expand margins at the pump. They're going to get a lot of money for all of the crude oil that they produce. So this is really the best sort of scenario for a company like Exxon Mobil. I would be accumulating it below $83 a share. This is a situation, Nicole, where I'd be pretty greedy with the way I executed this trade. So if I wanted to put in a bid at say 82 even and maybe another one 81 and a half, and I bought some of that, I would feel really good. I would feel really good about both my execution and my position.
Okay, so he's really looking at specific levels where to get in here. Ben, when it comes to Exxon Mobil, what are your thoughts when you take a look at this chart? What do you see?
This is a stock that I see rallying strongly into the beginning of the year, but since then it's been a bit more sideways in a wide range here and basically from 91 down to 76 now. What concerns me a little bit at this level is we're starting to roll over, and again, between 76 and 91, that's kind of in that range of the middle area of balance that I like to look for. And if we roll over here, we're kind of failing to get anything going through the middle of that range after a failed attempt at the lower extreme. So again, it's just not a lot of directional conviction here as of right now, but you can see the nice move up to begin the year, and then again, you can see this overlapping, this more rotational type price activity. We do have a well-defined upper and lower extreme to keep an eye on at this point, but let's take a step back from the hourly, take a look at the daily time frame. You can see again the well-defined trend we were just looking at here. Actually, again, this is basically the area that we were looking at from 60 up to 91. You can see that that's just a small part of the larger degree trend we've seen. We're holding above the 50-day moving average. We haven't been below the 200 days since the fall of 2020. And again, you got to go all the way back to these levels. We've tested it a couple times, but we haven't been convincingly below since the fall of 2020. And, you know, I think the weekly is really where this gets most interesting here in terms of, I always say, when in doubt, zoom out. And I'm just not seeing a lot of directional on the hourly again, or even that much on the daily. You do see that well-defined trend, but just kind of in this zone we're in right now. But, you know, we've held this range. We're now working our way into the middle of this range here. So I think this is key. Again, while we've kind of stalled out on the hourly time frame, that's a bit of a disappointment for the bulls. But if we could regain composure and now kind of work our way up through the 90-100. I think from a very strictly technical basis here, it could open up the door for some upside potential here. Obviously, I'd be watching the price of crude if I was trading Exxon and some of these other energy names. And in fact, now that I think of it, crude's kind of stalled out at these levels too, in a bit of a range after recently topping out around 130. So again, not a proxy, obviously, but a lot of contributing factors, as Scott just mentioned here. But again, I think unfortunately in this one, not as much well-defined directional conviction one way or the other as in terms of what we were just seeing, for example, as far as the move up in Deere.
Yeah, Scott, what did you think of that chart that Ben was just highlighting as he took a look at the weekly versus the longer period and the moving averages? As you talk about your entry point in those low 80s levels, what did you think about that chart?
Well, I think Ben is right, that there's not necessarily a lot of conviction right now. And that's why I think that I can be a lot more greedy when it comes to my execution here. And that is, you know, put some bids below the market. I would be much more emphatic with adding to Deere than I would buying Exxon Mobil because of for the very reasons that Ben has mentioned technically, but also fundamentally the picture for Exxon Mobil, while I think it's positive, particularly as we all start to travel again. But in the shorter term, the picture's a little bit more muddled, and so again, we can let the market come to us.
Right. Understood. And last but not least, I wanted, as we just came off the Oscars last night, Netflix got a lot of nominations, even though Apple TV took the best, the big show, right, the big win, but Netflix did well. Tell me a little bit about your final trade here, because a lot of folks, when they like FANG, they don't like Netflix necessarily, Scott. Why is that, do you think? What do you think?
You're right, Nicole. We just got off the Oscars, and streaming has finally broken through. And that makes a lot of sense to me. There's some wonderful content on the streaming services. But the problem with Netflix, Nicole, is while they are the first mover, and they have a wonderful first mover advantage, they are spending a tremendous amount of money on content creation. And it really doesn't seem to be paying off for them like it is for, say, Apple Plus. Also, Netflix is trying to raise prices while Apple Plus is about a third of the price of Netflix. And so I think Netflix is going to have a problem going forward. You see the chart there does not look particularly impressive. That said, Netflix has the potential to rally and just rip your face off if you're shorted. So I want to be short, but I want to define my risk, and the way to do that in Netflix is to buy a put spread. So specifically, I would buy the June 320, 370 put spread. You see there, when I put it together, you could buy that for about $16.50. Tiny bit more expensive right now, but that's a great way to get short exposure to Netflix, define your risk, and all we're looking for is Netflix to be below, and you see this there, be below $320 a share at that June expiration.
All right. And what do you think, Ben, as you take a look at this one? I mean, you know, as Scott noted, that chart's a tough one as you look at that drop off.
Yeah, there's been some selling here, to say the least, and under pressure, no rejection of these lower levels. In many ways, kind of the mirror image of what we talked about in terms of Deere to the upside. And I'd like to begin with the hourly time frame. I think there's a couple things to take note of here. First and foremost, the well-defined trend to the downside. You can see that again, top left corner to bottom right corner. You can see, again, a couple well-defined areas of consolidation separated by this vertical development, and most well-defined probably the selling we saw in reaction to quarterly results. Again, we're talking going back to the end of January, and since then how we've just kind of been in this sideways consolidation, recently into a new low, but limited in terms of follow-through. So we've got a well-defined upper and lower extreme to keep an eye on right now, 460 down to the 329 level. But again, you know, what concerns me is that we're kind of back to the midpoint of this range that we're in right now. Again, 460 down to the 329 level, and we're starting to roll over just a little bit. Further weakness here could potentially open up a door for a retest of these lower levels, and it's just continuation of the trend that we've seen. Now, again, we talk about, and much like Deere to the upside, if we get a breakout below here right now, it's not as significant just to see the levels taken out as it is to see a new area of value form at a lower level. And I think that's what's kind of playing out here as you take a look at Netflix off the recent all-time highs around that 701 level. You can see kind of value forming at lower levels, and in this case, one right here below the 200-day moving average. I'm sorry, below the 50-day, well below the 200-day moving average. And then even look at RSI as we kind of stall out at that key area, as I mentioned on the 60. RSI is kind of starting to roll over here as well. And then, you know, I wanted to point out on the weekly, we always talk about, again, these two phases of price development, again, the horizontal or the vertical. Netflix broke out in a big way, just like Deere is trying to do. Remember, we talked about higher highs and higher lows and how we want to see an area of consolidation form at a higher level. In this case, it didn't really. We got more of a V-type top pattern. We spent very little time up at 700, got rejected essentially, and then like a hot knife through butter, you can see how we just ripped lower, again, right back into this 350 level. Tough to buy into this here right now. At the very least, maybe forming a little bottom here right now at this point. But yeah, it's been under pressure here to say the least as we've come off 700 back down to this 350 level, basically giving back half.
All right, gentlemen, thank you. What a great big three today. Appreciate it. Scott Nations of Nations Indexes. Finn Lichtenstein, thank you. Always looking at the charts with the big three of Deere, Exxon, and Netflix. Thank you both. Coming up next, New York Stock Exchange senior market strategist Michael Ranking will join me right here. We have plenty to discuss. Of course, the moves in the market, rising yields, earnings, and much more. Trading 360 continues live from the New York Stock Exchange.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then watch list. When the default list appears, select the name box, then create watch list. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watch list, then select save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then add to watch list. From the Scan tab, right-click a security and then add to watch list. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back. Live from the New York Stock Exchange, I'm Nicole Petalides. Take a look at the markets. You can see that the Dow is down 169 points at 34,691. The S&P just fractionally lower at this point at 45.39 after 2 weeks of gains. The Nasdaq showing some strength. They're up about 0.5% at 14,824. And the Russell small caps at 2063, pulling back about 15 points. So today for our 360 Spotlight, as I said, we are live from the New York Stock Exchange, and so it is our pleasure to bring in a special guest from the New York Stock Exchange, and that is Michael Ranking, Senior Market Strategist for the New York Stock Exchange. He's joining me live here, and we have so much to discuss. Of course, this is our very first day here, so glad to be here. Thank you for having us.
Yes, welcome to, first and foremost, welcome to the floor. We're excited to have you here. And I'm honored to be on the inaugural show with you, and hopefully this is our first conversation of many.
Of many, without a doubt. So we have lots to discuss. I mean, I think we should first just start with your wheelhouse, which is all about market strategy. At this point now, we're seeing the markets with a little bit of a rally, right? I mean, at least 2 weeks of gains.
Yes.
Now what?
Yeah. Well, it's been a very interesting environment, to say the least, right? So we've had a lot of volatility to start off 2022. We're in the midst of the deepest and most prolonged pullback that we've seen in the market since the rally started 2 years ago. And that's as investors are kind of dealing with the geopolitical concerns, other macro headwinds, inflation, and obviously the shift in global central bank policy. So we're a couple weeks away from Q1 earnings season. So I think that's going to be kind of a welcome change for the investor base as they're able to kind of focus away from the macro a little bit and back into the micro and focusing on kind of company fundamentals and the earnings power within those companies.
As we had that rally, right, from 2008 to now, it was the rally that made everybody nervous the whole time, right? It just kept climbing and climbing. They hated the rally. They were waiting for corrections. You had the pullback during the pandemic, which ended up being a great buying opportunity. But does it feel somewhat nerve-wracking now, too? Because there are so many elements. We just had a great conversation with one of our Charles Schwab guests who said that the rally just doesn't necessarily feel like it has legs.
Right. Well, there is a ton of skepticism in this rally, right? And at this point, the sentiment had gotten really, really negative. We've seen a little bit of a snapback over the last 2 weeks, right? As some of that sentiment is reset. I think the issue that the market has is that we have the Federal Reserve, which is not supportive anymore, right? I mean, they've been very clear that they're going to fight inflation, get price stability back in the marketplace. So not only are we going to see interest rates moving higher, we're also going to see QT eventually start to kick off here in the near term, right? And so that's a little bit of a headwind if you kind of think about the mantra that's worked for that past 10 years is don't fight the Fed, right? And that's kind of fighting the Fed right now.
Absolutely, absolutely.
So I think we could be interested for a period of volatility, but I think some sideways trading action in the market is not a bad thing considering the rally that we've seen over the last couple of years.
And I mean, you're certainly seeing plenty of names, and with the volatility, it gives opportunity to people who want to trade, right? You can buy low or sell high or try and get in, at least for people who want to try to day trade it. For longer investors, I mean, they're faced with higher yields at this point, right? You have the 10-year at 2.5%. And we heard from Citi now talking about the Fed rate hikes, but that the next 4 hikes will all be 50 basis points each. I mean, does that seem too much?
Yeah, I think that the hawkish sentiment's gotten a little bit ahead of itself, right? It feels sort of like when stocks are rallying, where the analyst community is always trying to catch up and raising price targets. It feels like you're seeing a little bit of that, in terms of central bank policy. I'm not sure that we actually are able, that the Federal Reserve is actually going to be able to get to, what they're talking about before something potentially breaks or you start to see the economy slow down, right? So I think, that hawkish sentiment has probably gotten a little bit ahead of itself.
What are people saying overall? I mean, do they ask you a lot of questions? Because as we approach earnings season now, which you noted, they're really telling me often that it's really going to be contingent upon the fundamentals and what we hear from earnings and guidance and such.
So, yeah, I mean, I think that's a great point. And, I think the investors need to prepare for kind of a more normalized environment, right? So a growing but slowing earnings profile, right? Last year, we saw the S&P 500 earnings growth rate was over 50%. Clearly, that's not sustainable, right? We're looking at projections now for about 9% on a year-over-year basis. And what we've started to see is, companies. We've seen the negative pre-announcements kind of outnumbering positive pre-announcements 2 to 1. We've seen estimates cut a little bit, but those are back to historical norms, right? So what we saw last year with positive earnings revisions, driving the market higher, that's not going to be there at this point. But I think that there's still the opportunity for we've seen a resilience in corporate earnings that has far exceeded estimates throughout the last year, and we've seen the economy perform much better, right, than people had thought. So I think that's still in place.
I feel like we should get out of the box a little bit, whether it's, crypto or anything else that, IPOs and all the listings and SPACs and things like that. Are there things that are also just getting your attention one way or another that people are also looking at?
Right. I mean, I think right now, the key that everybody's watching is interest rates. Like really, that's really what everybody's paying attention to. And the big conversation has been about, kind of the inversion of yield curves and where there's a lot of varying views in terms of which parts of the yield curve actually matter.
Right.
What I would say is that in terms of that we've seen recessions typically happen a year or 2 years down the road. Right. So even if you see these inversions in the near term, it doesn't mean that there's something right in front of us. And I think that last week Chair Powell really signaled that what the Federal Reserve is watching in terms of the yield curve, the very short end, the three-year
Right.
versus 10-year, the 3-month bill versus the 2 quarters out, right, or 6 quarters out, the 3-month bill futures, right. That's steepening. So they don't see a recession in the near term.
Right.
So if their viewpoint is that they don't see a recession, right, they're going to continue to move strongly.
Mm-hmm. I'm going to tell you, I'm going to ask you your favorite fun fact about the NYSE. I'll tell you mine, which will give you a second to think about yours. But mine always is that the ceiling is actually real gold leaf and has tobacco leaves on it, from the time that they used to trade tobacco here. This is an iconic building. This is, I guess arguably the financial capital of the world, and we're both so lucky to be working here each day. So what's your favorite fun fact? When somebody comes in to visit you and they say, Michael, thanks so much for having me here. I mean, what's one of your favorite fun facts that you tell them?
I just, there's so much history in this building, and, and it's always changing. And if you go upstairs and you can look in the boardroom, we have the urn, from the Bolshevik era. We have a clock, the original clocks that show, kind of where one stock was traded at a time, and there was, kind of, on a 5-minute basis. So there's just so much here to see, and it's just an amazing place to be every day.
Yeah, thanks so much for being with us today.
Absolutely.
I'm glad that you were able to join us and talk market strategy, but also really give our footprint here at the New York Stock Exchange. So thank you for the warm welcome. Michael Reinking of the NYSE, Senior Market Strategist. Thank you.
Yes, thank you very much for having me.
Thanks. Coming up next, it's the Disruptors, and we have Tom White standing by to take a look at Roku. He'll have all the details and a way to trade it next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Welcome back to Trading 360 live from the New York Stock Exchange. It's time for the Disruptors. Every single day we take a look at the Disruptors, and today's company is Roku. Tom White is here to take a look why this one is on his radar and a way to trade it as well. But first, let's start. Why is this one on the move, and why is it on your radar today?
Hey, Nicole. This is one of those stocks that, has taken the brunt of the pullback that we've seen. It's down about 75% over the last 7 or 8 months here from their all-time highs above $490 a share. So it's had a significant pullback. Now, what is Roku? Well, they disrupted everything. We have subscriptions to multitudes of streaming services, right? And the one company that kind of congregates them all into one platform is Roku. And the ability to have connected TVs where you can aggregate all your different streaming services on one platform. The growth has been astronomical over the last 4 years. Roku had about 19 million active accounts in 2017. Now they've tripled that to about just over 60 million by the end of 2021. And streaming hours rose from about 4.3 billion hours to about 19.5 billion hours. So if you look at the revenue, how Roku generates their revenue, about 81% is from advertising on their platform, and it doesn't come from device sales like they initially did at the beginning because most TVs are connected now. So they're gaining market share. It's about 6.4% at this point as they kind of try to expand their footprint, not only domestically, which is starting to get saturated a little bit, but international growth is going to be one of their drivers moving forward. So if you look at the transition that they've made into those connected TV devices and the digital ad revenue spend by a lot of these streaming companies, you wonder why Roku's pulled back so significantly from those all-time highs, but valuation's high, and the company is given softer guidance than maybe the street anticipated moving forward. Deutsche Bank came out with a note this morning on Roku saying that latter stages of 2022, you should get some more clarity on guidance moving forward, how they're doing in the international markets, which is their next growth driver. We've seen that same theme play out in Netflix, Nicole, where you get saturated in the U.S. and North America, but their growth drivers are going to be overseas. And when you look at the amount of money they get, average revenue per user, it's about $41. It's a pretty significant increase from the previous year. So while they might have saturated here in the U.S. a little bit, their average revenue per user continues to grow. And being the leader and first in the market as far as aggregation of all these different streaming services that we have, the outlook's still pretty good, even though the stock's pulled back pretty significantly.
Yeah, it has. I mean, as you noted, right, down year to date about 40%, but the group overall has seen a lot of demand and some growth. And we just finished talking about Netflix in our trading earlier in the big three. We saw how well streaming did at the Oscars yesterday, and so Roku is tied into all of these. At this point now, how would you trade it? As you did speak of the valuation, how would you trade Roku?
Yeah, and I think that's the biggest concern for a lot of investors. It's been a falling knife over the last 6 or 8 months. So how do you play this to get in it if maybe your assumption is along the lines of the Deutsche Bank analyst on his call today? So I wanted to look at, because the stock has fallen, we've got implied volatility that's elevated in the overall market, not just Roku. I looked at a shorter term trade. They do have earnings coming up at the end of April, so I kind of want to avoid that. So I looked at going out to the April monthly cycle, so 17 days to expiration, where I'm just going to sell a cash secured put. And in this example, I'll look at the 120 strike put, which is currently just out of the money to the downside. If I can collect a $5.50 credit on that put, that's going to be the most I can make on it. But this type of trade is twofold, Nicole. If the stock does fall below 120 at expiration, I get to buy the shares at $114.50, which is a significant discount from where the stock is now, about 7% below the current share price for this stock. Now, the other way to look at this is you don't want it to fall below 120, so you can just keep that $550 credit for each put that you sell. So it's taking advantage of the higher implied volatility. It's a neutral to bullish type stance. You do have to have that capital to buy those shares if the stock does fall below $120 a share. But this might be the way to play it. It's a little bit more conservative to take that bullish stance, and you're taking advantage of that higher implied volatility in the option market.
Yeah. Thank you for that. I appreciate it. Understood. Thank you so much. Tom White with a good look there at Roku and an example trade. Thank you, Tom White. Coming up next, it's time to discuss those travel stocks. Are you planning a trip? It's our topic of the 360 round. Which companies are poised to outperform? Geopolitical tensions, could they impact international travel? Our panel will weigh in.
It's a 13-hour flight. That's not a weekend trip.
15 minutes to
Oh,
board.
wow, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make Thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Ben Lichtenstein here with your TD Ameritrade Network Futures Market Update. A bit of a risk-off sentiment to begin what looks like it could be a busy week to come. First, the four majors, the ES, the NASDAQ, the Dow, and the Russell are selling off some from the open, a reflection of investors' unease as rates have spiked, along with unease and the war in Ukraine. The Russell's leading the day way lower, down around 1%. The NASDAQ's teetering around unchanged, while the Dow and the ES are down around 0.5% this week. Keep an eye on a handful of Fed speakers, jobs reports, and personal income and spending to get a better idea of how the economy is performing with ongoing supply chain constraints and the 530 yield curve inverting, weighing on sentiment. Crude oil is also lower this morning. The WTI briefly back below 105 with rates here in the U.S. and COVID case counts in Japan on the rise, weighing on demand expectations. Officials announced a 4-day lockdown in Shanghai, China's largest city. Population is estimated to be around 25 million. We'll hear from OPEC later this week later this week on Thursday. And we have G7 leaders calling for the group to increase production in response to the ongoing war in Ukraine. OPEC again meets later this week. The UAE energy minister said it's essential for OPEC to stay together, stay focused, and not allow politics in. WTI futures holding around 106. Brent is at 113. Heating oil and RBOB gasoline futures all down around 6% on the day. This has been your TD Ameritrade Network Futures Market Update. Now back to Trading 360 with Nicole Petalides.
Thank you, Ben Lichtenstein, for that report. Welcome back to Trading 360. I'm Nicole Petalides, live at the New York Stock Exchange. We're happy to be here, and it's time for our 360 round, and we're ready for a focus here on travel stocks. And for that, we're welcoming in our panel, Jed Kelly, Senior Analyst at Oppenheimer, and Adam Johnson, Portfolio Manager, Advisor Investments. Thank you both for being with us. So, Jed, I'll start with you. I know you sent along your reports here on both Expedia and Booking Holdings. How are you feeling about these names?
Yeah, so we recently upgraded Booking. Feeling pretty good, all things considered, with the Ukraine crisis. What was interesting was last week there was a large European travel conference. Both Booking and Expedia were at this conference. They said they have a strong outlook for European travel this summer. So we're feeling pretty good. We think you're going to have a nice narrative in terms of demand trends when they report later this month or in early May. So as we kind of get into this recovery theme, leisure travel still remains strong.
Yeah, and within the notes that you have here, Adam, I'll steal from the OPCO notes to just formulate this question, and that is that urban and international travel could provide strong recovery tailwinds. So what are your thoughts, Adam? Do you agree with that? Just a broad-based statement?
Oh, well, it's not a function of my agreeing, Nicole. And by the way, good to be with you, and thanks for having me. But actually, that's the data. The data says we're already there. Load factors at a number of the U.S. airlines are already back to where they were pre-COVID for leisure travel. We're not seeing the business travel yet. And admittedly, the airlines is that's where they make their money on the business travel. But the point is, you're now getting back to profitability at a number of the airlines. If you remember, Delta said, oh, this was about 4 months ago. Delta said, we will be profitable by the first or second quarter this year. And they've actually done it sooner than that. So there is a tremendous enthusiasm among leisure travelers to get back out there.
Yeah.
When you see load factors as high as they are, and granted, I know some of the equipment was taken offline, but when you see load factors as high as they are, that's very powerful, Nicole.
Yeah, without a doubt. Jed, what about the other names in the group? For example, I saw that you have the Outperform on Booking and a Market Perform on Expedia. What other names are you watching? Why is one more of an Outperform versus the others?
Yeah, we look at our coverage is all relative. So, we kind of look at the big three, right? Like Expedia, Booking, and Airbnb. I would say this, Expedia since COVID, its enterprise value is up 80% higher. Airbnb, it's trading at 10 times or 23 revenue. Its private valuation, now its public company, is up 3 times. So they've kind of gotten these leisure travel tailwinds that, the pandemic, these work from anywhere trends has provided. But you look at Booking, its enterprise value is still similar to where it was pre-COVID. And we think that has a lot to do to higher Europe exposure. So we actually think Europe's going to have a strong travel recovery. There's a lot more pent-up demand. They're sort of like 6-7 months behind where the U.S. was in terms of the reopening. So that's why we have an outperform on Booking. But however, as you look out, I think it's going to be strong trends. The one thing we're watching is just on a potential recession in Europe, say at the later part of this year. We actually think as a stock, Airbnb would actually be the most exposed, just based on where their multiple would be relative to the other names. You would see more.
And Adam, you mentioned some of the airlines and how there's been a lot of pent-up demand, and you've already seen some of these numbers matching pre-COVID. So what's the big picture, as I know you have a lot of different groups that you look at pertaining to travel, right? We have the travel names, but there's airlines, there's cruise lines, there's hotels, casinos. Sure. Is there anything that sort of stands out to you, Adam?
Well, yeah, and I think Jed made the point about valuation. Some of these stocks are incredibly cheap. I mean, you look at Delta, and Delta is going to make $1.50 this year, but they could very well make $5.50 next year, which means they're trading at 7 times a PE of 7 times 2023 earnings. You look at Wynn, which is trading down at $80. That was a $150 stock before COVID. Wynn Resorts, which gets about a third of its money from Las Vegas, 2/3 from Macau. Chinese authorities are liberalizing, making it easier for people actually to go to the casinos in Macau. So, I think you look at valuation, and there is a lot of upside to these names. They were taken down so far.
Yeah, you've made some great points there, Adam. And Jed, your final thoughts here. As is there anything that could sort of derail this? You're more focused on the tailwinds than the headwinds, Jed?
Yeah, I think you would just say one would be Europe, and then if inflation starts to eat into consumer spending, right? Like that's really the only thing that could get on travel. We're actually seeing business travel start to improve a little bit. We're hearing some commentary out of the airlines, but it's geopolitical in Europe, and it's inflation causing. Inflation with any part of stagflation would impact travel.
Yeah. Great to see you both. Thank you very, very much. I wish you all beautiful trips this summer somewhere. Jed Kelly of Oppenheimer, Adam Johnson, Advisor Investments. Thank you both for being here with us. Appreciate it. And that's going to do it for us live at the New York Stock Exchange, trading 360 every single weekday at 11 a.m. Eastern Time. I am Nicole Petalides. I will see you at 2 p.m. Eastern Time for the watch list. Do join me then. Fast Market is next.
Let's walk through how to analyze a company's financials on Thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade network.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade network.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Good afternoon, traders, and welcome to Fast Market. I'm Tom White, and we've got a great show lineup for you today, including discussions and example trades in the S&P 500. The SPX we'll take a look at, which has rebounded sharply this month, and AMD, which was downgraded this weekend. And like Folio, we'll break down consumer sentiment data on Chewy, which reports earnings on Tuesday after the close. But to help me break down 2.5 hours into the trading day, stocks are mixed as investors, mixed to lower, as investors weighed risk to the economic recovery from inflation and tightening monetary policy. Bonds reversed from last week's slide, while oil declined on China's demand concerns. The 10-year Treasury note rose, sending the inverse yield down to 2.45% from last week's nearly 3-year highs over 2.5%. Earlier, yields on the 5-year Treasuries rose above those on the 30-year bonds, suggesting some investors expect an economic downturn. Now let's take a look at those four major indices. The S&P 500 down nearly half of 1%. The Dow Jones Industrial Average down 0.8%. NASDAQ 100, which was positive most of the morning, is now dipped into negative territory by 0.1%. And the Russell 2000 leading to the downside once again. The only major indice in the red last week, now down another 1.25% on the session. But to help me break down the market action, let's bring in my co-host for the day, and that's going to be the former host of Fast Market, Alex Coffey, the host of Next Gen Investing right here on the network. Alex, seeing some weakness here after a pretty strong week for the major equities. There's been no real news to kind of cause the downturn here, but I think the rhetoric about potential recessions, the rising interest rate environment, even though we're getting a little bit of a reprieve on that today. What's your take here on the market action?
Yeah, I wouldn't say that the story has changed, Tom. I would say that you've watched the markets rally continue to take place from maybe oversold conditions on declining volume levels, decreased market breadth, and as we've watched that decrease in breadth, and some of these mega cap tech firms have re-established themselves as the market leaders. So I know we're going to talk about some of these stories throughout the show, but you've had names like Apple, Amazon, and Tesla reemerge as market leaders over recent weeks. Of course, mathematically very important, but when you have less and less in terms of actual companies and names that are advancing on day-to-day sessions, in the midst of what's going on from a macro standpoint, it becomes increasingly difficult to chart higher prices. And so I think in many ways we've watched this rally run out of momentum, and as it's been kind of built on shakier ground over recent sessions, I'm not surprised to see this kind of whippy trading that we've seen.
Yeah, definitely. And you mentioned some of the drivers for the overall equity rally over the last month. And one stock that's done pretty well, up about 24% in March so far, spiking about 7.5% today, is Tesla. Let's bring in Caroline Woods, a contributor on the TD Ameritrade Network, to help us break down. Now, Caroline, I was going through a lot of the information that was out on Tesla over the weekend and this morning. We could do a whole show on Tesla. What do you have for us as far as what's going on with this company? Because it's spiking pretty high today.
Well, it's funny, you guys were talking about no news not necessarily being good news for the market today. Well, any news is good news for Tesla, regardless if it's positive or negative. But we'll start with a positive headline, and that's that Tesla is seeking shareholder approval to increase the number of common shares allowed, paving the way for another stock split so that Tesla can pay a dividend. This would be a stock dividend, so they'd be issuing additional company shares instead of cash. Tesla's board has approved the plan to increase the amount of authorized stock, but it hasn't yet approved the actual stock split. Tesla, of course, last split in August of 2020. The shares have more than doubled since that 5-for-1 stock split took place. Shares today are up 7.6% on that news, now positive for the year, up 3% year to date. And Wedbush's Dan Ives said the stock split news will be a massive catalyst for the stock over the next few months, so not just for today. Now, on the more negative side of the news flow, Tesla has paused production at its plant in Shanghai following that surge in COVID cases. It's expected to last through Thursday, and it's a key plant for cars, not just for China, but also for exports to Europe and Germany. So it could impact quarterly delivery numbers, although investors appear to be shrugging that off today. Shanghai, of course, is being split into two areas for lockdown, or two phases for lockdown. The east closing from today through Friday, and then the west closing from then until the following Tuesday. But I should note that on that note, Musk also tweeted, "I supposedly have it again, sigh, but almost no symptoms," of course referring to COVID. He tested positive back in 2020, and it looks like he's positive again right now, but luckily no symptoms.
Caroline, when you look at Tesla, it seems like the ultimate stock in which investors are able to just completely take a glass half full approach. It seems like day after day. You mentioned kind of all news in many ways seemingly being good news for Tesla, and historically that seems to have been the case, shrugging off, of course, regulatory concerns, SEC, Elon Musk tensions throughout its years, and of course, today you have kind of two separate stories, or maybe even three if you throw the Elon maybe being sick alongside that, yet it's as if the market only sees the one, and the stock completely bucking the overall market trend, building on its recent strength. Do analysts continue to have this kind of very strong kind of bipolar aspect to this? You have your ultra bulls, your Dan Ives, and then do you still have your doubters, or have all the doubters thrown in the towel?
No, they certainly haven't thrown in the towel. There's the Bernstein analyst, Tony Saganahi. He actually did call Tesla's performance year to date remarkably resilient, but he still has a $350 price target, or a $450 price target on Tesla with an underperform rating. I will say, though, on Friday, an RBC analyst increased estimates for Tesla's first quarter deliveries to more than 325,000 vehicles from roughly 316,000. That would be up 76% year over year, up 5% sequentially, and about 6% ahead of consensus estimates. So it's interesting, we've seen Ford and GM get hit hard so far year to date, down double digits. Tesla, meanwhile, as I said, is positive, but we're seeing analysts kind of revise their estimates for those automakers lower, and then here they are with Tesla revising them higher. So it's not just a momentum situation. Clearly, they're expecting more positive fundamentals. I should also note, in terms of positive headlines for Tesla, there was a Reuters report yesterday that the U.S. is basically boosting fines for car makers not meeting fuel economy rules. So the U.S. National Highway Traffic Safety Administration reinstated a sharp increase in penalties for automakers whose vehicles don't meet those fuel efficiency requirements. That's for models 2019 and beyond. So that, of course, could hurt the GMs and Fords of the world and be another positive catalyst for Tesla, which also could be why shares are moving higher today. But I don't know, it's hard. Tesla was down, what, $700 to $700 a share not all that long ago, and you just can't seem to doubt Elon Musk.
Yeah, that was, at the end of February, that stock was trading around $700. But we talk about Tesla all the time. The valuation that some people have on it based on the amount of sales that they have, the revenue that they're generating. But at the same time, demand continues to pick up for their vehicles. First to market, they still have the lion's share of the market as far as EV goes. And they got into more plants actually ramping up production also. All right, great stuff as always. Thanks to Caroline Woods, a contributor on the TD Ameritrade Network. But Alex, let's get into a discussion about what's going on in the market, because we've got some asset classes moving pretty violently today. We've got oil down on the lockdowns out of China. We mentioned the shutdown of the Tesla plant in Shanghai. They're shutting down parts of the city. What's your take here on crude oil? It's a bonus, right, for everybody that uses crude oil. Maybe some gas prices will start coming down, but this has been a volatile trade over the last couple months.
Yeah, I want to stick to that last part, Tom. It's been a volatile trade from a day-to-day, session-to-session standpoint, but generally we know the direction that crude oil has gone, and I don't think there's much speculation that that's going to abate anytime soon. So energy prices are increasing. While the path that we get there may be a choppy one, it might be one that has extraordinary volatility, but generally we've watched this market climb higher. And so ultimately that means when we go to fill up our gas tanks, when we go to buy goods, whatever it may be, the prices are going to increase alongside energy. Energy is the most critical price when it comes to the financial world. And we're going to see why as we continue to see inflation numbers, and of course the amount that we spend where when we go to the store, when we go to the gas pump, whatever it may be.
Yeah, Kevin Hinks and I always have this kind of conversation because we talk about crude oil because of the reach that it has, the footprint that it has, and how it affects everything we do, and especially as a consumer, whether it's heating your homes, filling up your gas tank, logistics companies, shipping things. You want everything, same day service, and it costs. And I think with the effect that it's going to have on the economy, while it might lag a little bit, we're seeing implications of that now as far as the consumer sentiment data, because the expectations portion of the consumer sentiment data is really weak at this point. So more to come on that. Another asset class I wanted to hit on, Alex, Bitcoin, up 6.8% today. It's broken through a key level here, Alex, at that $45,000 level that had been acting as resistant. Now, is this set up Bitcoin to continue to move higher? Because seems like people are pouring into this asset class today.
Yeah, and I think if you looked at Bitcoin alongside something like volatility, and we had this conversation with Oliver Rennick this morning, but when I look at the VIX chart and I compare this to Bitcoin, when I compare this to Tesla, when I compare this to the meme stocks, I've long said that a large aspect of the trade that you see in these type of assets is a short volatility trade. I have the VIX chart pulled up here. If I were to pull up a second grid here and look at Bitcoin, type that in here, and we can take a look at them alongside each other. I'll zoom in here just so we see kind of this year-to-date price action. You can see in many ways these are inverse charts, and that makes sense. Bitcoin is very much this highly speculative, futuristic, kind of anti-volatility type of an asset, and so it's going to do better when times are a little bit less uncertain, a little bit more certain, a little bit less risk is in the market. And so to see this massive move lower in VIX correspond with this massive move higher in Bitcoin, it's not the entire story, Tom, but to me, this is the short-term story.
Yeah, and I like that you brought up the VIX here, Alex, because I kind of wanted to hit on that a little bit. Are we getting a false sense of security? I mean, you see the headline risks out there. Russia, Ukraine, the disruption in the energy markets, in the commodity space, consumer sentiment falling. When I saw the VIX settle below 21 level on Friday, it's almost like I kind of looked at everything, the macro environment that we're in right now, and it kind of gave me a little pause for concern here moving forward, that investors are getting a little too comfortable with the fact that, hey, I'll ignore this stuff until it matters. Well, I think it matters, and I think that VIX falling below 21 last Friday, it's up a little bit today, gave investors a little bit of a false sense of security. Your take here?
Well, I think that we have to set our expectations accordingly. And so while in times past, 2017 always jumps off kind of into my memory whenever I think of times of low volatility, where you had volatility breaking through the 10 mark, spending the majority of the time under 12. Those days are likely not in the near-term future. Okay, we know historically the average for volatility somewhere in the mid to high teens, so somewhere between 15 and 17. I said at the beginning of the year as one of my sort of previews for the first 6 months is, expect volatility to be above its historical long-run average for the beginning of the year. It's just a different environment than times past. This was before we added in, escalating geopolitical tensions from some very, very, integral parts of the world economy. And so you throw more uncertainty into the space. I think that while it isn't necessarily giving us a false sense of security, we may be approaching what could be a near-term floor in volatility in terms of, could we see VIX, VIX peak into the high teens for a short period of time? Sure. Was it maybe a little bit overbought in the low to mid 30s? Also sure, but I don't think that we're heading back to any type of a low teens volatility regime. And the reason I say that is, Tom, if we pull the platform back up, I have the product depth screen, which is a sub-tab amongst our chart platform, and I have the volatility futures /VX typed in here. What this is going to do is plot across the different contract expirations that we have. Each one of these dots is going to represent a different volatility futures contract. And what you can see as you look across this curve is volatility is normalized across the future in the mid-20s. So we're not in a situation where there's this feeling that volatility is going to abate into the future. In fact, it's the opposite. There's this feeling that it's going to increase into the future, which is normal for volatility, but normally we see this from a lower price point.
That's interesting. I like that because it's almost reflective of, hey, there's going to be volatility most likely throughout, at least the next quarter or two. So expect those roller coaster rides to continue. I think nobody's really pushed against that volatility is going to go away anytime soon, especially in a Fed tightening type of environment, which we're going to start to see ramp up as early as that first meeting in May. Maybe get a 50 basis point hike. But one of the areas, Alex, that helped drive the markets throughout the month of March has been the FANG names, right? Mm-hmm. Most of them are up above 4% for the month, except for Netflix has been under some pressure lately. But I always look at it this way, Alex. When you see those major components in a lot of the major indices, outperforming or performing well. It's hard to send the overall market down when you've got Apple, Amazon, Google Alphabet, Tesla up, anywhere from 3 to 10% on a monthly basis. It's pretty hard to drag any other names down when those are such major components within the major indices.
Yeah, hard to disagree with any of what you just said, Tom. But what I would also point out is, I'm just going to pull up, for an example, Tesla over the last 10 days on the platform. You've watched this stock 10 days ago reach a low of 755, and I know that that's not the low point, but I'm just solely showing that you've seen a tremendous move in terms of percentage gains on limited news. I know that we've gotten some as of this morning, but that only corresponds to this last little piece when it comes to Tesla. You've also had some incrementally poor news for companies like Tesla over the last recent weeks. I'll key up Apple. Similar story. Some have said the strongest 2-week move in Apple's history. Well, we have news that they're actually trimming production. That's not the type of reaction you typically would see in a stock that is cutting back its production, particularly one that sells products. And so when you look at some of this, Tom, the reason I paint this picture isn't to discount the importance of these particular names on the market. It's more to say how much more in the near term is left. And so if we've seen these tremendous rallies, and let's just entertain this as a theory, that maybe they've ran their course for a very short period of time, does this actually end up turning to a possible negative for the market? Do these names have to have a healthy pullback or even just stop their rally? And if we're already talking about a market that's rallying on very limited breath using these names as leadership, if they're no longer rallying and they're no longer the leaders, what is?
Yeah, you wonder about the parabolic move that we've seen in some of those names, and you mentioned Tesla and Apple over the last couple of weeks here. RSIs, those technical levels getting to that overbought territory, especially for Tesla on those moves. But it brings all boats rise, go higher in rising tide back into play. But at the same time, Alex, when you're looking at the overall market, we talk about the benchmark S&P 500, the SPX. A lot of news people talk about the Dow Industrials. I kind of ignore that a little bit. I look at the benchmark S&P 500. When you look at this type of environment where we're going to expect some added volatility, where maybe they sell rallies, buy dips, but there's no real direction. How do you look at SPX as far as a trading vehicle? I know it's considered an institutional product, but that shouldn't shy people away from this type of index if you have an assumption on the S&P 500 on where you think it's going to go over a specific amount of time. I mean, they've got 3 expirations per week, so you can find something possibly if you're looking at this type of product to trade, maybe as a hedge, maybe as a speculation, right?
100% agree with what you're saying, Tom. I have a 5-year chart pulled up at the S&P 500, and so this is just to highlight the point that there's times of uncertainty, but generally throughout history, the reason that there's investment in risk assets, particularly U.S. equities in publicly traded markets, is because over time, even throughout those periods of uncertainty, overall the market has appreciated beyond those ultimately out in the time. However, in the near term, if you time things properly, there can be pullbacks. And so I'm of the belief that we're in a different market environment than we have been in recent years. And so as a result, if the market's going to rally, we should be utilizing those rallies as opportunities to de-risk our portfolios that generally lean long in long-term passive assets. And so you should utilize these opportunities that the market's giving you to establish maybe some short positions, protective positions, particularly when volatility is lower. And so, Tom, I wanted to talk about kind of the pros and the cons of trading this particular product. The first con to me is that it's just very, very big. On the pro side, though, it's cash settled and there's no early assignment or exercise risk. So in terms of holding things through expiration, if you ultimately decide to do that, it can be very clean in how that's settled. Some of those risks that you would see on individual equities aren't going to be seen. You also mentioned one of just the vast amount of choice that you're faced with this. So while daunting, it also empowers investors to make things very, very customizable and they can basically find something more than likely within this marketplace in these options that are available. It is only options, of course, available for the SPX. First off, so it's big. It's a big product, Tom. Lots of choices. And so how do we think about trading this? Well, prior to the show, I built out an example trade just for the sake of saving some time. I wanted to show this. And so what I looked at was a traditional put calendar spread. This is going to accomplish two things if ultimately we put this style of trade on. And what this trade is a longer term or more traditional calendar spread, more from your time on the floor, Tom, where we're selling the May monthly and we're buying the June monthly at the 4,300 put strike. I chose the 4,300 put strike. One, it's a round number. We had some trading there, but also it's the 30 delta in that June expiration. So a lot of things converging to one there for me. Also, we know that this will, of course, give us some short deltas or offset maybe some of those other portfolio risks that someone may or may not have. But also, this is a long volatility trade. This is going to have a positive vega. If I open up these price slices, we can see we're getting 3 short SPX deltas and positive vega. So if the market moves lower, you may see an expansion in volatility, both of which would work to the advantage of this style trade. And so the downside is it is a hefty debit. There may be exchange traded products that seek to track this index as well that have their own risks inherently that could maybe make this a smaller trade for someone who is looking to get smaller. But for those who are looking to trade this size product, this type of exposure, this may be a trade strategy that could look to accomplish several things at once.
Right, so you've got implied volatility that's fallen so far in March as the S&P 500 has rallied. Alex set up this 4,300 put calendar to the downside, and that's about just over $200 below the current share price of the index. The May options expire in 52 days, and your long Junes expire in 80 days. So it's quite a long duration. You do have some the ability to adjust that, but I like the setup here, Alex, where if the S&P 500, the SPX index falls, implied volatility historically has risen. Now, that's not always true, but that's what you would expect. And maybe it hedges against anything. And maybe you have a long portfolio that's bullish with equities or individual names. And this could be used as a hedge if you think maybe we'll see some pullbacks. You're paying a hefty debit on it, as you mentioned, about $3,340 in risk on this per spread is going to be that. But if you look at the Analyze tab that you have up there, Alex, I think that's what's interesting about where the potential reward is. I mean, you've got right now basically about 4,550 on the upside and about 4,100 on the downside as your break evens. So you've got a wide swath that this can trade in to remain profitable on this trade. But this is like a big boy calendar, as I like to call it, Alex, because you're not only giving yourself duration, you're actually paying a pretty hefty debit for these each individual calendar. Your final thoughts on this type of strategy as either a hedge or speculation if your assumption is bearish?
Couple things. First off, it's highly customizable. So 4,300 isn't the strike someone was interested in, and these aren't the expirations that someone was interested in. This is one that's a little bit longer term. It won't necessarily need as much active management if you were willing to kind of let things play out. Of course, when you're looking at this, I wanted to highlight one more thing. I actually pre-built this out prior to the show. I'm going to move this up a little bit so we can see it. I have the May-April 4,300 put calendar also built out. This isn't going to be a perfect indication of how things would look 1 month from now, but it's showing what a shorter term calendar is priced at. So if we kind of hypothetically were thinking, okay, a month passes, everything was exactly the same, how would this trade fare? Not perfect, but it does in a way replicate that. This trade actually expanded. And so it goes up by $18. So if all of this was equal, if time passed and we didn't see a market move, volatility roughly stayed the same, you could actually watch this trade expand, which I think is counterintuitive than what the risk profile shows on its own. It's also a positive time decay trade, Tom, as we're selling volatility as well in the nearer term. that if nothing happens, it may decay at a faster rate.
Right, I like that that outlook on that. Even with the SPX still above 4,500 level on this, it's not at the apex of that profitability, which is at or near that 4,300 strike, and it still expands in value because time decay is working in your favor. Great reference there, Alex, to kind of highlight what possibly could happen on an example trade like that. All right, that's going to do it for this segment, but coming up after the break, Alex and I will be joined by Andy Swan from LikeFolio.com for a discussion on this. What are we talking? We're talking Chewy. Chewy's got earnings on Tuesday after the close. Fast Market will be right back in 2 minutes.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watchlists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Fast Market on the TD Ameritrade Network. I'm Tom White, joined by my co-host for the day, Alex Coffey. But let's bring in our next guest for our cash tag segment, and that's going to be Andy Swan, the co-founder of LikeFolio. Andy, Chewy shares are down about 20% this year, hit nearly two-year lows earlier this month. What kind of data are you seeing? Because it seems like people that use Chewy love it, right? But I mean, what kind of data are you seeing? Because they have high retention rates? Are they having pullback in the number of users, or what's going on here?
Yeah, it's kind of a tricky problem with Chewy because they got, like so many stocks and companies that benefited from the pandemic. This is one that has really, really difficult comps coming for the next year. And what we're seeing at LikeFolio is that they're doing a very, very good job of keeping their customers happy. They have the highest customer happiness rating of any of their competitors by a really wide margin. This is a company that truly focuses on the customer experience first and foremost, maybe at the expense of growth in the short term. But one of the things that's really catching our eyes, that along with this very high level of consumer happiness, we have seen some resumption of people talking about, signing up for Chewy's auto ship service, which is really turning Chewy into a pet food, pet supplies subscription service that produces really nice recurring revenue that the company can count on. This is up 31% on a year-over-year basis, but somewhat cooled on a quarter-over-quarter basis. So it's a really mixed story with Chewy. We see some signs that new consumers are coming back to the company, coming into the company for auto ship and subscription services. But the bottom line is, for us, really long term, is that this is a company that makes its customers extremely happy and is building a huge base of automatically generated revenue that should separate them from the competition over time. Although in the short term, we continue to see a little bit of a rocky road for the company, really tough comps, and just a really interesting inflection point. So I think that as we go into the into these earnings calls, we're going to have to really listen carefully to how the company sees its future, because I have a feeling it's going to be a little murky.
Andy, I think your data and what you just said somewhat speaks for itself. So my question is going to go to picking your entrepreneurial brain a little bit here. I always look at, comparing this, let's compare this to an Amazon. Amazon has done a good job of basically not limiting the scope of which the products that they sell and not limiting kind of the market that they're shooting for. They're basically trying to sell you anything you want, wherever you are, as fast as possible for as cheap as possible. Chewy, of course, a little bit different, focusing on pet products, particularly food and some of those staples, hoping you sign up for that auto ship. But also, I think sometimes we're somewhat prisoners of our own situation. And so when I think about my own, situation, I live in an urban area. I live in a large apartment building with tons of dogs and pets. And I see a lot of these boxes, and it makes sense. Maybe a lot of people who live in my building don't have cars. We've had this conversation before, where it's a little bit more difficult maybe to lug a big bag of dog food down the street if you don't have a car. But if I'm in, the Midwest where I grew up, in, let's say, Omaha, Nebraska, where it's a little bit more suburban, everyone does have a car. They maybe go to a PetSmart or even a Super Target on the way home from work. They might as well just throw this into the cart, buy it alongside their other things, and go home. So I guess my question to you is the only way Chewy can compete with the likes of something like Amazon to have a superior customer service and consumer happiness? Is that the only differentiating factor that they have?
Yeah, I think it really is. I don't think that they're going to be able to compete in terms of the breadth of their product offerings with an Amazon. They can with, a Target or somewhere like that just has one aisle kind of dedicated to pet supplies. But I think we have to remember the American consumer is very much getting used to ordering and having delivered a single burrito. So a 40-pound bag of dog food, no matter where you live, is probably pretty compelling to have someone else bring that to your front door. And so I think Chewy's focus on making every customer they have as happy as possible, and then expanding their offerings into pet insurance, pet health care, pet pharmacy, and becoming the relationship you have with a company for your pet is their best play, and one that they're executing on pretty well.
Andy, when you look at this, as far as recurring revenue, I think that's the biggest key here. And Alex mentioned Amazon before. I look at this as a specialty player in that. You mentioned the retention rates are good for most of their subscribers. But as costs continue to rise, the cost to ship, everything else, when you look at your data and you mentioned, the stock price is down and your data quarter over quarter maybe starting to waver a little bit, looking out for Chewy, is this going to be one of those stocks that we're not going to see those highs that we saw a year ago, just because comparables aren't going to be that great, and maybe margin as they try to expand their footprint isn't going to be that good? Is this one of those stocks that you look at and your data reflects that, hey, it's going to be a good company, but don't expect anything out of the norm unless maybe some partnerships or they expand into other areas?
Yeah, I think that's right. This is a little different than some of the other kind of post-pandemic waning companies, where we see something like a Roku or a Tesla as having, the potential to kind of rocket higher or get close to all-time highs within the next year or two. It's going to be tougher for Chewy. I think this company got way ahead of itself in terms of Wall Street's anticipation. I think the company is really executing really well. So it's got to be frustrating for the company to have its stock be down and battered, even though as a company they're doing a really good job of execution. I do think that this is a really good company long term. I think that short term volatility will continue, and there's probably going to be opportunities to buy the stock even lower than it is today.
Andy, I got to say they do a great job, and you can see it in that B-roll there of marketing through their shipments. And you know, I always have tons of boxes built up in my lobby, and you always see the Chewy boxes, which is, you know, in a way just kind of free marketing for them. I know that there's probably a little bit of a cost, obviously, to have that screen printed on their cardboard, but still it does a good job of kind of building their customer base within the markets that they certainly have a stranglehold on, and those are the more urban centers, those who spend a little bit more time on foot than, you know, on wheels. But Andy, you also talked about them expanding into some of these other areas and trying to ultimately be creating this kind of pet ecosystem. With all that's going on in terms of the macro and the stuff that's going to be pressuring their margins, are investors going to have to, as you said, weather maybe some near-term volatility if they believe in this long-term story, and maybe implore a little bit of patience?
Yeah, I think patience would be a very key word for Chewy investors. I think that you have to be bought in to what the company itself is trying to execute and trying to do, and not so worried about how Wall Street reacts to each and every report or action, because what their plan is to build a very long-term, very loyal relationship with each one of their customers, and that can take time to show through to really big profits. You know, we've seen these types of plays in other companies be wildly successful, if you're talking about Netflix, and we've seen these types of plays also fail historically because it just gets too expensive, and you can never really get to that highly profitable point. You're always chasing the Amazon, the Walmart, the Target. So it could go either way, but I think the path for Chewy is very, very clear. And at Likefolio, we're going to stay focused on, you know, how happy are they continuing to make those customers extremely happy? Because if so, that means they're executing on their plan. And if not, then everything is on the table in terms of Chewy's downside.
So do you have an earnings score for this one, Andy?
Pretty neutral going into this. Is going to be a listen type of event for us, and try to understand that cost structure side of the company's report.
Guidance going to be key for a lot of these companies going forward, so we'll continue to watch that. All right, great stuff. As always, Andy, thanks for being here today.
Thank you.
All right, that's Andy Swan, the co-founder of Likefolio, joining us, breaking down the data for us on Chewy ahead of those earnings. Now, Alex, we got his take on it. This stock was trading $120 in February of 2021, so about 13 months ago, more than cut in half. Your thoughts here on the way you want to look at this for an example trade going into earnings, because I'm guessing implied volatility pretty elevated going into this report.
Well, I think first comment I'd like to say, Tom, is just because maybe you like a product or service or have had a great experience with it doesn't always make it a great investment. You know, I can completely echo the sentiment of what Andy's seen in his data, that the experience with Chewy has been great in my own experience. Of course, I'm just one customer of their, you know, many million, but, you know, this does take a lot off the table in terms of remembering to do stuff for your pet, and of course, the hassle of actually going to get it. But of course, there's you know, prices, and there's valuations, and there's growth projections, and there's other things that factor in than just a positive experience. I think that's important to talk about. But Andy mentioned the word neutral at the end of what he was talking about, and how he sees a lot of the risk factors potentially in this report being how the company shapes their progress towards their goals and what they have to say about the future. And I think that's going to be pretty key throughout this you know, upcoming earnings season as well. But volatility is still quite elevated. You have 178% implied volatility for this week's 4-day expiration options expiration. And so what I was looking at, Tom, was actually a range bound or a neutral strategy with a little bit of a downwards bias. Reason being is the stocks had a nice rally as of late, and also maybe you see some of those risks in a very short period of time favoring a downside move as opposed to an upside move. Nonetheless, though, it is a risk-defined trade. For the trade itself, we're selling this Friday expiration 51.54 call vertical, so that's $3 wide. Selling the downside 38.35 put vertical, which is also $3 wide, and we're looking to collect around $1. That would be exactly 1/3 the width of the strikes, giving us a risk to reward ratio of 2 to 1, which is sort of loosely within our guidelines of about a 65-70% probability of success. Tom, break even on this trade would be 52 to the upside, and to the downside it would be 37. What I'm going to do, that would be if we filled it at $1. I'm going to set the slices to the break even, and I'm going to set those slices to our chart. On the chart, the dashed lines, those white dashed lines, represent the break-even points, and the chart data, this entire picture, represents the last 30 days of trading. So you're talking about a month and a half or so of actual trading activity going back to the early parts of February, and you can see we haven't spent much time beyond our lower or upper bound. And so in this particular case, we're looking for an underperformance of that market maker move, an inside type of reaction. For context, that market maker move right now about $6.50 for about a $46, $47 stock. So you're looking at somewhere, let's say around 14, 16%, around 15% or so.
Yeah, and let's see, the implied volatility, as you mentioned, about 178% in that near-term April 1st weekly cycle. The probability of finishing out of the money on the 38 strike, which is the put that you sold against the long 35 strike put, 82% on the probability. So decent on that one. It has bounced off that 35 level a couple times, and that was more than 52-week lows on that. The probability of finishing out of the money on the upside on the 51 strike, about 72.5%. You mentioned those break evens. If you're collecting roughly $1, you've got $2 in risks outside of the 35 strike and above the 54 strike. So you've got a nice wide range. The option market's pricing in that plus or minus 14% move either way in Chewy going into this report, but it has bounced about $11 off those 52-week lows that we saw just a couple weeks ago. All right, great example, great look at an example trade in there if you're more neutral, trying to take advantage of that higher implied volatility going into this report. Short 4-day trade on that. It expires on Friday. All right, good stuff as always. But coming up after the break, Alex, we're going to take a look at AMD, which was downgraded over the weekend. Fast Market will be right back after this short break.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Ben Lichtenstein here with your TD Ameritrade Network Futures Market Update. Bitcoin to levels not seen since the beginning of January, breaking out of a 3-month range and shrugging off recent comments from Federal Reserve Governor Christopher Waller. He said it's not a payment instrument at all. Waller called it electronic gold. He equated cryptocurrencies and Bitcoin to baseball cards and art, things that are intrinsically useless that people pay a lot of money for and hold, thinking they can sell it later and get their money back. Last week, the chair of Russia's Duma Committee on Energy said for friendly countries such as China or Turkey, Russia's willing to be more flexible with payment options, suggesting Bitcoin will be accepted for oil purchases. Now some $10,000 off the March lows. Bitcoin futures are up 7% at 47,800. Another day of selling pressure in the Japanese yen to a new 7-year low against the U.S. dollar, with the BOJ trying to defend the quarter-point rate cap they've committed to, buying an unlimited amount of bonds. Many are calling for intervention from the Ministry of Finance to take measures to slow the currency's decline. If so, it would be the first time since 1998. The U.S. dollar versus the Japanese yen briefly above 125. Futures down to spot 80 even before recovering some. Currently trading down 1%, just above 8,100 if lower this week. It's the fourth in a row. This has been your TD Ameritrade Network Futures Market Update. Now back to Fast Market.
Welcome back to Fast Market. I'm your host, Tom White, along with my co-host, Alex Coffey, joining me today. But let's take a look at the four major indices before we get started here. All in the red. The NASDAQ 100 basically flat, but S&P 500 down 0.4%. Dow Jones Industrial Average down 0.66% on the session. Russell leading to the downside, down 1.2%. And the NASDAQ, as I mentioned, just slightly in the red, trying to hang on. It is up 3.6% for the month of March so far. But Alex, let's get into a discussion here about the next stock we're going to talk about, and that's AMD. It's down about 18% this year, off about 28% from all-time highs that we saw in November, above $164 a share. It just hit a death cross as far as if you're looking at the 50 and 200-day moving averages, the 50-day moving over the 200-day. So death cross in. It's not oversold. It's not overbought on an RSI, a technical level here, Alex. But Goldman Sachs coming out, downgrading the stock. They still give it a $127 price target, which is about 6 or 7% above current share price. Your thoughts here?
Yeah, I'm just keying up a chart here, Tom, and I'll have it ready in just a second to illustrate what you're talking about with that death cross. But I also have a chart that's pulled up for the last 5 years in AMD, and I think this tells the story greater than just the death cross itself. This is a stock that's had a absolutely meteoric rise over the last 5 years, and I think that explains why it's been such a fan favorite, a retail investor / trader favorite. It's gone from $9, 4.5 years ago, to all the way to 164 in a very short period of time. Even though it has pulled back, you have to look at that general trend. And so while it is not crude oil, the same story that we talked about with crude oil, I think, applies here. Near-term volatility, but generally, where has this stock gone? Well, it's gone higher. As for the death cross, sounds ominous. Does it mean anything is a better question. Let's pull up the SPX, because if you recall, Tom, we had a death cross, right at the market lows of late before preempting a massive rally. So if you use it for the same way that we did in the SPX, maybe this is actually good news.
Yeah, you have to wonder. They talked about compressing margins perhaps and maybe stagnating demand for some of their products moving forward. As you mentioned, I remember looking at AMD for about 10 years. It was between about $5 and $15. I mean, it just didn't do anything. But they've made the necessary changes. The CEO in place, leadership has turned this company around. Now it's one of the biggest players in the CPU space, along with the retail consumer space as far as their chips go. I think Bank of America came out with a note on Friday, Alex, calling a new FANG, a new acronym type of thing, where they looked at like Broadcom, AMD, Micron, On Semiconductor. They called it MANGO is the acronym they gave to it for a lot of these semi chips that have pulled back from those recent highs. But we'll have to wait and see on that. Like what I kind of wanted to look at in AMD on the downgrade, because I know a lot of retail traders look at this name, right? So I wanted to kind of take advantage of the implied volatility being elevated due to the fact that it's elevated in the overall market, but now we've seen a pullback here in AMD. So the strategy I kind of looked at, Alex, and you can help me break it down, going out just about 2.5 weeks to the April monthly expiration. So 17 days till expiration. Got some elevated volatility in there. And I just looked at a way to, look at a covered call, but not doing a covered call, selling a cash secured put here. And I went pretty aggressive on this example. The 115 strike put, selling that. You're collecting roughly just over a $4 credit on that option, Alex. And this is a type of strategy I think a lot of traders look at if they want to get long a stock, but they're not comfortable maybe getting in, or maybe there's some headline risks to the overall market or the sector or the individual stock. But selling a cash secured put in a stock to take advantage of higher implied volatility and or the ability to buy the shares at a cheaper price if it goes below your strike price at expiration, Alex. Give me your thoughts here on this. If you sell it for $4, your break even is going to be down at 111 on this, so that would allow you to buy it if you have the capital at expiration. If it's below 115, and giving yourself a better probability of success.
Yeah, oftentimes the very first strategy many investors are introduced within the option world is the covered call, because traditionally you're a stock investor, you own some stock, you learn how overlaying or selling that call or writing that call against those shares can look to create potential income in exchange for a defined upside profit, therefore, reducing your cost basis and improving your probability of success. This strategy, because of its ease of explanation and how it's easier to grasp, often overshadows, in many ways, its counterpart, which is the short cash secured put, as a means of possibly acquiring a position prior to actually buying those shares. And so this is a strategy that, again, if you're willing to set aside what is a little bit more capital intensive for a greater risk, you can potentially improve that probability of success in your investing by adding a time decay component and, of course, a lower break-even point, Tom. In this particular case, you go out a couple weeks, the 115 put just out of the money, and therefore you sell it for $4, break-even 111. But I think the part that's oftentimes forgotten with this is you don't actually need the stock to go higher, although it's a bullish trade, to be profitable. In fact, this stock can kind of languish around this 115 area for the next 2 weeks, and we can actually be max profit for this particular trade. It's far different than stock investing, where you buy the shares and you're basically at risk penny for penny, depending on the amount of shares that you bought.
Yeah, and that 111 level going into April expiration, probability of that being out of the money about 67.5%. You do have to have the capital if it does fall below that strike, if you want to let that go, through assignment, where you have to buy the shares, so you have to keep that in mind. But this stock doesn't pay a dividend. So this is the trade-off if you sell a cash secured put that's out of the money to the downside, as opposed to buying for every 100 shares of stock you buy, you sell a call against it. So it looks like the same thing on a risk profile as far as just the shape of the profit and loss, but there are different mechanisms within each one of those strategies. On that, max you can make on that is $400 per option that you sell if it remains above 115 into expiration. All right, great stuff. Alex Coffey, thanks for joining me today. He's going to be hosting Next Gen Investing coming up, but let's take a quick look at the equity markets before we sign off here. The S&P 500 down about 0.25%. Dow Jones Industrial Average down just over 0.5%. NASDAQ 100 peaking back into the green, up 0.2%, and the Russell 2000 still down just over 1%. We've got crude oil down nearly 6%. We've got Bitcoin up over 6%. So we've got some asset classes moving. But stick around right here on the TD Ameritrade Network, as Next Gen Investing is coming up next with Alex Coffey. He's going to be hosting that one, the Iron Man, and Jenny Horn. Have a great day.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Let's walk through charts, one of the most commonly used features on Thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select Time Frame to adjust time intervals or to favorite a time frame. Select Style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to Thinkorswim, head to the Education Center on TDAmeritrade.com.
Happy Monday, good afternoon, and welcome to Next Gen Investing. I'm Alex Coffey alongside Jenny Horn. Jenny, it's noon. That means 3 hours to the closing bell. First trading day of the week and a mixed one. So you have the NASDAQ clinging, or just barely clinging onto those gains. As you see it up about 28 points or so right now. But a lot of this is due to big moves in Tesla, big moves in Amazon. The rest of the market a little bit weaker.
Yeah, Tesla posted a 10.5% gain last week, which was just astronomical, really, to watch. And we also saw markets, I would say, start to normalize last week as we did see things, I would say, fairly positive for the week. So I think expectations are a little bit mixed heading into this week, but we actually do have some key earnings in the beginning of the week at least. So earnings season is not completely over. A lot to look forward to this week, although it is 28 degrees in Chicago right now, Alex, and it's also March 28th. So I'm a little bit over the cold, but we will get right to our upvote and downvote segment. Following that, we will chart and trade our upvotes. Then we will look at our FOMO discussion of today, and that is in ticker symbol MATX, that's Matson. We'll dive into that stock's performance and how it's outperforming the broader market so far this year. Then we will preview Lululemon ahead of their earnings, which are Tuesday afternoon, a report I am very excited about. And last but not least, we will look at Canopy Growth and really a lot of these pot stocks sort of giving up a lot of their gains from last week.
Yeah, Matson, formerly known as Alexander and Baldwin, for those who have been following the transportation industry for several years. Very old company, goes back to 1882, primarily in the shipping front. So I'm looking forward to that conversation as we just watch how the interworkings of everything affects the prices that we ultimately pay. And so if shipping prices are going up, unfortunately, means the prices that we pay as consumers may go up as well. But we'll get to that in a little bit. Let's go to upvote, downvote. A good list of movers once again. A couple familiar names for sure.
Yeah, so to start things off, we have Micron, who reports their earnings tomorrow afternoon. So definitely one of those key movers we will be watching in the beginning of the week, like I just mentioned. Shares have obviously been in a rough ride in 2022, down about 16.5% so far this year. But the street is expecting earnings of about $1.97 a share on revenue of roughly $7.5 billion. And they're expecting their DRAM shipments to be hit by the ongoing chip shortages. Not a new discussion there for this name, but as a whole, supply shortages are expected to remain an issue for the duration of this year. However, overall, the analyst community is still fairly positive on Micron, despite the fact that it has seen some selling this year. It's not, of course, the only one, as we do see chips seeing this weakness. But of the 13 analysts that cover Micron, all of them are positive, with the consensus rating being a strong buy. The average price target remains to be about $119 a share, which with the shares currently trading at just shy of $78, this still implies about 50% upside. So we do see some positive expectations here for Micron. However, we do know with these tech names for earnings, Alex, it's been very difficult to gauge how the market will react.
Yeah, JP Morgan analyst Harlan Sur, overweight at 115, came out saying expects the company to come in line with its own guidance. So it's always notoriously Micron kind of in this no man's land of earnings season. Is it the beginning, an early beginning preseason type game, or is it a late game, kind of like the Hall of Fame game or something that takes place in the summer? It's always hard to kind of pinpoint, but nonetheless, I think it's going to be critical to see if it does come in line. How does the market react? Is it going to be enough? Is the market going to reward that, or are we going to see weakness? So I'm excited for this conversation, excited for this report. I'm going to say upvote.
An upvote, because we do still have that earnings catalyst, and I do agree. I'm not really sure if it's the end or the beginning. I always kind of thought of it as the end, but with not a lot of earnings, there will be much attention paid to Micron. But our next name now is a frequent flyer on the show, and that is Tesla, with several pieces of news today. They announced plans to request stockholder approval for their upcoming 2022 annual meeting of stockholders for an increase in the number of authorized shares of common stock in order to enable a stock split of common stock in the form of a dividend. Now, Tesla's board has already approved this proposal, but the dividend is contingent on now a final step of approval. The plan, now they also have separately plans to suspend production at their Shanghai plant for at least one day, as we know that local governments have cracked down on their COVID restrictions in China. Now, they have not yet announced if this lockdown will persist beyond just today, but we do know they are shut down for at least today. Plus, additionally, the U.S. National Highway Traffic Safety Administration has reinstated higher penalties for automakers who are failing to meet fuel efficiency requirements, which is seen as a win for Tesla, as this could cost other automakers millions or more, according to Reuters. So it's not necessarily a direct win for Tesla, Alex, but it's more of the loss of everybody else that seems to be seen as a positive for Tesla. Now, like I mentioned, shares were up over 10.5% last week. On Friday, they actually closed slightly lower, snapping an 8-day winning streak, which was their best consecutive performance since about January of 2021. So this name has seen some fantastic movement, and I would say not a real clear catalyst other than maybe that Gigafactory in Berlin opening up, which seemed to set the shares sort of on fire.
Yeah, and with the question now for investors, is this the crescendo? Is this the, kind of that last jump? or is this the beginning of more constructive action for Tesla? Up 7.5% today. Not sure any of those headlines merit a 7.5% move in Tesla, considering when you're talking 7.5%, you're talking, almost $100 billion in terms of market cap being created, which is in many ways bigger than a lot of its peers. So keep that in mind. But we'll say down vote today. We'll let things settle, if you will. But of course, Tesla is always a fan favorite. It's a retail trading favorite. If you're willing to step into those waters, nothing holding you back.
Yeah, I mean, I guess I would say maybe news of a potential stock split is positive, but we haven't even gotten any confirmation yet. So a down vote for me for that reason, but I'm sure we will revisit this name many more times on the show, at least this week. But now our next name today is Foot Locker. Now, you'd be hard-pressed to find a chart that looks worse than Foot Locker on a year-to-date basis, with shares down about 32%, also falling about 6.5% this month, and we do know they have been in a pretty sizable downtrend following their fourth quarter earnings when they reported revenue that would be below expectations for the remainder of the year, and sort of a breakup with Nike, their biggest supplier. But Cowen actually cut their rating to market perform from outperform, while also lowering their price target to $34 a share from $42, saying this comes after his review of the latest data on digital traffic and search trends, which has him concerned despite the stock's relatively cheap valuation right now. Now, Google trends so far this year are averaging down about 14% from last year for Foot Locker, and are down more than 30% from their pre-pandemic levels. So that is obviously a concern. The analyst said that without better online and brick and mortar traffic, it will be very difficult for Foot Locker to take advantage of the improved industry in the second half of the year. They're also concerned about inflationary costs from supply chain to labor could be more burdensome than what is already being priced in. So fairly negative report on Foot Locker. I would actually even say the most worrisome part of this report, Alex, is this analyst was a longtime bull of Foot Locker and now has completely changed his tune.
Yeah, a little bit of capitulation. Stock's certainly been under pressure for years now. It is off its COVID lows by quite a substantial margin, but there's not a lot of positives being painted right now. So for those who have patience, believe in the story long term, maybe they'll see opportunities in this. For those who don't believe in it, want to bet against it, it's like the stock's already gotten beat up pretty good. How much risk reward is left in there to the downside? And then I look at where we are seasonally. You talked about some of those trends. Well, we're after the holiday season, and we're kind of in this lull for sports. Those are two things that don't really favor something like Foot Locker right now. So maybe wait till the summer. We get a little bit more, football starts, baseball starts, new school year, get some new shoes. But who knows what the economy looks like then. So there's a lot of unknowns here. And for many, that might be enough to keep them on the sidelines. For some, they love the uncertainty and they'll be jumping right in.
Yeah, that's a good point. And even more concerning than I would say sports is the return to school is always when I bought shoes. No one buys shoes in the summer. You go barefoot in the summer, but obviously a concern for Foot Locker. But our next name, equally concerning on a year-to-date chart, that is Beyond Meat, down over 27% year-to-date. Actually up for this month, up about 1% for the month of March, but Piper Sandler downgraded Beyond to underweight from neutral, lowering its price target to $50 a share from $59. Now, they pointed to increased competition for plant-based meat substitutes and also lowered their expectations for the impact of a nationwide McDonald's McPlant launch, saying the offering continues to burn cash with no clear signs of a path to positive EBITDA. Now, this name has been all over the place. Its 52-week range sits between $35 a share and $160. So volatility has definitely been I would say not a stranger to Beyond Meat, Alex, but we do know that shares are reacting pretty negatively today, down over 3%.
Yeah, and so where I'll compare and contrast this to, let's say, Foot Locker is down the line, whether it's Beyond Meat, one of its peers, maybe a company we don't even know yet, there's this anticipation that this is going to be a market. In the case of Foot Locker, there's doubters whether or not the in-mall store that sells shoes is just going to be cut out of the equation. And so I think that's where some of the negativity that weighs on Foot Locker for many would be enough to keep them on the sidelines. It's like, what am I investing in? What is the upside here? Where on Beyond Meat's case, if you believe in the meat alternatives, if you believe in Beyond Meat's position in that, maybe you have something to look forward to down the line. At least that's how I think some would pitch this idea. We'll talk more about it on the technical front as well. This is the final upvote for us.
Yeah, the plant-based meat trend. And I've seen a lot of flack on Twitter and social media about people eating lentils and bugs when meat prices have gotten so high. So also an upvote for me, as I think this is a very interesting conversation. But to tell us more on both of our upvotes today, those being Micron as well as Beyond Meat, is Rick Ducat, TD Ameritrade Network contributor. Rick, good morning to you, or good afternoon, I guess. We will start things off for this week with Micron ahead of their earnings. A ton of volume in this name, but some weakness, and this is nothing new for a lot of these chip and semi makers.
Yeah, and this one, for how much it's moved around since the last earnings, the actual net change is only about minus 3% since December 20th. So really a lot of chop and not a lot of actual directional movement overall. But I did see an interesting trade in this name. If we could pull up our risk profile, about 120 options traded today, about 70% of them were to the call side. And looking at this trade, we saw one trader in the May 20th expiration series sold 500 each of the 50, 47.5, and 45 strike puts for a 51-cent credit. So kind of giving us this unusual curved downward side to the point at which you'd be exercised on these trades. Max profit of about 25,000. Kind of an interesting way to take advantage. Consider also that we're trading at about 78 right now, so these are very far to the downside.
Yeah, possibly a little bit of a share accumulation, the idea behind that if you did get a big move lower in the stock. And if not, we'll take our credit, we'll move on, is maybe the thought process there. Given the size, maybe a little bit more of an institutional type of a trade there. But talk to me a little bit about Beyond Meat. Anything else similar sticking out to you?
Well, I mean, Beyond Meat or bugs, I'm not really sure which I'd choose. But the stock is down about 70% since those yearly highs. And this has been really, there's no other way to slice it, just a really rough chart to deal with. But I have another risk profile for us to take a look at. Of the 30,000 options traded, about 55% were puts today. And this trade was a risk reversal spread. So buying 536 April 1st, 48.5 calls, and selling the same number of the 42.5 puts for a 114 net debit. So this gives us a bit of a cushion here if prices go down, while giving us a long exposure to the stock as well.
Rick, and fun fact, I have eaten bugs and I eat Beyond Meat, so I think I'm perfectly positioned for any inflationary measures that are weighing on meat prices, as I have lots of different alternatives. But we will dive more into the technicals on both Micron as well as Beyond Meat coming up next. Rick will be sticking around. Alex and myself will be right back with Next Gen Investing.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo Webcast Series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
After the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
Welcome back to Next Gen Investing. Mouse Coffee alongside Jenny Horn. We're still joined as well by TD Ameritrade Network contributor and charting specialist Rick Ducat. We'll look through a couple upvotes. Very different companies, very much a part of the inflation story, though. Jenny, we got Micron, a pre-earnings look, and Beyond Meat just can't seem to catch a break.
Yes, I would say things look maybe a little bit more positive for Micron ahead of their report, but it's all relative. I mean, this is a name that has seen a good degree of weakness despite the fact that it is well established and it's been in the public markets just a lot longer than Beyond. So, Rick, from a technical standpoint, help us out here with the technicals, because I do think the tech earnings this season have been very, very difficult to predict and very unforgiving is what we've seen in terms of reactions from the street.
Yeah, it's kind of a mixed picture here, too, in terms of the price action. Like I said, it's been very choppy prices, jumping from one extreme to the other one. More recently, though, within the past few weeks, it looks like we're in a little bit of a holding pattern since this big gap up. So starting with point A, we put in some recent lows near the 69 level, so we have a trend line to work with now, as well as a support point. That purple line off of those lows from October is the first thing I would look at here. And I want to caution to people too, I would not say we're in an uptrend in this name at all. It's more that we are in a relative uptrend from that point. But looking much more recently, look at those white dotted lines there that I put a channel in. Still making lower highs and lower lows, really not showing a lot of strength or follow through yet. So next thing, looking at point B, price sort of tested the upside of our pink 252-day exponential moving average. And once again, this is a moving average that places greater weight on the more recent prices rather than a simple moving average, which is equally weighted. So it helps kind of eliminate some of the lag here. But price was not able to really crack above that one, nor was it able to get above the 21-day exponential moving average in yellow there. So we've got two kind of key points there for possible resistance just above where we are now, between maybe 79 to 81 or so. 81 level representing some lows that we saw during the winter times, as well as our recent high. So finally, looking at point C, we had a bullish crossover in the MACD, our moving average convergence divergence, which compares two specially constructed moving averages. And it was showing a bullish crossover, but it's really not, once again, showing a lot of follow through here.
Okay, so great takeaways from that, Rick. Really don't say it's in a clear uptrend, as we can see from the chart, but we are starting to see some signs of maybe normalization. We are even seeing the shares, I would say, start to rebound a little bit even on the day, but I would be a little bit cautious saying it's anything. I mean, we're in a rebound yet, obviously. But Alex, when trading this name, obviously we have this major catalyst being that earnings event Tuesday afternoon, so something to consider, as well as the fact that Rick sort of outlined these key price levels, those being 69, 81, and 83. So pretty positive price levels considering shares are trading right now about $78.
Yeah, and so I wanted to take some of that into account in terms of maybe there's going to be a bit of a trouble getting much higher on the charting basis. Combine that with what the analyst from JP Morgan said in terms of maybe expect an inline report coming in line with their guidance. Maybe there's just not a whole lot here with this report. And so following that logic, I went out to April's monthlies, give ourselves a few weeks of expiration, and we're selling the 76.73 put vertical for about $1. And so in this case, our break even would be 75. We have $200 in risk to make $100. And it's one that stands to profit in the event that the stock kind of just goes nowhere and time passes. Of course, best case scenario would be a rally higher, as it is a neutral to bullish strategy. It would reduce potentially the price of this spread and give us an opportunity to maybe buy this back early. But really with this one, we're just more taking a position that the stock stays above 76 through expiration. So neutral to bullish, as you talked about, still a lot of reasons why this particular industry has been a little bit more resilient. But of course, risks do factor in, and that's why it's risk defined. If it does fall sharply lower, we can only lose $200 in this particular case if the stock's below 73 at expiration.
And some degree of cushion that, say, if you thought the stock was going to be a rocket higher, which would be absolutely, I would say, interesting to say the very least, but obviously a neutral bullish strategy, we do have, some degree of cushion there. But now our next name today is Beyond Meat. And Rick, you know, I've been an advocate for this name because I don't eat meat, but I have to say that we got this analyst note today from Piper Sandler, and I actually saw the headline that said something like, is the MIC plant a MIC failure? And in Beyond's defense, they've only launched in select markets. This is not a widespread rollout yet, so I don't know how you could call it a failure yet. Maybe I'm just selfishly hoping that it rolls out to Chicago still, but I do know the technicals in this name have been pretty brutal, so all personal bias aside, tell us what you've got from the chart perspective.
Just my unbiased, look at this chart is pretty bad. Like independent of what the product is or anything, a long downward sloping channel for that long is never really a good sign for bulls. So that's kind of where we've been at for most of the past year. And starting with point A, that was the most recent bottom that we put in near the 36 level. Prices fit pretty cleanly within this channel, except for just recently, within the past couple weeks, we started to break above that upper line of the channel to the upside here. So point B is where we're at right now. We did break above that yellow 21-day exponential moving average for a short time. We're starting to give it back today, though. We're at a green candle, but we're still a little bit below it, maybe about 50 cents below. That's not a great sign. Watch for where it closes. If we have a close below it, that would be more typically regarded as a bearish sign. So it looks like we could even retest that upper level of our channel. Old resistance can become new support and vice versa. So a test of a breakout level, once again, is not really uncommon. It's something you should always be on the lookout for in a situation like this. And looking at our moving averages themselves, they're still pointing downward to sideways. The longer term ones are still sloping downward, so that's a sign that the overall trend is still looking more toward the bearish side. Finally, point C, once again, we had a bullish MACD crossover, but once again as well, not really a lot of follow through, and it's starting to wane a little bit here. It's looking like the momentum is really slowing down within the past couple days. So keep your eye on this one. Our price targets to keep an eye on would be 36 to the downside, 51 to the upside. And I should not price targets, areas of interest, let's say.
So momentum is slowing, Rick. We're also seeing this pretty sizable downtrend. Things are not looking so great. But if you follow this name, this is not news, as can't really seem to catch a break so far this year. But as always, thank you for your unbiased insights, Rick Ducat, TD Ameritrade Network contributor. So Alex, when you're looking at this name, you mentioned that people oftentimes invest with the potential of maybe a larger plant alternative market. However, I have to say that even going against myself, the more bearish case is that if we haven't seen this adoption yet, will we ever see it?
Yeah, exactly right. And I keep getting caught up in the McDonald's situation. Those who eat at McDonald's regularly probably don't eat plant-based food, and those who eat plant-based food probably don't eat at McDonald's. So was that just a massive swing and a miss in terms of just thinking things through? But time will tell. Of course, I don't have an opinion on that. I'm just trying to think about it out loud. My thought on Beyond is almost exactly the opposite of what really successful tech firms have done. Really successful tech firms in the public market have notoriously under-promised and then over-delivered when it comes to quarterly earnings and things of that nature. A company like Beyond early on set the stage for this world-changing marketplace that they were going to deliver to, and have consistently under-delivered to that. So they over-promised in many ways, overhyped their business, and then actually delivered and underperformed just really for years and years and years now. And so I look at this situation and I say, we're not even taking into account that there's countless new entrants into this space now. They just simply haven't lived up to the expectations. And until something notably changes there, you saw the trend that Rick had talked about. I think many investors probably don't have a lot of confidence in this particular name, so I want to talk through a neutral to bearish strategy in this particular company. And so going out to May, so a little bit over a month away, selling the 55.60 call vertical, so we have $8 in cushion, collecting a little bit over $1.25. Our break even at expiration would be 56.25. Neutral to bearish, $375 in risk. All we need this to do is not breach 55 by May 20th, or on May 20th, I should rather say, and this would expire entirely worthless, more than likely, and we would capture that credit and move on. If it does rally or stage a comeback, we're risk defined, so that's important as well.
A neutral to bearish trade, as you can see, again, you just mentioned being risk defined, obviously preparing for, say, maybe an upside scenario, but also preparing to capitalize on a downward scenario. And I just have to say that I think that what the McDonald's, the attempt was, I think just the wide scale. There's McDonald's absolutely everywhere. There's like 2 within walking distance of actually where I live. There's like 4 in the airport. So I think it was just more of a wide mass adoption was the goal, but it doesn't seem like at least the analyst community thinks so positively, so they might agree with you, Alex. But that does it for this segment. Now, coming up next, we will switch gears. We will be talking Matson, that's ticker symbol MATX, and really discuss how the transportation stocks and industrials, what they could mean for the broader economy.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
90 minutes after the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Time for FOMO. Welcome back to Next Gen Investing. I'm Alex Coffey alongside Jenny Horn. Jenny, we're talking Matson today, symbol MATX, but this is really part of a greater, larger story, which is that of the transportation industry. So we hear all about fuel costs, of course, and so that's going to spill over into this, but we hear about materials prices. Well, that kind of spills, this is part of that story as well. So not only are goods going up, but the cost to move those goods is going up. And therefore, ultimately, in the end, we're still paying more. So it's not as simple as, the liquid in terms of crude oil or natural gas, whatever it be that we use to generate power and energy is going up. So that's the only input cost. It spills down all these different levels during the supply chain and the movement. And every time, that's a cost that's passed on to the next person, passed on to the next person, passed on to the next person, if they seek to be at least as profitable as they were before.
Yeah, that's a really good point, because I've had friends that have said to me, Jenny, you're so lucky you don't have a car. Gas prices are so expensive. And I'm like, well, in some ways, pretty much every consumer is being affected by the rising fuel costs, whether you know it or not. It's just the awareness of the way supply chain works, Alex, like you just pointed out. But I did want to start off this week on a positive note, which I know that the shares are slightly unchanged or lower today, but this is, I believe, a positive story in terms of the macro economy. Now, Matson is a Honolulu-based industrials company that operates through its logistics and ocean transport segments. It's actually one of the best performers of the Dow Transports Index this year, which has fallen only about 3.8% from their November high, which is much better than a lot of the other major indices and equities have performed since reaching those December highs. Matson itself is up 35% year to date, up about 10% this month. So seeing a ton of strength. It's very difficult to find actually companies that are performing as well on a year-to-date basis. But what we do know is that transportation stocks have been outperforming, showing really optimism over the economy's strength that could fuel any hopes of a rebound. Now, companies that operate these trains, planes, boats, and trucks tend to see things improve when, of course, a growing economy increases their demand for goods, materials, as well as travel. So for that reason, some investors oftentimes look towards these transportation stocks as a barometer for the overall commercial environment and really the health of the industry. So this month, the Dow Jones Transportation Average has jumped over 7% as of Friday's close, outperforming the major indices. We also see that strength is really showing how some of the U.S. economy will handle the Fed's rising interest rates, which is a discussion we've had timelessly over the last several weeks. And several analysts have pointed to the converging of yields on a shorter term and long-term bonds as sort of a sign the bond market has been forecasting this recession. However, there is a very mixed feeling from the analyst community when you look at the transports. Actually, a State Street Global Advisor chief investment analyst said this shows that the U.S. economy is actually more resilient or on firmer footing than people have been giving it credit for, pointing to names like not only Matson, but also Avis Budget, Kirby, and Union Pacific, as freight has historically been some sort of indication of maybe things starting to pick back up again. Now, Alex, a lot of this is speculative, but that is sort of the discussion we often have on this FOMO segment of, where do you buy in that you don't necessarily miss the boat, no pun intended. And things are looking, at least from this specific industry, I'd say more positive. So I liked this discussion because you do see a lot of fears and a lot of concerns and just headlines that are very negative when this seems to still be a bright spot in the overall economy.
Yeah, and I would say, if you looked at only one single variable and you simply just saw, transportation industry is outperforming, that must mean that economic activity is doing good. And the question would be then, are these companies doing better because, one, they're needed? If I can't do my core business without moving the goods around, I have to pay whatever it costs. And they have pricing power within this industry. And now it's just a greater percentage of the costs for these manufacturers or whoever would be their customers. And so that's where I'm getting caught up here in terms of just because these companies are doing good, does that necessarily mean that the economy is doing good, or is it in fact the opposite? Is it that these companies are doing good because they're charging more, because they're passing their costs on, and if you're the one of their customers, you really have no choice but to pay it? That doesn't mean that this stock and its peers can't outperform for the near term in spite of all this uncertainty, because whether or not they're passing their costs on or they're just getting more customers or both ultimately still benefit this company, and we don't necessarily need to know ultimately where the economy is going if our trade is short-term enough that it won't really matter. And so in this particular case, I went out to April for an example trade here, Jenny, buying the 115 call, which is slightly in the money, selling the 130 call for a 750 debit. The idea here was it's a $15 wide spread. We're risking one or 750 to make 750 with a break even that's pretty close to where the stock's trading right now. So 122.50 when the stock's at 121.54. It might even be trading for less now as the stock has moved lower, but it's a bullish strategy. Best case would be this rally continues through 130, where we could stand and make 750. If it falls below 115, we could lose 750. So you're kind of limited in terms of strike selection here with this name. Expirations are only monthly. It's not as widely traded, but it's a long-standing company, specializes in freight across the ocean. And while its costs may be rising based off its stock's performance and where it fits in terms of the economy, it's likely for now been able to pass those costs on. Therefore, it's sort of insulated from these margin pressures that so many others are facing. And therefore, maybe for the near term, the thesis would be that it could continue to outperform.
And you made a really good point. Obviously, it's far too difficult to predict, a recession or a rebound. I would say that is not at all what I was trying to say. It's more the fact that, say, you look at this name, look at its performance this year and say, how can I get involved in a name that's insulated, like you pointed out? Because it's too much, I would say, too challenging to try to be the market maker. But I think to follow these trends and to see how you could really utilize to your best benefit is something that we oftentimes discuss, which is where a name like Matson up 35% fits in. But that does it for this segment today. Alex, coming up next, we will talk Lululemon, a conversation I am very excited to have ahead of their earnings, which are due tomorrow afternoon.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network. Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our portfolio management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position?
You two are all set.
Choose the app that fits your investing style.
Welcome back to Next Gen Investing. I am Jenny Horn alongside Alex Coffey, and we are now also joined by Caroline Woods, TD Ameritrade Network contributor, to help us preview and break down some expectations for Lululemon ahead of their report, which is due tomorrow afternoon. Now, we oftentimes say that Nike is the end of earnings season. Caroline, I have said timelessly, it's actually Lululemon, but we did get somewhat of a mixed bag from Nike, initially actually seeing a very positive reaction. Then the next day, they gave back some of their gains. So what is the analyst community expecting for Lululemon? I have to say, anecdotally, I just bought their new shoes, which will not be included in this earnings season, obviously, but I'm very excited.
I was actually wondering if they would have hooked you in with those Blissfeel sneakers. I know you're a runner. But in terms of Lululemon, they already kind of gave a downbeat outlook back in early January, saying that earnings and revenue would be at the low end of a range. So in terms of expectations, earnings per share are expected to come in at $3.27 on revenue of $2.13 billion. I mean, Lululemon is a stock that has seen tremendous growth, especially during the pandemic, really benefited from that stay-at-home and yoga pants trend, although we are starting to see revenue growth slow, so still growth, but it's slowing. Lululemon was hit by Omicron, supply chain problems, staff shortages last quarter, like so many other retailers, which is why they came out with kind of that downbeat forecast. So we'll see how those ultimately ended up hurting the company. And then when it gives its outlook, if it gives an outlook, considering aside from Omicron for the most part, that those headwinds still exist, how that will impact business going forward. Also get a sense of how business in China is doing, because that area obviously still does have that uptick in COVID cases, renewed lockdowns. We know it's a growth area for Lululemon. And also, you know, we've talked about that potential shift from international brands to more domestic brands in China. It didn't seem to have an impact on Nike, its competitor. They saw notable growth in China, but let's see what Lululemon says. And also, as you mentioned, it won't be included in these Q4 numbers, the holiday quarter, but the Blissfeel running shoe, priced at $148, just hit stores last week, so maybe they'll give some early updates in terms of how that's performing. They're attempting to lure customers in with a 30-day trial period. You can return those sneakers back in any condition, they're saying. So, Jenny, I don't know if that actually did lure you in, but Jefferies did warn that it could be an attractive revenue generator, but it won't be good for margins, and it could be a distraction from its core business. So analysts kind of mixed on the impact of its new sneakers. I'm an on sneaker girl, so I don't know that I'll stick with the Align leggings, but not switching over to the sneakers.
Caroline, I'm wondering here as a bystander, and I've long said I think this company is missing a major market within kind of the male apparel, men's apparel, that they need to be sponsoring some type of a big golfer or something and getting this out there and reaching a whole new crowd, because I know so many people that are wearing their stuff for those type of activities. But I'm not going there with the question. My question to you, Caroline, is we hear all this stuff about inflation and costs rising, and naturally, if our wages, on the balance aren't going to keep, pace with that, we're going to probably cut back on discretionary spending if we're not willing to go into, some type of debt. Do we start looking to the knockoff brands, or maybe the brands that don't have the luster of a name like Lululemon, which is historically perceived as higher quality, but also higher price point? Do some of its lower priced peers that have largely just copied the concept but don't carry that brand recognition start to steal the spotlight?
Lululemon certainly has that strong brand recognition. I know there are some pretty good dupes on Amazon for a third of the price, but I mean, that's the question I think heading into this report. Basically, with gas prices high, food prices high, will consumers, sentiment is waning, but we haven't seen it hit demand yet. Mm-hmm. But at what point do we start to, and will companies like Lululemon be the ones to suffer? I mean, anecdotally, I'm hearing of stories of lines outside of the Rolex store and outside of the Hermes store. So, or Hermes, I should say. But it's, so clearly for the luxury segment, there's still very much demand. I will say that I did see some price target cuts heading into this report, which is tomorrow after the bell. MKM cut last week to $438 from $481, but maintains a buy rating. Meanwhile, Deutsche Bank slashed to $410 from $453. Also a buy rating. Lululemon currently trades around $326, so still a lot of upside. And the majority of analysts still do have a buy rating at this point. 22 buys, 10 holds, and only 1 sell. Although keep in mind, Lululemon is down some 16% year to date, even more if you go out over the past 6 months. Now, earlier this month, Bernstein initiated coverage on Lulu with an underperform rating and a $260 price target. She warned about slower growth, but also called Lululemon's products pricey. So that has something to do with that bearish call from Bernstein, or also cautious about Lululemon entering the sneaker market. So there's kind of both sides there, but it did stand out that she specifically called those products pricey, which we know they're not necessarily affordable or low budget. But there is something to be said about that Lululemon brand, that logo that people seem to love, and many would say quality products. So I guess it's just kind of, we'll have to wait and see, especially with what Lulu says about their outlook on the earnings call.
Yeah, Caroline, you make a really good point. As prices continue to surge, and gas being obviously the biggest concern, can you afford to go to Lululemon anymore? And I will agree that the Align leggings, I don't think there's anything else like them, but can I afford to splurge at Lululemon if everything else is more expensive? I'm not really sure, and I don't really know how people...
And they last a long time, so you don't necessarily have to replace them as often as maybe Lululemon would like.
Yes, and they have a great return policy. If you ever have anything wrong, they take them back. I can't give a full report yet on the shoes because I haven't gotten them yet. They arrive actually tomorrow, but I will run and I will give a full report back because I am very excited to try and hopefully not be disappointed. But Caroline, thank you so much for your insight as always. That is Caroline Woods, TD Ameritrade Network contributor. Now, coming up next, we will talk all things pot stock, specifically Canopy Growth, seeing some weakness today after what was a pretty stellar session on Friday. We'll dive more into the legalization or potential legalization in this space coming up next.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then watch list. When the default list appears, select the name box, then create watch list. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watch list, then select save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then add to watch list. From the Scan tab, right-click a security and then add to watch list. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
I'm Maria Schrader. Here are a few stories to watch this hour. Gordon Haskett lowered Lowe's price target to $255 from $285 with a buy rating on shares. The analyst thinks March traffic trends are a bit concerning in home improvement. The rise in interest rates also makes premium valuations for the home improvement sector harder to justify. Daiwa initiated coverage of Roblox with an outperform rating and $56 price target, saying while its competition remains quite strong, its addressable market is growing. The analyst says Roblox is a lock on hard-to-reach users under the age of 13. He thinks the mobile gaming market can grow in the early teens range, and the metaverse can grow nearly triple digits. And Loop Capital lowered Pinterest's price target to $34 from $50 and kept a buy rating on shares. The analyst thinks user growth trends may not improve until late 2022, but there is a strong pipeline for higher monetization as it integrates shopping further and shopping becomes a bigger slice of user activity. This has been your TD Ameritrade Network Market Update. Now back to Next Gen Investing with Alex Coffey and Jenny Horn.
Thank you, Maria. Welcome back to Next Gen Investing on this Monday now afternoon. Just over 2 hours to the closing bell, and it's now time for Under 30. Alex Coffey alongside Jenny Horn. Jenny, we're talking some cannabis. We're specifically focusing on Canopy Growth, and these names alongside so many of the forgotten assets. The meme stocks came back to life. Cannabis came back to life. Crypto came back to life. Tesla came back to life. What do these all have in common? Are they all just short volatility trades? I don't know. There's certainly more to this story, though, with the rumblings of possible federal legalization again coming on the docket.
Yeah, with the surge of these meme stocks over the last week, I'd say we're back in like 2020, 2021. But these pot stocks, I feel like we're back in like 2016. So I do think the resurgence of these names has been quite interesting. And like Alex mentioned, on the hopes of federal legalization. But to tell us more on these names and Canopy growth is Jeff Pierce, TD Ameritrade Network contributor. So Jeff, my biggest question is, because I've read a lot about this bill and that there's the concern, obviously it goes to the Senate and it doesn't pass, and this is the second time this has happened, is we initially saw such strength in these names. You know, all of these names jumped. We saw Tilray up 40% for the week. But was it all on false hope? Because if this bill just gets shot down, do these names just continue extending their losses?
Well, we know these stocks are not immune to volatility, right? We've certainly seen that among their names. It may be a bit of a buy the rumor, sell the news situation for people that are holding on to it. I would imagine if they're still concerned it's not going to go through the Senate, they're at least hopeful that a push forward on the bill could take a closer look at some of the various aspects beyond just legalization, right? You think about banks, for example, and their abilities to do business with cannabis companies. We look at a company specifically like CGC. We know that they've been losing money. Third quarter, they had a net loss narrowed at about 108 million Canadian dollars. That's down from 904 million, but in line with expectations. Net revenue down 8% year over year. What these companies are doing that we've noticed a lot over the last few years, as you said, we've been talking about them for 5-6 years now, at least, is we're seeing a lot more M&A activity. We're watching these companies buy each other up as kind of the hopes of legalization, especially in the U.S., continue to kind of come up each year. But we're also watching them try to spend less money, and that's been a major benefactor for some of these companies that have been in there tightening up their expenses. If we look at Canopy last quarter, their expenses declined by 19% year over year, largely due to these reductions. And certainly they are seeing some new revenue streams. Think about some of the drink options out there, the vaping options, that sort of thing. That's offsetting some of the decline that they're seeing in Canadian cannabis sales, which is helpful for some of these bigger names.
Jeff, I think a lot of the possible, combination of these names, of course, the devaluation that we've seen in some of the prices, is all ultimately, if these companies are going to succeed in their goals, probably long-term beneficial. When they're trading at 100 times what they currently are now, there's really no price, there's really nothing they can do to ever merit that valuation. They were put in a tough spot. And so now things are a little bit maybe more realistic for a long-term future. But my question to you is, are we kind of conveniently explaining this rally that we've seen because there was news, when rather it just was a kind of convenient coincidence? I look at some of those other asset classes that I talked about, meme stocks, volatility cratering, Tesla resurging, crypto resurging, and now I look at cannabis stocks resurging. Is this just animal spirits doing what they do best and finding risk where they can take it?
Well, anytime we hear some news, especially around legalization, typically you're going to see some movement in these stocks. And certainly there are some investors that are hopeful that this is, the big news that they've been waiting for years to come. Other investors are looking at it and thinking, this may not be the time that we see that legalization. But what we're watching investors do and hold on to is that long-term hope that they see legalization and they see this market come to what they expect it to be. And that's another question, right, is how big is the addressable market here in the U.S.? There's a lot of estimations thrown out. We don't necessarily know. One of the things that sets Canopy aside from some of the other in the group is their connection to Constellation Brands, right? They've had a stake in them since 2017. They've invested about $4 billion. They've got about 38% ownership. They do have outstanding warrants that could get them even more ownership, up to about 53% stake in the company. So far, since their 2017 investment, Constellation's lost about $424 million on Canopy, but they've continued to be invested in them. And obviously, like a lot of investors out there, it's because their hope is in this future where we do see legalization and we see this big addressable market. And some of these names right now that we're seeing take over in these acquisitions, they're really trying to get a foothold in that market. They want to have the biggest possible share. We think about back when Canopy announced to acquire Acreage Holdings, they paid $300 million up front. They also said it was about a $3.4 billion deal at the time, but the agreement depended on cannabis being legalized. So there are a lot of different moving parts a lot of expectations that are built in this market. Seeing news like this can move a market that's entirely built on expectation.
Yeah, and Jeff, you have to applaud those investors because it's taken a good degree of patience to wait for any hopes of legalization. I mean, we're still only in the beginning phases, I feel like, as this bill is expected, from what I've gathered from the analyst community, to not pass in the Senate. But an interesting discussion in the pot stocks nonetheless. Jeff Pierce, thank you so much for joining us. And Alex, we are still seeing the NASDAQ holding on to those gains, but just barely now.
Yeah, and the last thought I want to say here is those investments by like alcohol companies in many cases, don't think of them necessarily as offensive investments, but rather defensive investments is what companies stand to lose the most. But that does it for us. Thanks as always for tuning in to Next Gen Investing. Mixed market continues. We got the watch list coming up next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then watch list. When the default list appears, select the name box, then create watch list. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watch list, then select save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then add to watch list. From the Scan tab, right-click a security and then add to watch list. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes
Oh,
to
wow, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. Ah, they're getting so smart.
Choose the app that fits your investing style.
Good afternoon and welcome to the Watch List live from the New York Stock Exchange. Our very first day Here we are on the corner of Wall and Broad, and we're so excited to really have our footprint here right on the floor of the New York Stock Exchange. We have a great show for you. Let's take a look at the markets. You can see right now a mixed bag, with the NASDAQ being the only gainer of about 0.6% at 14,845. Those tech stocks. The Dow and the S&P with down arrows. The Dow is down 166 points, 34,694. The S&P down just fractionally at 45.41, and the Russell losing about 0.75%. So the small caps under pressure. Of course, we did have 2 weeks of gains for the Dow, S&P, and the NASDAQ. In today's top story, we're looking at Bitcoin prices. Those have surged. We've been watching it above, actually close to 48,000. So this is a new high for 2022, experiencing a late rally on Sunday night when it passed over 45,000, erasing the losses for the year. The digital currency has been on an uptrend since Friday and gaining almost 7% since then. Take a look at some of the top stories. Ben Lichtenstein is with us, host of Futures on the TD Ameritrade Network, to give us an update on what he's watching closely and what's causing the move and the technicals. You tell us, Ben.
Hey, Nicole. Good afternoon. As you mentioned, Bitcoin is rallying, on the move higher today, and not just rallying and on the move higher, but actually breaking out of a range that we've been stuck in since January. Again, the bid coming into play this morning, overnight for the most part, and really no rejection of. We're currently holding at 47,800. We're talking some $10,000 off the March lows. Let's just take a look at the move up that we've seen just over the last week, and you can see in this instance from 40,000 up to 48,000. Now, we're really kind of tying this to some of the kind of overall legitimacy that Bitcoin's been experiencing recently. Last week, Chair of Russia's Duma Committee on Energy said for friendly countries such as China or Turkey, Russia's willing to be a bit more flexible with their payment options for oil, suggesting basically that they'd be willing to accept Bitcoin for some of those oil energy purchases. And again, as I mentioned here, while we're up 7% on the day, I just wanted to point out, take a look at the move that we've seen, again, off the all-time highs, 69,000 recently down to 34,000-ish, we'll call it, around that 30,000 level for the most part. We kind of double bottomed here, so we've been in a bit of a range, but you can see, again, the gap up here, the breakout, and as mentioned, back to levels we haven't seen since January of this year, so a 3-month high. Now, really shrugging off the Federal Reserve Governor Christopher Waller's comments. I don't know if you heard, but he said it's not a payment instrument at all. He called it electronic gold. He equated cryptocurrencies to Bitcoin, basically equated it to baseball cards or art, for that matter. He said they're intrinsically useless, that people pay a lot of money for these things. They hold on to them. They think they can sell it later for the money back or more. But again, basically kind of shooting it down. I do want to point out that as you take a look, Bitcoin's back above the 50-day moving average as of a couple weeks now. So this is going to be interesting to watch here. Also, that kind of risk-on sentiment often tied to this, but it's interesting because we've been watching rates spike. That sparked some growth concerns, and the indices have been kind of just treading water today for the most part, holding near the March highs. So something to keep an eye on. But yeah, I think this legitimacy tied to just basically some of the usage and Russia's comments recently are all kind of giving a little bit of a lift.
Right, and since you mentioned rates, I want to touch on that, right? We see the 10-year at 2.5%. We're watching both the 5-year, 30-year, the Treasury yields, that inversion, right? You have to see where is it the 210 inversion, and that's key. That's what people watch to really give you the signal of whether or not a recession may be looming, right? This at the same time, while Citi has said the next 4 meetings of the Fed, 50 bips every meeting. And we have to wonder, how is this all going to play out? What are your thoughts on what you're seeing in the treasuries?
Well, I think those, Nicole, are some of the concerns that investors and traders are expressing basically since the beginning of the year. You know, we talk about the geopolitical tensions right now between Russia and Ukraine, and that kind of adding to some of that unease. But this market started coming off, if you remember, back in the beginning of the year, where we topped out as rates started to rise, and it's really the rate of the rise that we've seen, the acceleration recently that has investors concerned. Take a look at the futures. This is the flip side to rates, and I'll show you what's got them on the move higher. Again, futures selling off. This is the bonds, but take note, the longer dated, not the only one that's been on the move. In fact, we're going the bonds top left, the 30, and to the 10-year in the top right. I've got the 5-year in the bottom left corner, the 2-year in the bottom right. You can see all four have been and continue to be trending lower. coming off the Sunday night lows, but those were multi-month, multi-year lows in many instances. You can see here now rates again. So Treasuries to the downside means rates are on the move higher. Look at the FDX, the shorter end up to 2.5%. I've been watching that 2-year, which has just been on a tear. I mean, really, the short end has been leading for the most part, but now we're starting to see the longer end start to play catch up a little bit. You mentioned the yield curve inverting, signaling a recession's on its way. There's been some debate about that, and it is a pretty good predictor of, but again, it's not necessarily always meaning that that's what's going to happen necessarily. But here you can see again that shorter end, in this instance, the 5-year and the candles really taking off over the last couple days, few days for that matter. And as you mentioned, inverting, here's another way of looking at that. We saw it go negative here. We've seen the curve flattening quite a bit. This is the 30-year versus the 5 we're looking at here. And yeah, again, once you see it negative, it does spark some of those recession concerns. We've heard a lot about stagflation. I mean, I think it all factors in when you have Shanghai on lockdown, some 25 million people, Nicole. I mean, the bad fundamentals that have been weighing on the market, investor sentiment in general, haven't gone away at this point. And add into it commodities, crude oil above $100. I mean, quite the mix, to say the least, to begin the week.
Oh, without a doubt. We're kicking off a very exciting week. Thank you so much, Ben Lichtenstein. Nice to see you. Thanks. Well, as we said, we are here live at the New York Stock Exchange, and what a great way to commemorate our first watch list show here. We have a special guest for you. And joining us is Mark Bell. He is CEO of Terran Orbital. He is, I mean, you could call him a space entrepreneur. He's certainly my favorite Trekkie. I will say that without a doubt. Congratulations on the listing today, Mark. I'm glad you're here with us. Thank you for being here. How was the day? How was the opening bell? I saw you there.
Oh, it's very exciting. It's really great to be here and ring an opening bell and to see us start trading. You know?
I think this is when we think about what's going on here, right? You're in the most iconic place, but you've had a whole lifetime. I mean, in addition to launching so many unicorns and being the CEO of different companies and having your hand, you have 2 Tonys, a Pulitzer, Grammy, award winning, and yet space was your true love. And that's why we were saying you're a Trekkie. And so this, having satellites and building, I was reading, more than 1,000 satellites in a year. Is that the goal? Tell me a little bit about that.
Yep, so we're building a facility we'll be able to manufacture over 1,000 satellites a year. That's just in Florida, not including our facilities in California. And this really is a Trekkie's dream come true. I am living the dream as a child that I had as a child. It's very exciting.
And you have your pin on, and the ticker symbol is LLAP. What does it stand for, Mark?
Live long and prosper.
See? I mean, I think that's so exciting. This is only the beginning for Terran Orbital. I saw the huge signage you have there in the middle of Times Square. Why now? Why was this the right time to have this IPO and to begin this venture?
So we needed capital. We realized that people are finally understanding what you can do from space, and the price of launch has come down, and the cost of satellites because of us has come down. So that those 2 things combined made it affordable for both companies and governments to do things in space that you could never have done before.
And so you have, and you're working so closely with NASA, with the U.S. military. I saw, others as well. Tell me about some of the partnerships and some of your goals for the company.
So we're very lucky. We work a lot with Lockheed Martin. We have a strategic cooperation agreement with them that goes into 2030. So we build satellites for them up to 500 kilograms. We have some very exciting missions going to the moon soon. One's called Capstone, where we're going to be helping build the first communication systems at the moon, and Loon IR that'll launch on the new Artemis rocket that's coming up, where we're going to be helping to map the moon. And we do a lot of fun stuff, and we build imaging satellites and synthetic optical radar satellites where you can image at night or through clouds, but even 5G or internet things. So we build satellites for everybody, and that's what makes it so exciting.
And you're not a competitor. What I was reading, you're not a competitor to SpaceX and Blue Origin. On the contrary, you're trying to work with them and grow what is to be, gathering all the most important data, right?
Right. So SpaceX is a great example. So we're a customer of SpaceX. Hopefully one day we'll be a customer of Blue Origin. But SpaceX's ride shares and the ability to lower the cost of getting satellites into space has helped this industry blossom.
So are you going to go into space?
I hope so. I like to. I'd like to go up on Virgin Galactic. I think it would be fun to do, and just to do it once in your life. And
What does it take to build these satellites? I mean, as you said, you had to raise capital. You founded this company back in 2013, I believe. What does it take to build the capital needed to reach the goals that you're setting for the next 5 or 10 years? As you said, you have a contract until 2030 with Lockheed Martin.
So we were very lucky that myself and my partners put up most of the capital in the beginning. And so we funded it ourselves because we knew what the future really held. And people ask you, are we sticking around? And I said, look, we know why didn't we just sell to one of the big primes? Because we know what it's going to be worth in 5 years. And we know how big this market is exploding, the total addressable market's exploding. And so with the defense budgets going up, we're in the perfect place at the perfect time.
And so when I was seeing here, it said in 10 years, 50,000 satellites. I mean, is that a stat in general for what we're going to be seeing around the world? Because obviously you said you're going to be gathering data about the moon, but we're also just trying to gather data about what's happened on Earth. During COVID, for example, it's my understanding, pollution went down and things looked more clear from outer space. Is that right? I mean, what are some of the most interesting fun facts and things that are occurring that regular folks might understand?
So the 50,000 number actually came from the U.S. government. They said 50,000 satellites will be built over the next 10 years. And our view is somebody's got to build them.
Right.
And why can't it be us? And so we're one of the last independent manufacturers of small satellites in the U.S., which is really great. And our satellites can be used for everything from national security to climate change and monitoring glaciers, to monitoring rainforest deforestation. There's a lot of things that we could do from space that's just economical that you can't do from the Earth.
And then, as I'm thinking about it, I mean, you mentioned national security, and when I started to hear about Lockheed Martin, the U.S. military, I mean, at this point now, I mean, you must have a lot of proprietary information. I mean, information that other people don't have in order to build all of this. What kind of relationships do you need to create to have this kind of partnership?
We're very lucky that we work with some of the nation's brightest minds, Lawrence Livermore National Labs, MIT Lincoln Labs, Jet Propulsion Labs, on lots of projects. But we also try to do good. So, for example, we're helping the government of Ukraine to keep civilians out of harm's way by giving them data and imagery every day. And it's very important for us to not only protect the national interests, but to help others as well.
Yeah. And as a Trekkie, I mean, we got to go, but I saw your place with tell me just quickly, what were some of those cool pictures we were looking at?
Oh, I collect Star Trek memorabilia. It's fun. It's always been a passion, and it's I'm doing my dream job. So I couldn't be any happier.
Well, I met your lovely wife and your family, and may you all live long and prosper because you're doing good work for your business and for our nation, which we appreciate as well. Mark Bell, it's great to see you. Thank you for being on with us live from the New York Stock Exchange, Terran Orbital. Thanks, Mark.
Thank you.
All right, later this hour, we're going to be looking at a lot of things, including the inflationary pressure that's been causing investors to have some volatility, some jitters. Are they worried about stagflation? Lee Schneider will join us to discuss what she is seeing. And we'll preview Chewy. The earnings results are due out, and we'll check that out. And our expert panel is standing by to talk about the resurgence of those meme stocks. But coming up next, we're going to be watching Intel, AT&T. Lots of details there as well. Coming up.
Let's walk through charts, one of the most commonly used features on Thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting drawings, drawing tools, and then type of drawing. For symbol comparisons, select studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes to wait.
I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim Mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make Thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Welcome back. Let's take a look at the biggest movers in the market right now. A keen eye on Apple. Apple is lower after a report out of Japan that the company plans to cut the output of its iPhone SE by 20% next quarter due to weaker than expected demand. The report cites the war in Ukraine hindering demand in Europe and rising inflation impacting consumer spending overall. Tesla is higher after news that it is looking to split its stock and issue a dividend. The EV maker will ask its shareholders to authorize the issuance of additional shares at an upcoming meeting to perform the split. The last stock split was in August of 2020. Cowen downgrading Foot Locker to market perform from outperform. The analyst also cut its price target down to $34 from $42. The analyst is more cautious on the shoe retailer following inbound data into March regarding digital traffic and search trends. Gordon Haskett cut its price target on Lowe's to $255 from $285, but keeps a buy rating on shares with the rise in interest rates, particularly 30-year mortgage loans. He finds it harder to justify premium valuations in the home improvement space. We started off the show talking about the rise we've seen in Bitcoin. Here it is right now, 47,935. Gaining 7.4%. Let's get right now to James Locke, co-founder of Pool Lock Associates. James, thanks so much for being with us. So we have a lot of economic data. Obviously, we'll be getting jobs report on Friday, but a lot of earnings as well. What's been on your mind front and center here?
Yeah, biggest thing is definitely the Federal Reserve and those raising interest rates, and you guys are talking about it today. The question is, how is it going to happen? 10-year, where are we now? A little under 2.5. I mean, back in 2018, it was at 3.25. Fed funds was about 2.5. So we have a lot of room on the upside, kind of just to get back to 2018 levels, which is when the Fed had their kind of taper tantrum and started to cut again. So with those kind of goals in mind of, hey, that's where we were back pre-COVID. What are we seeing? Credit spreads between the 10-year and like the double B or triple Bs are even getting wider. And the market seems to be shaking this all off. The market seems to be shaking off bad news about Treasury spreads widening or Russia, Ukraine war issues. So the market's absorbing it well. So that's good. That's a good sign. And, maybe there's opportunity to jump in there. We always tell our clients, stick with the dividend stocks, things of that nature when the market isn't screaming ahead like it used to. But most importantly, we want to make sure the Fed makes small corrections. I know you were even talking about half-point jumps. I mean, that makes me a little nervous, but we'll see what the Fed does.
And so with that, we have to wait to see what the Fed does. I mean, we were talking about Citigroup saying 50 basis points at 4 meetings this year. So they seem to be very aggressive. I mean, does that seem too aggressive to you? That's a lot, is right. I mean, especially when we watch the 5-year, 30-year inversion, right? And that's not the 210 inversion, but still, I mean, that doesn't necessarily mean great things ahead. I mean, that could mean something like recession.
Yeah, inversion is always the front runner to recession. Now, no one is saying that, for sure yet, because it's not, like you said, it's not the 210.
Right.
But it is something that has to, we have to pay attention to. And I'm hoping that they're not as aggressive as Citi says. We want to make those small corrections a little at a time, because from where I sit, the Fed has avoided as many recessions as it might have created, right? So we want to keep things moving at a steady pace rather than making unforeseen jumps, because the stock market likes predictability, and that's good for everyone.
That's true. That's true. Why are names like Intel and AT&T on your radar?
Yeah, I mean, just with the chaos of semiconductors, it's good to hear Intel investing in the United States. And I mean, I just love that concept that we're going to be, creating our own semiconductors. And I know that's a ways off, so Intel's a bit more of a long-term play, but it's seen some recent upward move. And I think as soon as all of those semiconductors come online and we're kind of creating our own technology, it's going to be just a fantastic opportunity for Intel specifically. AT&T just announced last week the kind of spin-off. So that is starting off. You're going to get that kind of 1 share for every 4 of AT&T in the new Warner spin-off. Both companies are run well. I know, it's hard to love AT&T right now with it, down so far, but once the spin-off happens, you're getting good dividends. Like I said, I'm always a big fan of the dividends in investing. That's always a smart way to go historically. So both of those, have great management and upside potential from there. And like I said, the other one, Patterson Companies.
Yeah, I saw Patterson too in the world of dentistry. Also,
yeah, it's dentistry
tell me a little bit about
and
that
like
one.
pet supplies and things of that, and just from its industry peers like Kimberly-Clark, Dentsply, things like that, it's trading at a discount. And just with COVID really starting to come undone, people getting back into more normal activities, that company's done well even with this downturn, since the beginning of the year. And I'm still holding my hopes out for a buyout candidate. That would be my buyout candidate for sure.
Ah, I see. And you got any thoughts on Friday's jobs report? A little preview?
Yeah, I think it's going to be better than expected, strictly because everything is getting back to normal, right? COVID has sharply declined the last 2 weeks. We flattened out a little bit. So I think we can keep that unemployment number going down, going in the right direction. That's Friday, April 1st. Hopefully it's not an April Fool's joke on us, but it is something to watch out for. And the Fed's going to be watching it as well. So I'm hoping, just from our conversation, that the Fed sees, hey, employment's going in the right direction. Let's not get too crazy on the rate hikes, so we don't spook the market. We're going in the right direction. Let's keep a good thing going.
Yeah, let's hope things go in the right direction and continue in a good way. James Locke, nice to see you. Thank you so much, co-founder of Cool Locke Associates. Thanks, James. You too. Appreciate it. Coming up next, Meech Snyder is standing by. She will join us to discuss some of the names that she likes and if investors should worry about stagflation. Coming up.
Let's walk through how to analyze a company's financials on Thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Technical traders, The chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to the Watch List. I'm Nicole Petalides, live in New York City, live at the New York Stock Exchange. Let's get to Mish Schneider, Director of Trading, Education, and Research at MarketGauge.com. Mish, nice to see you. Thank you so much for being with us. So tell us, I mean, we've seen some recent swings in U.S. indices. In fact, 2 weeks in a row of gains. Bull market, bear market, or does it even matter? You tell me.
Well, it certainly matters to a lot of people, but I'm seeing kind of like at a trading range type of market, which is not so atypical when you consider all the fundamentals that we have at play. We definitely have inflation fears. Obviously, it's not transitory. We also have fears about the Fed, although the bond buying today was very robust, which was a good sign. Clearly, we have a situation where we're coming back from COVID, so that's a plus, which can also turn out to be even more inflationary. And they have the retail investors out there very accustomed to buying the dips. So you're getting these crazy calls for new all-time highs or a major crash. And that's why I'm kind of sort of in the middle here, trying to be very pragmatic about the reality that we could actually, on these dips that we see close to the lows that we had maybe the beginning of 2021, as buy opportunities, and rallies as we get higher, closer to the highs that we had in 2021 as sell opportunities. And you've got to be very nimble, and passive investing may not be the best idea right now.
So that being said, as you're trying to position yourself at this current time, you know, at this juncture where we saw, you mentioned what's going on with Apple, they're cutting production a little bit, Bitcoin is on the rise. These are two of the things that you noted, trying to step in at the right time. Tell me some of the opportunities that you are seeing.
Well, I certainly think that commodities aren't going to just like die at this point. And I think the corrections, you're seeing good, healthy corrections in very positive phases, with fundamentals still supporting that we're going to see supply chain issues. We're still going to see some labor issues. We're still going to see, obviously, Mother Nature issues. And even if Ukraine-Russia situation resolves like tomorrow, it's going to take a while for Ukraine to come back and be able to produce a lot of the commodities that they've been producing, particularly in food. So for that reason, I think that these buy opportunities that you're seeing when we see these dips, particularly if you're not in precious metals, that still has a very low risk trade. Apart from commodities, though, I'm also looking at some things, again, that make more sense if we're coming out of a COVID world. And even though China's on lockdown right now, obviously in the United States. So transportation has been incredibly strong. So if you're looking at some of the trucking companies, let's say like J.B. Hunt, that looks pretty good right now. If you want to go more into air travel, GoGo made this huge move. So that's the internet connection on planes. So now we're looking at Garmin. Garmin is an interesting stock because it's been beat up, but yet at the same time, it's in every plane as autopilots. So it's the technology that they use there. So we're looking at that. And then switching from there, medical devices. I think you and I have actually talked about this in the past. People coming back from COVID are going to need to go back to their normal medical procedures. So companies like Stryker and Intuitive Surgical, or even the ETF IHI, this is kind of where we're looking at in terms of the stock opportunities. And there's a few others, but those are my major ones.
Right, and it makes sense because you're looking for themes and things that people are doing and their behavior and habits. Some of the other names that I saw on the list, some things to discuss here, you could tell me if you do like them, names like Palantir, Datadog,
Wolf, space.
Okay, so when you said Palantir, it just triggered right. The other great area to be looking at is cybersecurity. And those cybersecurity stocks have gone up a lot. And Palantir hasn't really. It's not strictly just cybersecurity. It's an aspect of it. But Checkpoint, Leidos would be another one. Even Zscaler has come all the way down. Datadog is more big data. I like that stock. I'm looking for things that, like I said, that not only could be pragmatic in terms of being able to go up even if the environment is somewhat stagnated, but also opportunities where they may be more inflation proof. And those are companies that pricing power is not necessarily a factor for them. The others you mentioned are more meme stocks. And we can't ignore that AMC and GameStop have gone crazy. Right. So it makes you wonder about these very high short float fun meme stocks. Would I be a long-term investor? No, but there certainly could be some fun, especially when they go up 20, 30, 40, 50% in a couple of days.
Right. I saw you took some profits in BitO.
Yes.
As we've seen Bitcoin with a nice jump from Sunday till now. Tell me a little bit about your thoughts on crypto and what's going on here.
Well, I think that the fact that it had held very well between 38 and 40 was the launch pad to get us to 42. And then as it was consolidating at 42, we got through 46, which was a big level of resistance. We took profit because we got long in BitO much lower. And I always like taking profits and locking in when you get a certain percentage against your initial risk. But I still think that we have more to the upside, particularly some of those other altcoins. We're looking at Avalanche. We've been looking at Wrap Lunar and Polkadot. And in terms of Bitcoin itself, could go to 50, and then we can reevaluate.
Wow. Okay. Good. Well, I'm glad we were able to really broaden it out. You covered a lot of topics for us. Thank you very much. Nice to see you. Mish Schneider of MarketGauge.com. Thanks for joining us on the show. Still ahead in the second half of our show, we will take a look at Chewy ahead of its results and look at some of the trends also in biotech. And as we head to break, take a look at winners and losers in the S&P 500.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Welcome back to the New York Stock Exchange. I'm Nicole Petalides, coming to you live. We're in the middle in New York City. 90 minutes left in the trading session after 2 weeks of gains for the Dow, the Nasdaq, and the S&P. We have somewhat of a mixed market on this Monday, a big jobs report on Friday. Here's a look right now. You can see the Dow is down 0.4%, losing 128 points, 34,733. The S&P gaining 3 points at 45.45. The NASDAQ up 110, 14,864, and the Russell pulling back 17 points at 2060. Want to take a look at Chewy. Chewy is set to share its earnings tomorrow after the closing bell. Bringing us all the details, Michael Keeley, contributor here on the TD Ameritrade Network, to take a look at what the analysts will be focusing on when it comes to Chewy. Michael.
We're still seeing top line growth, and that is definitely envisioned into not just the next quarter, Nicole, and the one that they're posting, but into next year. However, it's the bottom line that is proving a concern for a good many investors, traders, and analysts, because top line growth without bringing it home with profitability on the bottom line can only hold out for so long. And it does appear that investors have been, willing to make some accommodations to an extent, but then we take a look at the last 6 months of trading on this name, Nicole, and the shares have definitely tumbled. And that I think a lot of investors are in that show me phase. This is a company which has prided itself on being more of a pure play retailer for folks to get auto shipped items for their pets. And they've extended that, idea of auto shipping actual products such as food and toys and the like into the more profitable domain of healthcare supplies and even insurance. But that is not proving to turn the corner on the investors' pessimism, as we can see from this chart. We've got clearly descending highs there. And so, Nicole, I would say that, valuation has come down quite a bit, but the valuation on Chewy is still ahead of that of some online marketers such as Stitch Fix and Wayfair and the like. And when we see this, side-by-side kind of comparison of last year relative to this year, we can see that it's still a loss from operations that's nearly as much as the case was last year. And so while, Chewy does all of its business in North America, one might think, well, they're shielded from the tensions surrounding Ukraine and Russia right now. The fact is they are paying a lot for labor expenses, for operating expenses, for the fact that global supply chains are having an impact, even though their revenues are derived strictly in North America. And so the firm is facing some impediments. And the last thing that I'll say here, Nicole, is that you've got very well capitalized competitors of the likes of Amazon, Walmart, and Costco that do have that larger footprint. They are closer, by and large, with their distribution facilities being here and there across America to the customers than is Chewy itself. And so, you've got a lot of competition, and I would venture to state that you don't necessarily have a unique product in what Chewy or Petco are offering that extends its ability to pull in customers beyond the likes of Amazon, Costco, and Walmart. So, the firm has a lot against it in terms of being able to really produce some optimism in the part of investors in Petco. They did not do that with their earnings release, even though they reaffirmed their guidance.
And thank you for that, because you gave us a good summation of what we can expect here from Chewy ahead of its earnings reports. Appreciate it. Michael Keeley, a good in-depth look there at Chewy. Appreciate it. Now I want to shift our attention straight over to a different sector, and that is biotechnology. Mara Goldstein is with us, Managing Director and Senior Biotech Analyst in Mizuho Americas. Thank you so much for being with us, Mara. So tell me a little bit about some of the trends that you've been seeing. I noticed you have a lot of buy ratings at this time on a lot of these companies. Are they positioned well? Valuations looking good? What are some of the trends you've been seeing?
Sure. I think we're, seeing a couple of things. And one is that, the sector in and of itself is under a fair amount of pressure exiting 2021 and into, certainly the first quarter of 2022. And so it always raises the question as to whether or not valuations are at a point that should make investors interested. And I think we've seen over the past couple of weeks inflows into the biotech sector. We're seeing that in the XBI. And so the question of whether or not now's a good time to step up into a lot of these names that have been repriced is certainly circulating. One of the things that we look pretty, I think, at a time like this that we focus a lot on is cash runway, and do these companies have enough capital available to them to really commit and execute on their R&D plans, which is really, what drives these companies getting to critical data points and the like. So I think you are seeing a lot of that in the industry. There's been a ton of secular change over the past couple of years, new tools and technologies, certainly just looking at what's occurred in the COVID field and the ability to get COVID vaccines rapidly developed and deployed does raise the hope that that can be put to work in other areas, other therapeutic areas as well. I cover mostly oncology companies at this point in time, and we really are seeing the potential for these companies to be the direct beneficiaries of accelerating development timelines based on having, more advanced tools and technologies.
And as we had the pandemic, there was a lot of talk about how oncology really was front and center because people weren't getting checked as much, or they weren't able to get treatments and things like that. And now we're in a new time as the pandemic is passing, and we now have obviously new catalysts, new technology, right? And I know you're looking at hematology as well. So tell me about some of the names that really are the buys in the group and why. Because as we look for investments, but we also look for great ideas and what's behind this.
Absolutely. And I would say that oncology is just like all of the various different subsectors when biotech suffered, but to some degree the least amount, because what we saw was that maybe there were new diagnoses that had slowed from an oncology perspective, but patients who were in treatment still continued to come into treatment. So that is certainly a big component of, the ability for, folks to continue to get their medications. So a couple of the names that we have been really heavily focused on, and a lot of this comes down to A, having really strong catalysts, and B, having little cash risk at this point in time. Arcus, RCUS is the ticker there. That's a name that we like a lot. This company has a really broad immuno-oncology pipeline. Partner in Gilead, which has essentially taken a development option on their on their lead candidates, and there are 4 of them currently in human clinical trials, and they'll have a catalyst in the second half of this year looking at data for a couple of their drugs in development, and very little cash risk. $1.4 billion in cash on the books, trading at a market capitalization that's little under twice that. So for us, we like Arcus a lot. Another name that we focus pretty heavily on, a company that's really been repriced at the cutting edge of what's going on in cell therapy. So that's a different way of treating cancer, and that's when you take cells and engineer them to go after cancer cells as therapeutics. Again, a lot of hallmarks that we focused on with Arcus. Catalyst coming up. They're going to have data for a bunch of their candidates in their pipeline this spring and through really the rest of the year, and with $700 million in cash and a corporate deal with Johnson & Johnson, little risk on the cash side and on the cash execution side. So that's a name that we've liked a lot. And they're looking at a variety of different tumor types, mostly in the hematological space, but they are looking at advancing their cell therapy, which are called NK cells, natural killer cells, into solid tumors. Solid tumors are a much larger market than hematological tumors, so it really does open up potentially a much larger addressable market for them. So it's a name that we focused a lot on. And then the third name that I would argue that, is in this space where they have a good amount of capital, little cash risk, big pipeline, and coming up on data is Xencor. XNCR is the ticker here. And this is a company that develops bispecific antibiotics. So if you think about bispecific monoclonal antibodies, which are antibodies are naturally occurring. We all have talked for many years about monoclonal antibodies. These are bispecific, so they hit 2 targets at the same time. And this is a company that has a fair amount of corporate partnerships that have been licensors to many pharmaceutical companies, $600 million in cash, very little cash risk in the near term, and some pivotal data, we think important data that really could change sort of the nature of the company's valuation in 2022.
Right, and thank you for all of that. Just a quick thought on Merck. Can you give me 10 seconds on Merck, just because that's a big, all the ones that you named are incredible, because a lot of people, Myra, don't even know a lot of the companies that you brought to us today, so thank you for that. But just a quick thought on Merck, since so many people do own that.
Sure. We do cover Merck. As I said, we've had this oncology focus. This is a company that has this amazing franchise in Keytruda, and it's both, the most, an amazing franchise, going to be a $20 billion product, really drives a lot of clinical development. At the same time, it is a ton of revenue concentration, and that scares investors. We're not scared of that because we think that the company has a lot of tools at its disposal to be able to mitigate that over time. The company's going to have a cardiovascular R&D meeting and another on April 5th, which will really shed some light on what they're doing in the cardiovascular space. They have, a tremendous amount of capital put to work to do, additional M&A deals, maybe not big deals, but, if they string together enough smaller deals, that becomes meaningful over time. And the Keytruda franchise, while it is open to loss of exclusivity concern towards the end of the decade, still has a ton of growth associated with it. Company is looking at ways in which to create novel constructs around Keytruda that, essentially they can repatent in certain ways, particularly combining with other drugs. So we like it. We also essentially have a new management team here, so that does lend itself to the idea that you may see a different strategies going forward, which we just have not heard yet from the company.
Thank you so much, Mara. It's really great to chat with you about all of these names. Obviously, huge, huge story with biotech. We appreciate it. Mara Goldstein, Mizuho Americas. Thank you. Still ahead, we are ready to speak with our panel about meme stocks. What's causing a little resurgence in some of these names? Anything that you might like? Coming up, we'll have our panel discuss these.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Horn. Here's a few more of this afternoon's movers to keep on your radar. GameStop is jumping today after seeing its third insider stock purchase just in the last few days. GameStop has been one of the most high-profile meme stocks and has taken off over the last week, now gaining over 40% in March. GameStop has a total share float of just over 46 million, of which almost 27% of shares are sold short. Shares of cigarette makers Altria and Philip Morris fell today on news Walmart plans to end cigarette sales at some U.S. stores. According to the Wall Street Journal, cigarettes are being removed in various markets, including some stores in California, Florida, Arkansas, and New Mexico. Walmart said it will be using the space more efficiently to meet its customers' demands. And Sonos is jumping on the day, pacing now for its largest percentage increase in over a year. Shares surged on news the company will be added to the S&P Small Cap 600 index. Sonos is now up 4 of the last 5 days and has gained over 10% month to date and 1% this year. This has been your TD Ameritrade Network Market Update. Now back to the watch list with Nicole Petalides.
Jenny Horn, thank you so much for that report. Well, we're watching these meme stocks. They began the extraordinary spike back in the summer of 2020, and recently some of these names are starting to garner attention once again. Jenny was just telling us about GameStop. To bring in our panel, Ben Silverman, Director of Research at Verity Data, and also David Traynor, CEO of New Constructs. Thank you both for being with me. So Jenny just finished talking about the fact, and everybody's talking about the fact, that Ryan Cohen, the chairman, bought over 10 million shares of GameStop. And in fact, the stock has gone from less than 150, it's at 175 or so. Ben, I'll start with you. What are your thoughts on GameStop and some of these names in a broad-based way?
Thanks, Nicole. So GameStop's interesting. You know, we deal with institutional investor clients, and we put out research about insider buying and selling, and Ryan Cohen's recent purchase obviously lit up our radar. But the important thing to remember is, so he bought about a little more than $10 million in stock. His cost basis on his GameStop investment is still, even with that purchase, a little under $9.50 per share. So when investors are looking at GameStop and wondering, is this a good price to buy at, and they see the chairman buying, they really need to understand that most of his investment was made at a sub $10 price. So $120 or so, or 100, I think he's buying around $102. That might not be the best indicator. He's throwing down some cash to protect a large investment that he was already up 12 times.
Right, and David, your thoughts here, because I think you're making a great point about what we're seeing. It's not always as it appears, right, David?
Yeah, you know, I would firmly agree with Ben. You know, look, this is I think it's a head fake. I mean, the fundamentals of this business are nowhere near close to justify the valuation. This is crazy. I mean, that's why they call it a meme stock. I mean, this is why we have bored apes. I mean, no one even pretends that this investment makes sense. It's a speculative gamble, and as good as it can be on the upside, it can be just as devastating on the downside. And we would highly recommend that investors sell into this strength. If you have gains in it, take them. But yeah, this is it's crazy talk.
David, but are there some names that you do like? You're saying sell if you want to maybe take some profits, particularly a name like GameStop, which has jumped now, David. Are there other names that you say, oh, if this one's down, I would touch that one. I would get in for a little bit?
Not in the meme stock arena, no, not by any means. But if you're talking about sort of bigger, larger, or more solidly fundamental companies, absolutely. We've got a regular recommendation list that comes out weekly. And we think there are plenty of good spots in this market, but we still think there's some really dangerous spots. We've had a bit of an unwinding of the meme stock trend, you know, at the beginning of the year, and some other really expensive stocks have come down a good bit, but there is a lot of risk in a lot of these stocks remaining because they were so overpriced to begin with.
Ben, what are your thoughts? I mean, are there other names that you would say, hey, I might be interested? I think you made a great point in noting that Ryan Cohen's getting in there. He's buying at over $100 a share, and everybody's so excited he's buying. But the truth of the matter is his price is probably $10 or less. So that being said, AMC, for example, which we always thought of as a movie theater, has certainly expanded its role into purchasing a gold and silver mine. Are there other names, Ben, that you think that might be a play?
I mean, speaking of AMC, you know, there's a good example of look at what the insiders are doing. Everyone's all excited, but the CEO sold $40 million in the last couple of months. That's a good indicator. I mean, if he's in it for the long term, like he talks about, why is he taking money off the table now at these prices? You know, In this arena, it reminds me of the dot-com boom and bust. I was involved in that both as dot-com executive and as a journalist, and things are just not running off of fundamentals here. And this idea, companies like AM branching out and buying a gold miner today, the CEO was talking about more potential M&A outside of the core business. It's this idea of throwing things against the wall to see what sticks, and some investors are going to appreciate that, but many are not going to. And again, it's the quality of the company, it's the quality of the business. And I'm looking at all these meme stocks, and Bed Bath & Beyond's a good example. That was the stock, it still kind of is. The insiders have been buying there over the past several quarters. The company's been buying back stock. So at least we have an understanding that management is invested in the long-term health of the actual operating business, as opposed to trying to go, off of plan and just throw money that, by the way, AMC got a lot of that money selling stock to the public at over twice today's market. So,
Right.
People just have to be careful. Look at good companies, look at companies with good fundamentals. So I tell my clients, look at where the insiders are buying or where they stop selling. Look at where buybacks are being deployed opportunistically, not just to buy back stock, but to reduce outstanding share count at good prices.
Yeah. And David, what are your final thoughts here? Because you said I wouldn't consider meme stocks. I mean, what would you consider?
We like stocks like Domino's. We recently published a report on that company. Ford Motor Company, Royal Bank of Canada, O'Reilly Auto Parts, AutoZone. These are sort of you're not as sexy or fancy names, but they can be trusted. And I think that's what investors should look for these days. Companies and management teams trust. And I think Ben makes a good point about AMC. Like, the management team's talking out of both sides of its mouth the way it's selling stock, throwing capital at a gold mine. I mean, throwing whatever they can at the wall to see what sticks is not good management. That's a sign to turn and run. These folks don't care about preserving shareholder capital. They care about maximizing wealth for themselves. And as Ben said, we saw this during the tech bubble, and we're seeing it again now. It's a shame. It's a shame. And there are plenty of other great companies like that deserve your capital and deserve your trust, as opposed to these meme stocks.
Thank you both so very much. Ben Silverman of Verity Data, and also David Trainer of New Constructs. A great conversation. I appreciate it. Nice to chat with you both. Thank you. And that is going to do it for us here on the Watch List every single weekday. I'm Nicole Petalides. I do appreciate you watching. Here we are live at the New York Stock Exchange. I see you every day at 11 a.m. and 2 p.m. Eastern Time. Thanks for watching. Keep it right here. Market on Close is next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo Webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
90 minutes after the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
Good afternoon. Welcome to Market on Close. I'm Oliver Rennick. We are at the highs of the session. Bulls continue some strength, and it started out over the weekend and late last night with Bitcoin, baby. It's back, or at least it's trying to make a pretty big stand here and punch above a level that it's gotten rejected from a few times. NASDAQ now trying to accumulate some bullish action too. Let's check out the moves here as we're now up about 1.2%. And the NDX, pretty strong push now to 15,000. We cleared 14.5 last week. Found a little bit of chop back and forth, but bulls right now are winning out. And it's basically been that way since the day the Fed hiked. Whatever happened to the big, scary interest rate hikes? Supposed to derail the market. Or at least maybe some of that got priced in over the last couple months. Maybe a little bit of de-escalation, or at least lack of escalation in Ukraine, whatever you want to attribute it to. Relief rally here that it began as is now taking on some real momentum. So looking at the big global issues, there's not a whole lot really to point to in terms of a catalyst for some of this, though we are seeing some of those telltale signs looking at gold and crude as maybe some at least lack of escalation on the geopolitical front. Again, there's no real calming of the headlines from the war in Ukraine, but at least apparently we haven't worsened the dialogue, and at this point the market seems to be kind of ditching some of those Ukraine safety trades at the moment. Crude's down 8%. It's a pretty decent move. Gold's down about 1.5% right now, so those two right there were quick to swing higher when there was any surprise in that particular story. But as right now, we see them both pulling back and staying off those highs. Market seemingly maybe trying to digest that particular story. Now, one of the other big global stories right now is the COVID just rampant cases in China, which is pretty wild. But at this point, there was a priority by the market placed on the language from Xi Jinping and the message of support for capital markets earlier in the month. So even that too hasn't really applied any additional pressure. And I think that's important because if you're looking for a reason for why there's some big push in risk assets here, you pretty much have to tie it back to some relief perhaps around the market's acceptance of a rising interest rate paradigm. But then secondly too, this is a market that by many measures, especially in some of these assets, got really extreme. I think about crude oil and how extreme that got elevated. The commodity space as a whole that got very elevated. This is the chart of the Goldman Sachs Commodity Index ETF GSG. The big move that we got here sent its 14-day RSI, a measure of momentum, to the highest in 20 years. Okay, this is a 20-year weekly chart, and we were pushing up to 90 here. So clearly, things got very extreme, right? So just an example where you could look at the commodity space and see how powerful those moves were to the upside and expect maybe a little bit of a pause. It doesn't mean it's changed the trend, but it is notable here that on today's session we see a drop in crude, we see the drop in gold, and then we have a market breathing a little bit of a sigh of relief. It kind of goes along with all the other inflation measures too that have calmed down a bit. Stuff like wheat and some of the grains, general commodity trade has slowed somewhat. So maybe the market here is getting a grip on potentially some of the inflationary the stories we've been tracking. But at the end of the day, if you don't have a direct news story, or you don't even know, let's say you're totally disconnected from the internet, you got no information coming, I've maintained that there's really one thing you need to watch. It sounds crazy, especially to traditional financial investors, but the tell of Bitcoin's high risk asset behavior has been an incredible trading tool, just extraordinary, to where you see Bitcoin making the big moves first. I think people are starting to catch on to it a little bit, but it still works. If there's a big gap between Bitcoin and stocks, it is almost always paid off to trade in the direction of Bitcoin. Not because it's necessarily a truer read or because people trading Bitcoin are smarter than the global stock market, but just because it is the type of thing that gives off major risk-taking vibes whenever it is moving. It's the crypto world. It's nuts. So when there's appetite to buy into Bitcoin, generally there follows appetite to buy into particularly the high growth and speculative risk assets in the stock market. Today you do see that there's that big dichotomy that shows up again. Value stocks, SPYV, down on the day. Growth companies are roaring. Tesla's having a monster session, up 8%. On the year, still, this has not been the winning trade. But the more ground we recover here, the more complex the story gets. Look at the year so far, but also since the high from November. So this is a chart I've normalized back to November 19th, which is when the NASDAQ peaked. A little bit earlier than the S&P, but I think it's the more important index, given all the big cap tech in there. So since that peak for the NASDAQ, growth stocks, as measured by SPYG, still down about 9%. But they're right down there with the quality stocks too, QUAL. Really the only place to find that outperformance on the year in an actual income perspective to actually make money. If you're outperforming value versus growth, that's fine. Value up 2.9%, that's pretty good. But the real winning trade has been in inflation or commodity-linked funds. SPYD, the dividend fund, has been the best in terms of factors. So just a reminder here that there's still a pretty giant spread. If you're in dividend-paying stocks or some of the other inflation-linked funds that are up on the year, even value, there's still a pretty big gap here where growth is underperforming and quality, a label here that needs to be taken with a grain of salt, because in a lot of the big quality funds, you essentially have a giant cap, mega cap skew in it. So it looks a lot like growth in general, which skews to the big caps and the tech stuff too. But as you can see, we've been putting in some higher highs here, and now arguably a little bit of a turnaround in some of the growth themes. At the same time, though, there's something else that's very almost suspicious here, which is the fact that we're getting this massive speculative appetite coming back into the market and some of the really telltale places that are more aligned with a COVID-era stimulus-style speculative trading than an environment in which the Fed's going to hike at every meeting. So as Tesla's up 8.3%, it's not at the all-time high yet, but it did clear $1,000. That's an important checkbox for the bulls that I've outlined here. We've pretty much checked them. My checkbox was Bitcoin 45,000, Tesla above 1,000, and then looking also at the NASDAQ getting above the February highs. We haven't done that yet, but we're in between as we got through 14,500, and now we're challenging some of those February highs. We have to be very specific in terms of how we describe some of these charts, because technically many of them are still downtrending off the highs. This could all be a big rally within the context of a bear market that had been established in the NASDAQ. But this is the part that gets kind of suspicious here. Since the Fed on March 15th did give us the first hike, we've got GameStop has doubled. It's up 112%. AMC's almost doubled, up 92%. Tesla's up 40%. And the Buzz ETF is up 20%. Do you even remember the Buzz ETF? It's Dave Portnoy's ETF that he sponsored. The guy who was picking stocks out of a Scrabble bag during COVID. Where did the rush of speculative appetite come from here the moment Jay Powell actually pulled the lever and started hiking? Is this a relief trade, or is this a market that has discovered that interest rate hikes can't squash the amount of money that's still floating around from the system and looking for places to go to work? I generally still am of the belief that you can frame, and you should frame, most of this in the context of longer-term downtrends. Game, AMC, Tesla, Buzz, all these are still off the highs. Tesla's the one that's closest here to breaking that downtrend. But if you look at GameStop or AMC, you're going to see a chart that still requires a lot of work to get back into regimes from last year. However, I think this is a very powerful statement by bulls over the last couple of weeks that we can get these types of speculative rallies even as the Fed has confirmed the most hawkish of expectations out there. It's going to take a real repetition of withdrawing liquidity for this market to change its behavior. Is this an old habits die hard situation where people are just piling money back into the riskiest trades after just a couple weeks of potential bounce back? Are these bulls that are going to have to learn a tough lesson as Powell continues to hammer the hikes in? Or is this a market telling us that maybe the big bad interest rate regime is not quite as dangerous as many suspected? This is getting to be a really interesting juncture here when the NASDAQ is threatening those February highs and you've got speculative stuff going nuts again. All right, let's bring in Caroline Woods and let's talk some more about some of the other stocks we're following here. So Tesla again, Caroline, I mean, just a ton of different news flow over the weekend. Elon Musk just dumping information on us. I know we've been talking about it all day, but just remind us here, where's all this excitement coming from?
Well, I think the actual stock excitement has more to do with the plan to authorize more shares to hopefully eventually split again and then pay a dividend. So Tesla's up about 8% today. I think it has a lot to do with that. But then Musk also making headlines this weekend for giving serious thought to creating his own social media platform because he doesn't think Twitter allows for free speech. On Friday, he posted a poll for Twitter followers saying, free speech is essential to a functioning democracy. Do you believe Twitter rigorously adheres to this principle? He followed up with a statement saying the consequences of this poll will be important. Please vote carefully. Well, 70% of people who voted said no, they don't think that Twitter adheres to it. So he responded with a tweet saying, given that Twitter serves as the de facto public town square, failing to adhere to free speech principles fundamentally undermines democracy. We also know that, of course, Musk is seeking to end SEC oversight of his tweets, claiming it's being used to trample his freedom of speech. So, you know, this
maybe he's got a little
another headline
axe to grind.
Musk, yeah. So just one more way Elon Musk makes the headlines. But I think that the majority of this gain is probably more likely to do with that stock split that tends to send shares higher. Okay, so investors like the idea of another company encouraging some more trading behavior by lowering the price. We don't know how much, though, but we've seen the 20 to 1s for Amazon. So, I mean, maybe we'd be looking at something like that for Tesla. Again, still, though, a series of lower highs off the top. But, man, what a comeback here. Just an epic rip in this stock. What about the other side of the market, Caroline? It seems like investors are not affording the same sentiment to the value side of the trade today. Some of the cyclical stuff, banks in particular, just like really cannot get any momentum in this rate hike paradigm, which is causing many people some consternation as they wanted this group to do so well with rising interest rates. I know we talked about it at the start of the year, how banks were poised to perform well given the Fed's rate hike cycle. But now Morgan Stanley coming out and cutting its rating on banks, saying war changes everything. Morgan Stanley warning that higher for longer inflation increases credit risk. The inverted yield curve, which we know can be an indicator of a recession, points to slower growth, and that they're shifting their bear case to full-on recession, in turn downgrading their industry view to in line from attractive, with a number of adjustments across the group. Just to go over a few of those, lowering JP Morgan's price target to 161 from 170, keeping an underweight rating on the shares. They're currently trading around 140, down 1.3% today. Downgrading M&T Bank from equal weight to underweight, lowering the price target there from 185 to 179. It's down about 3% today at 178. So just basically $1 below that price target. And downgrading Synchrony as well from overweight to equal weight, cutting the price target from $56 to $40. So obviously we know rising rates can boost net interest margins, but not the only thing to consider when we have the potential yield curve inversion, when we have the war in Ukraine, so many other factors to consider.
Brutal. Regional banks today down 1.7% and have not caught a bid at all session. Just opened, gap down, and then have been there pretty much the entire day. So the downgrades are not helping, but the downgrades are seemingly really macro and economic focus. So it's not like some bold, stock-specific story. This is just maybe not the perfect environment that folks were hoping for this group.
I think it's also important to note that M&T Bank is the only of those three, at least, that's actually, you mentioned regional banks, that's in positive territory so far this year. It's up 16% year to date, whereas JP Morgan's down, 11.5%. So that one has seen a bit of a bounce, likely because of, the rate hike cycle. But obviously, it might not be the case for much longer, according to Morgan Stanley.
All right. And that's coming from the bank analyst. Okay. M&T, there it is. Nice. Good context there. M&T looking pretty good on the air. Okay. I know there's always like M&A rumors.
Buffalo Bank. Have to give a shout out to my hometown bank.
Nice. All right. Everyone's got the regional bank. What's yours? Send me a tweet. I'm not sure what mine is. I don't think it's publicly traded. Small town Virginia. Okay. Appreciate it, Caroline. Thanks. All right, let's talk some more about that spread between the growth and value parts of the market, where so far on the year, still and since the high, you're better off in the value themes and dividend payers. But the last 2 weeks have told us once again that growth is not going down without a fight. Wes Krill joins us as head of investment strategies and vice president at Dimensional Fund Advisors. Wes, it's great to have you here on the TD Ameritrade Network. Welcome.
Yeah, great to be here. Thank you for having me on today.
Absolutely. So weigh in here, because I know your team studies this a lot. It's been this great value recovery since the market peaked out. But should these last couple weeks have the classic investor strategies worried again that growth might make its way back?
Yeah, it was certainly nice to see a return to form for value, particularly at the end of 2020 through 2021 for investors who have been sticking around for so long without a positive value premium for really a long period of time. In terms of expectations for the future, we expect value stocks to outperform growth stocks every day. And that really just comes back to the intuition, the underpinning for believing in a value premium. It's this notion that if I pay less for a stream of future cash flows, then I have a higher expected return. And that's a very evergreen logic. It's something that is sound to believe in day in and day out. And historically, over the long haul, value stocks have outperformed growth stocks about 4% per year in the U.S. But there is uncertainty around that. And we see that there has been sustained periods of time where value has not delivered a positive value premium. So investors are often looking to signals that might give them some information about where things are headed in the future. Valuation spreads are one thing that people often appeal to. They'll look at the price to book ratio for value versus growth. And when we look at that in the U.S., it's at historically high levels. So the spread between value and growth, very, very high right now. Now, we know from a lot of research that has not been a strong predictor of subsequent value premiums, but it does tell us that even with this relatively strong run for value recently, it hasn't totally closed the gap in terms of those valuation spreads.
So Wes, at the risk of simplifying here, the long-term trade and investment does eventually pay off for value investors according to history, because these are the companies that make money and profit, and that's what a company is supposed to do. But there's many in this generation of traders who have lived through a very growth-dominated paradigm, and the Fed essentially stamping out a recession by dumping all of the world's money into the market the last couple of years has convinced them that you don't really have to make profits anymore. If there's never going to be a downturn in the economy, if we can just keep cutting off the swings in our economic cycles, is it possible we could see these growth companies cruise right through an interest rate hiking paradigm? What if that happens?
Well, this is where you come down to expected versus unexpected returns, right? So we expect value companies to outperform growth companies just based on the principles of valuation. They have a higher discount rate associated with their future cash flows. Unexpected returns can result in growth companies outperforming value. There was a very unexpected set of events that happened in 2020. I think we all remember what happened that year. And during that period of time, for much of 2020, growth companies were outperforming value. But again, I go back to first principles. If my goal is to pursue higher expected returns in the market, we have decades of academic evidence that suggests that trying to identify the underpriced stocks, trying to identify what trends are going to emerge in the future, have not been reliable ways to outperform the market. What is a relatively high probability way to pursue higher expected returns? It's to buy stocks with lower relative prices combined with higher profitability. And that's this intuition behind holding value stocks. Is it going to work over every time period? Clearly not historically. There's even been long periods of time where value stocks have underperformed growth. By the way, that's true for just the broad equity market versus 1-month Treasury bills. There's been 16-year periods historically where 1-month U.S. Treasury bills outperformed stocks. But I don't think that sways us from the logic that owning stocks has a higher expected return than 1-month Treasury bills. And it's the same thing for value stocks. A short-term performance doesn't dissuade me from continuing to trying to add value by holding value stocks.
Wes, the ratio, the spread of just the the SPDR value versus growth, to use as a benchmark here, that relative strength of growth peaked out in the last quarter of last year. It seems like, at least in this paradigm right now, really the Fed getting hawkish is kind of what kicked the value trade back into gear here the last 6 months. What's the connection you see right now between that value trade and interest rates? Do we need to have a Fed applying pressure and fighting back inflation for that trade to work? And how much? Because again, it's just mind-boggling here to see stocks like GameStop that have doubled since the Fed did its first hike. I thought it was supposed to do the opposite. Take liquidity out.
Yeah, it's funny you mentioned the Fed activity. You know, if I look for where there was most likely to be a causal effect between Feds changing their target funds rate and what you would see in financial markets, I would actually expect to look first in the fixed income markets. So if we go back in time, you know, there's been, I believe, 70 months when the Fed raised the target funds rate going back to 1983. And if you look in those 70 months, about a third of the time, the 10-year Treasury yield actually went down. So you had the Fed raising rates on the short end and then the longer term rates going down. And I think that's suggestive of there being so many different variables that are impacting whether it's Treasury yields or whether it's the returns of value versus growth. You know, Oliver, you mentioned at the very top a whole number of things that might be weighing on investors' minds. And it's likely that all of these are going to factor in to security prices. And so when we try and predict what's going to happen, and clearly it's not as predictable in fixed income markets as we might have guessed. And that's even more the case for value versus growth. That return difference between value and growth has not been particularly sensitive to interest rates, also not particularly sensitive to inflation. So all of these macro indicators that are interesting to observe just from a broad economic outlook have not really played strongly into a prediction for what types of stocks we're going to perform in the future. So again, we keep going back to these first principles. What can we say that is relatively unassailable? Well, if I'm paying a lower price for something, which is the case with value stocks, that's indicative of a higher expected return, and it's not something that relies on a market or an economic forecast.
Wes, a really good setup for us to have this conversation on repeat. So looking forward to having you back here. Appreciate you joining the show.
Yeah, thank you for having me.
Absolutely. Wes Krill, Head of Investment Strategies and Vice President at Dimensional Fund Advisors. When we come back, let's get some stock picks and talk about a few retail-focused businesses. Also, a little earnings update coming. Academy Sports, our next guest, likes the stock. We'll check it out.
90 minutes after the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Consumer discretionary stocks are having a nice day, but the consumer retail businesses still have a long ways to go after being punished these last 6 months. Let's talk about a few names on the list. Of Eric Marshall, portfolio manager at the Hodges Funds. Eric, great to see you again. Welcome back to the show.
Hi, good to be here.
Okay, so a couple companies on your mind. Let's get straight into it. We've got ASO reporting tomorrow, Academy Sports and Outdoors. One of these stocks that's been in a solid downtrend off the highs, but these last few weeks finding some strength. What are you looking for?
Well, Academy was one of these companies that really benefited from a windfall from the pandemic. And the company will have done, $7 for their fiscal 21. They used the windfall from the pandemic really to deleverage the balance sheet. So they're in much better financial shape, which should allow them to reaccelerate their store expansion plans. And we think that the company can still do north of $5 a share of earnings, which with the stock trading here in the mid 30s, we think looks very attractive on a valuation basis. And we think there's a lot less risk in the name, given their growth potential over the next several years.
What kind of growth potential does that look like? Is this a business that's going to take business away from other businesses, or is this just about people sticking with the outdoor sports and activities they got hooked on when they needed to get outside during COVID?
Yeah, one thing that we, in the Hodges funds, one of the things that we look for is companies that can self-fund organic growth. And this is an example of a regional brand that is actually expanding their store footprint. So they're building new stores, and they're really taking market share from in markets that they haven't been before. So we think that there's a value proposition that they bring within that sporting goods space, both in apparel and in hard goods. And we like the fact that they're expanding into new markets where they haven't had stores before.
So Academy Sports and Dick's Sporting Goods charts look pretty similar, both peaking at some point in the second half of last year and slowly trending downwards here. But another company that you like, how did the two fit together? How do they intersect, Eric? Are you getting anything different with one than you are the other?
Well, I think that they are similar. I think the merchandising mix is a little bit different. For Academy, they have a little more hunting, fishing, outdoors focused. I think Dick's over the last few years has really gravitated specifically to team sports and apparel. And so they may be a little bit more sensitive to, sourcing, inflation. One thing that we've seen is all these stocks have come back down as people are very concerned about consumer discretionary spending. And we think it really creates an opportunity to go in and look for companies like Academy, where we think maybe they've thrown the baby out with the bathwater.
Okay, all right. It's a couple good.
Day, only on the TD Ameritrade Network. For an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our portfolio management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I'm going to take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
All right, let's talk some options trades. Tom's got some bullish bets for us, and no shocker after today's big rally. Snowflake, even the cloud companies, Tom, are staging a pretty nice reversal of fortune after a 6-month decline.
Yeah, you're seeing a push up higher. Snowflake's up about 7%. But if you look across all the cloud computing companies, are having pretty good days, whether it's ServiceNow, Adobe, even CRM reversed from earlier losses today. So we're seeing a lot of push into the cloud names led by Snowflake. There wasn't really any news out here on this name, but I think they're getting reassurances that IT capital spending environment for the next few years is going to be pretty robust. The stock's still down about 30% year to date, off 40% from those all-time highs that we saw in November, around $405. So still has some ground to make up here, Oliver, but you're seeing yields fall slightly, which might be also putting a bid into some of these big tech names as the Nasdaq's leading. But we saw real near-term, short-term buyers in Snowflake. Now, in Adobe and CRM, we saw some longer-term call buying in those names. But in Snowflake, one that stuck out to me was on the near-term April 1st weekly series, the 240 strike call. Over 20,000 of those traded earlier on in the session. The average debit was about $4, so that break even of 244 to the upside over the next 4 days, really short-term positioning. That's about 3.5% above the current share price in there. Call volume is about 6.5 times normal daily average volume that we've seen over the last 5 trading sessions. So people piling into these short-term options. Over 28,000 have now traded on that strike. But not only the short-term April 1st weeklies that expire this Friday, but they are also out there in April and May buying some upside calls too, further out of the money. So a lot of speculation to the upside that these cloud stocks can continue to dig into some of those losses that we've seen since they started the tech sell-off, as you recall, Oliver, in early November. So still a lot of ground to make up, but valuation still pretty rich on a lot of these companies.
You look at a 1-year chart of snow, and even this rally, it really fits within the downtrend. An example of where we are on some of these charts that will show up like this quite a bit in tech companies, where you've got lower lows, lower highs, and then the big rally here basically fits within that regime. So that's kind of the the bearish take on this rally. Is it very much could be part of this larger trend. Snowflake's particularly weak one, though. I mean, it just really got obliterated, and specifically on its own earnings, too, right around the top there. So beyond just kind of a macro interest rate thing, it seemed like the market was really panicking about some of these growth rates post-COVID. And this rally, without a whole lot of news behind it, I guess there's very much a two-way trade here, which makes this bullish options trade pretty interesting. I mean, because I think a lot of people are going to look at this chart and think it's very fadeable too. Yeah, I agree. And if you look at the rhetoric that, hey, they're supposed to hike another 6 times, maybe some 50 basis points in May and June, what does that mean for a lot of these companies that aren't, they don't have healthy balance sheets and the valuations are outsized? They're not making a lot of money. So is that going to have a negative impact on these growth names? But then again, if you look at the rally that we saw up to over $400 in this stock in November, was that justified? Probably not, right? So maybe a little bit of semblance of common sense here by pulling these stocks back 30% this year and over 40% from those all-time highs. But in a rising interest rate environment where maybe corporations are getting squeezed on margins, what's one of the first things they're going to cut? Maybe CapEx spending, right?
in these IT solutions such as Snowflake and what they do for these corporations. Maybe
and
that
retail.
gets pulled back. Yeah,
they're launching a retail data cloud, and to me that is not surprising. Number one, because I was getting Snow ads in my email. I was wondering about that the last couple of weeks. So it's interesting that they're going to push in that direction when you've got Dropbox, you've got Google very much already in that realm. So not sure if this is like the big secular growth story for it, but okay. We'll talk some more about that as it develops. Microsoft, bullish trade there too, pretty much similar situation.
Yeah, if you look at this stock, it's having a good day today, up nearly 2%. It's only off about 8% from its all-time highs. So, and that was basically at the start of the year. It kind of got caught up and traded under $290 a share, pushing back up again. But if you look at the total addressable market for their biggest growth engine, which is the cloud-based business, will that boost their earnings, significantly, like a lot of people on the street think they will? The shares are up about 3% this month. As I mentioned, still down about 8% on the year. The Activision Blizzard deal is still in the works at this point. There was some commentary on that deal over the last week that they'd be willing to have some concessions, let Activision unionize perhaps. So that's in the gaming space for them, but I think their growth is still going to be in the cloud-based businesses. But really short-term call buyers in here also in the April 1st weekly series. Traders were coming in there, over 50,000 of the 310 strike calls traded for an average debit of about $2.40. That break even of $312.40 over the next 4 days, about only 1% above the current share price. Call volumes nearly double the normal daily average volume that we've seen over the last week. So piling into these short-term options here, and call volume, nearly doubled today. That's pretty big because historically we see a lot of daily volume in Microsoft throughout a session just due to the high price of it. So you're always getting speculators coming into some of these FANG Plus names. And Microsoft having a good day, back above 300, and that break even, you only need another % over the next 4 days, Oliver, to get above there.
Okay, all right. So bullish Snow, bullish Microsoft. Tom, but real quick, you've also got a bullish Kinder Morgan trade. Give us the 60-second specifics here as it's just below its 52-week high.
Yeah, and it's got really big resistance at that 19 level. That's key for this. So just under those 52-week highs. Traders were in there buying longer dated calls. You got to remember, America's largest natural gas producer, right? Kinder Morgan's got 83,000 miles of pipelines, 143 terminals. So they're one of the largest natural gas networks, and that's in everybody's headline at this point. But they were in there buying September 20 strike calls, so about 172 days till expiration. They bought 10,000 of those for an average debit of about 70 cents. That break even of $20.70, which would be above that resistance point over the next 172 days, about 10% above the current share price. Call volumes nearly double the normal daily average volume. And 38,000 calls have traded in there on the session, only about 3,500 puts. So even though the stock's down a little bit today, we're seeing some positioning to the upside in this space that probably has some growth just due to the geopolitical risks that are out there.
Okay. All right. 3 bullish trades, and 2 in tech, software, and 1 here in oil. Thanks, Tom. Nice finds. Good discoveries here on a big up day. Crude oil, though, is in the opposite direction. Let's talk WTI. Right now down 9%. Then we're going to take a look at the home builders after a bullish note out from CFRA. We've got about 23 minutes till the bell.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. the existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
I'm Maria Schrader. Here are a few stories to watch this hour. Shares of Volta, an electric vehicle charging company, fell sharply today after it announced its two co-founders will leave the company. Volta said now is the right time to identify new leadership with experience in managing public companies after its IPO last August. Canaccord Genuity cut its rating to hold from buy after the news. QuantumScape shares jumped higher after reports it is working with Porsche to integrate solid-state batteries into its electric vehicles. However, no formal announcement has been made. Porsche has previously put forward a goal for its electric vehicle sales to hit 50% of total sales in 2025. And JetBlue announced it will add 5,000 jobs in all sections of its New York operations, including airport, ground technical, in-flight IT, and others. JetBlue currently has around 8,000 crew members based in New York City, and this comes amid a broader hiring wave among the airlines as travel picks back up. JetBlue also announced new flight services over the weekend. This has been your TD Ameritrade Network Market Update. Now back to Market on Close with Oliver Rennick.
Another big decline in WTI, down 9.5%. Let's talk the inflation trades that have been unwinding a bit here now. Chris Robinson joins us to talk some WTI and, of course, a little Chicago wheat, the managing director at TJM Institutional Services. Okay, Chris, so this is now another big sell-off in crude. We fell short of the 130 previous high, so we're kind of putting in a lower high here. Should the crude bulls be worried, the WTI bugs?
Yeah, if you didn't get the text message at 3 a.m. and we were at 114, we broke hard. What's the driver? The driver is the shutdown of Shanghai. You can go back and look at a lot of the moves in crude oil have been, when we've had lower moves, have been driven by COVID fears. Go do your own homework, but you can look at that on the chart. It's pretty prevalent. This is what's driven us this last time, for sure. We had the break from 130.50 down hard. That was the first time China had announced shutdowns. So that's what's driving this. The whole idea being, obviously, if you shut down the economy, nobody needs to drive, and it just cascades. So crude oil has really been the canary in the coal mine trade for all the commodities. Crude oil got hammered, and it just hit a lot of sell stops across the commodities, corn, wheat, beans. Look at RBOB. RBOB is about 75 cents off of its highs, which is, if you buy gas, which most of your viewers do, it's going to be kind of a nice surprise as that comes through in the next few weeks. So that's the driver. And, are we going to go to, it looks like, right now I'm looking at it, we're down to 103 and change. I don't think we came all this way to not go down and see what happens if we get the $100 print. That may be, the defining battleground as we move through the rest of the week. But that seems to me what has been the driver. And it's, again, we took heat in all the commodities across the board today.
So crude, you can still zoom out General uptrend with the exception now of that lower high that we're talking about. But for wheat, the chart looks perhaps a little bit more interesting, Chris, where there's a bit of a coiled spring situation going on, where we had that real sharp, explosive move in late February. And then now we're kind of stuck here around $1,100. Seems like maybe we're testing some important support that's formed over the last month, the way my layman's chart work sees it.
Yes, and the way the markets work, they're lumping all wheat in together, even though there are 3 different kinds of wheat, and some will be harvested in the next 2 to 3 months. Some are going to be planted now in the spring. At the end of the day, it's all lumped into one issue. And we had an explosive, a historical move high between January and February. We basically rallied 75%, which is take a look at a continuation chart of wheat. So even when we're sitting here now at $10, that's 10-year highs. Now, we're not at the recent highs, but still, there's a lot of downside. We started this off, just to give you some example, we were around 750 in Chicago and KC wheat when this all started. So even to be sitting here at $10, what does that tell you? There's still a lot of potential for it. What I learned my first week of trading, which is called a repricing event. So if that happens, one way or the other, we're kind of hanging fire. What's the driver? On Thursday, we're going to get planting intentions from the USDA. Why is that important? Well, that report last year is where we put our lows in, which kind of set the table for the summertime rally, which got us 8-9-year highs. So it's a big report. Anybody that's long going into it is going to be taking risk off. That basically means selling something or buying puts to protect themselves, because it can really be in a very expensive coin flip on Thursday. And typically, those reports, okay, we'll rock and roll at 11 o'clock on Thursday. We'll move a lot, but it probably won't really work itself out till Friday, possibly even Monday. So it's a big report, and there's a lot of risk there.
Yeah.
And when we're on our highs, what's the risk? The risk is we have a correction lower.
And businesses and factories getting shut down in Shanghai and China to deal with COVID. I think you put a really important point back on our radar here, which is one explanation for why these assets are down right now. Wheat and crude both getting hit. All right, thanks for the check, Chris. Always good to help us look at those charts. Mr. Robinson joins from TJM Institutional Services. If there's one thing that can knock back crude, it is quarantine measures and the virus running wild still in China. With Chris on that, certainly makes sense. The only catch is Chinese stocks are actually up today. Go figure. Let's talk some home builders next with the bullish update on the already bullish case from CFRA. But this is now after earnings. Keep in mind that we just got KBH and the market didn't like the report. So let's hear the bull case next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim, she wanted to execute a preset trade strategy in seconds. So we gave them Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Home builders have been hurting after a huge rally during COVID, but one of them has been ailing more than others. KB Homes sitting at the lows, and last week's earnings did not help, carving out new 52-week lows right after the report. But Ken Leon says to stick with it. Research Director at CFRA covering the home builders. Welcome back, Ken. You shaved your price target a little bit down to 55, but that would still be on the opposite end of the chart at a 52-week high. How do we get there for KBH?
Yeah, so clearly there's pressure on builders and in particular KB Home. We start with the bull case that this stock is down 23% this year. It's trading at about 3.5 times current year earnings. KB Home has earnings estimates going higher in 2023, not lower. So the trajectory of the business is good. The sensitive spot is really orders are up, but Oliver was, on 95% of that order value up was on price increases and less on volume or unit orders or number of homes. The macro case is the bear case, especially looking back to past cycles. We're going to have higher mortgage rates. We're already seeing that now. But in the bull case, in terms of what will drive, let's call it dry powder to buy KB Homes and other builders, is that investors make up 33% of new existing home sales. These are institutions. It's about $60 to $70 billion coming into this market as an inflation hedge. So if you and I own an existing home, we have the ability to immediately sell at a high price and use that to buy a new home. That is unlike any past cycle.
Interesting. Ken, the thing that stands out to me is that KB Homes peaked a lot earlier than the broader home builder trade, which peaked alongside the NASDAQ. So I guess if there's one that's going to turn around first, that might argue for KB Homes. Also could argue that it's the weakest, but you're saying that there's basically new money flow into the stock. It's a pretty interesting analysis. I mean,
no, I said new money going into the new construction business, not
right.
Stock.
Right. Okay. So there are investors that are still funneling the hedge to inflation through housing exposure, basically.
That's correct, and it's very significant. Whether it's private equity, Invitation Homes, American Fur Homes, insurance companies, it's just there's a housing shortage, and that will continue for 5 to 10 years. So obviously, as an inflation hedge, residential is very attractive. I think for KB Homes, if you tracked it, we've never seen the stock go up on earnings because they talk down the fundamentals and the outlook. But the outlook's good. They're going to be growing total new communities to 255. That's about 10% plus up from where they are. So all the building pieces are in place. The one thing that's a slight drag is the supply chain delays, particularly in March, and that did affect their ability to even book more home deliveries. But the demand is still there. And Oliver, as long as the demand is there, these are cheap stocks, and we're going to see higher revenue and higher earnings for the next year or two.
3.5 times the fiscal year 22 earnings, looking at your note. How does that compare to history? I mean, it seems absurdly low in a market this expensive, but I know these companies don't generally attain those real lofty valuations, right?
Yeah, if we were in the material sectors and looking at commodities, we would say this stock is at its peak earnings, and we're basically reflecting that earnings are going down and the PE will just expand, but not because of better fundamentals. That is not the case, with KB Homes or the U.S. home builders today. They have very solid balance sheets. They did not have that in 2008. They have high total liquidity. They did not have that in 2008. They have about 2.5 to 3 years of own contract lots for development. When we go back to 2008, it was 7 to 8 years. And they were selling those homes in 2008 to subprime borrowers. Today, it's like 760 FICO or higher. So, you know, it's just a pretty conservative benchmark in terms of KB Home and other builders, providing that we have demand.
KB Home now trading below its pre-COVID high, a pretty amazing reversal there, while the broader sector is still above quite a bit. So can KB Homes, the bullish take here, and the 52-week high target, do you have that same optimism in the other builders? How does it compare to the group, still elevated broadly for this group relative to KB Homes?
So, you know, the leaders are large cap stocks in this group. D.R. Horton, Lennar, or Pulte Home are going to be able to get better supply chain results. They have larger scale, although KB Home with 255 communities is not a small builder. They're a top 10 builder. You know, so I would say those are good for traditional investors. For trading, you know, the most volatile name, and also actually is traded down more, Oliver, than KB Homes, is Meritage Homes. Ticker is MTH. We have a strong buy in it, and it has a higher percentage, 80%, is entry-level home buyers. And that could be squeezed, you know, with 30-year fixed rates, you know, of mortgages at around 4.6%. The storyline from Lennar and KB Homes on entry level is they're getting the higher echelon, higher income buyer from that category. But Meritage is the most volatile, the highest risk reward in the group. We're going to stay with it because in the last 3 years, they have built a efficient engine for driving entry-level homes, almost as good as the largest, which is D.R. Horton. So that's the one to watch if you're looking for highest risk reward.
Okay, I like that last point. It's been diving for like 5 days here. MTH, the ticker for Meritage Homes. Risk reward. Okay, we're definitely in a different place for home builders when we're thinking about trying to go from 52-week lows to highs. So an exciting time here for this group. Ken, thanks as always for the analysis.